The first thing I want to look at here is the business cycle. The business cycle basically represents the downward and upward movement of the overall economy. It's a cycle that goes in phases throughout which the economy goes through. There are four general phases in a economic cycle or a business cycle. Let's run through each of those phases here. Look at what they're characterized by. Expansion or expansionary phase of the business cycle is when businesses are ramping up. The economy is growing. Businesses are doing really well. It shows above average growth, and it's already functioning at a high economic level. The basic idea here is economic activity is increasing or maintaining a high level. So the gross domestic product, the GDP, which is often used to measure which phase of the business cycle we're in, is going up, performing really well. Unemployment is going down. Business spending is up. Employee salaries are typically up. Basically, everything's awesome. The economy is doing really well. It's performing at an exceptional level. Now, at the beginning of the expansionary phase, more credit is available. Money for people to borrow, lending, right? And interest rates are low. Banks and lending institutions are confident that customers will be able to pay back their money, so interest rates are at a low level. As the phases of the period move along, interest rates begin to rise and inflation rises with that. Inflation and interest rates typically move in tandem. So it starts with the expansionary phase. You have relatively low interest rates and relatively low inflation. As the phase moves along, those things are going up. So by the end of an expansionary phase, you've gotten to a higher level, inflation and interest rates. Now the peak is basically the maximum point of economic point in an expansion. It marks the end of an expansionary phase. And then after the peak, you're going to have the contractionary phase, which is the next phase in the business cycle that we'll look at. One thing that the peak is marked by is high inflation. Usually inflation, which has been going up throughout the expansionary phase, has reached a high level by the peak phase. Expansion can't go on forever, and interest rates go along with it. Now let's move on to the contraction or the contractionary phase of the business cycle. Here, the economy is contracting. It's either experiencing slower economic growth or it has started to decline. Less money is available to be lended out. They've tightened reserves. So at the end of the expansionary phase, high GDP, employment levels, high levels of business spending are dropping now. They're in a contractionary phase. At the beginning of the contractionary phase, credit is tight and interest rates is high. Typically, the beginning of a contractionary phase is where you're willing to see the highest inflation rate and interest rate. As the period moves on, interest rates and inflations drop, and this is largely often anyways, due to things that the Federal Reserve Board is doing related to monetary policy, which we'll get to pretty soon here. So again, during the contractionary phase, we have unemployment going up, the GDP going down, trade deficits going down. Trade deficits are often widening or expanding. A couple definitions that do show up on the exam: 2 or more consecutive quarters of economic contraction. This is a recession. 6 or more consecutive quarters of economic contraction is a depression. So a typical exam question you might see, a recession is defined as which of the following? A contraction is defined as 2 or more consecutive quarters of economic contraction. That would be the correct answer. B might say 5 or 4, 2 consecutive quarters of economic contraction, right? 1 quarter. But 2 or more would be the correct answer. 6 or more quarters would be a depression. The last phase of the business cycle is the trough phase. This is the end of its contractionary phase when it reaches its low point. Typically after the trough phase, this is where the economy starts to turn around and we have the expansionary phase starting up again. Okay, so think of it as waves. When we talk about phases of the business cycle, expansion is going up, peak it's reached the crest, contraction is going down, trough it's reached the bottom, and then it starts going up again with the expansionary phase of the business cycle. So now we know the phases of the economic cycle. Let's now look at economic indicators. Economic indicators are basically what is used by economists, financial analysts, to analyze which phase of the business cycle we're in, sometimes called and how far into that phase we might be, where we're heading in the new future, and some economic indicators represents past economic conditions. So basically, these are statistics that help to predict the future of the economy, characterized and current in the current phase of the economy, or reflect past economic conditions. Leading indicators predict future economic movements that a lagging indicator represents a past economic condition, and a coincident indicator represents where we are right now. So let's look at detail into these. First, leading indicators. So leading indicators are indicators that tend to change in advance in the economy as a whole. That predictive power, right? So an economist will look at a bunch of leading indicators that they all seem to be indicating the same thing. They can predict where the economy might be going. So important leading indicators: housing starts, the number of new housing and construction products that have been counted within a given period of time. When housing starts are up, it shows that people have the confidence, right? They're willing to put out and put money for houses, and we've got construction crews, employment there. You've got production costs and goods and services, woods, material, brick, roofing. So it's seen as a good sign. Initial applications for unemployment, when those are down, that's seen as a good economic sign. People are able to work and earn income. New manufacturing for consumer goods, when that's up, that's seen as a good sign. The money supply, there's M1 and M2 and M3. M1 and M2, which is the money supply, the S&P 500 index. When that's up, that's a good sign. When index on consumer spending is up, that is a good sign. For the exam, leading indicators are usually the most important. They kind of make sense, right? If you're trying to, you're working, telling somebody which investments to make, it's good to know where the economy is going to head if you're going to make suitable recommendations. That's why on the exam, out of all the indicators you're going to see in the questions, mostly you're going to be asked about leading economic indicators. Coincident economic indicators, you may see questions about these on the exam as well. These are indicators that change at the same time as, and usually because of, whatever economy. So what they say is they basically measure which phase of the economy that we're in at the current moment. Important coincident indicators, the GDP and the GNP. GDP is perhaps the most important coincident indicator. It basically measures all of the goods and services produced within the boundaries of a country, a given period of time, within a given period of time. The GNP is the gross national product. It measures the production of residents of a country no matter where the production takes place. The trade deficit, the difference between exports and imports. When imports exceed exports, as they have in the United States for a while now, that's a trade deficit. When the trade deficit grows, it shows usually we're in a contractionary period. When it shrinks, so exports are catching up to imports, it shows that we're in an expansion period. The non-farm payroll, personal income levels, industrial production, and retail manufacturing sales. These are all coincident economic indicators. Lagging indicators are indicators that don't change till after changes have occurred in the overall product or economy. So to explain what a lagging economic indicator is, I like to use one of these examples, the unemployment rate. Let's think about that. What does the unemployment rate measure? It measures the percentage of able workers who are unemployed at that point. Typically, unemployment doesn't start to go up until the economy has been in a contractionary phase for a while. Businesses don't stop laying off their employees right away. They stop until the contractionary phase has developed. The economy has been struggling for a little while before they start to lay off employees. So the unemployment rate doesn't start to go up until we're in the contractionary phase for a while. In contrast, when the economy starts to expand a little bit, businesses might still be a little leery at first to rehire people. So it might take a little while for the unemployment rate to go down. So it measures an economic change during where it takes place. Basically, consumer spending, CPI, the Consumer Price Index, the price that costs to buy certain items, goods, and services in different locations across the country. The CPI is also used to measure inflation. The primary charge by banks and bank loans outstanding. These are all examples of lagging economic indicators. Okay, so now we've gone through the economic phase of the business cycle, the indicators that are associated and help show where the economy has been in the past. Now let's ask the question, is there anything that the federal government or any of its agencies can do to affect economic change? Like if we're in a contractionary phase, do we just have to sit back and let it play out? Or is there something the government can do to stimulate the economy? And the answer is yes. There are things that the federal government can do to affect changes in the economy for its agencies. Monetary policy is one. This is implemented by the Federal Reserve Board, and fiscal policy is another, implemented by elected officials. So let's look first at monetary policy. So the focus of monetary policy is to control the supply of money and credit. The assumption behind monetary policy is that the growth in the money supply, making more money available to the public, increases available credit, lowering short-term interest rates, makes it easier for people to borrow and then spend money, which can help stimulate the economy. So to stimulate the economy, the basic idea that the Federal Reserve Board, which is what controls monetary policy, tries to make more money available in an economy. Now, if there's too much money available in the economy for too few goods, chasing too few goods, that's where inflation takes place. You can also use monetary policy to try to inflate and come back against combat inflation, and so making less money available in the economy, tightening credit. Changes don't happen instantly. They don't always occur as expected, but the general idea behind monetary policy is that there are certain things that the Fed can do to make money more readily available, drop short-term interest rates to grow the economy, and there are things that the Fed can do to make money less readily available, raise short-term interest rates and fight against inflation. That's what they try to do in monetary policy. The Fed has a few basic tools that it uses to use monetary policies. And there's 4 basic tools, but there's really only 3 that are commonly shown up on the exam. And those 3 we're going to run through right here. Open market operations, changing reserve requirements, and modifying the discount rate. The 4th tool that the Fed has is to change margin requirements under Regulation D. It hasn't done that since the mid-1970s though, so it's not likely to show up on the exam. They don't really use that often. So let's focus on these first 3 here, the three right here. You're most likely to see these on the exam. First off, open market operations. This is the one that the Fed uses most commonly. It involves basically buying and selling U.S. Treasuries. So to grow the economy, the Fed will buy U.S. Treasuries from an associated bank. So when it does that, it pays the banks money, injecting money into the supply. The banks have more money in their vaults, so short-term interest rates are lowered, specifically the federal funds rate, which we'll get into here in a second. That's the rate that is most closely tied to open market operations, the Fed funds rate. So with lower interest rates, it's easier for consumers to borrow money, and the more money they can borrow, the more money they can spend, and this fuels economic growth. On the other side, if there's too much money available, the Fed can use open market operations to fight against inflation. It would do that by basically selling U.S. Treasuries to its banks. So taking money from the banks. They're giving money to the Fed by buying securities from them. They have less money in their vaults, higher short-term interest rates, cost more to borrow money, right? It's harder for people to borrow. The less money that's being borrowed, the more less money is being spent, combating inflation. So the federal funds rate is the rate that is most directly affected with the short-term operations. So the federal fund rate, is the short-term rate that's most directly affected by open market operations. The federal funds rate, by definition, is the rate that banks charge each other to borrow money. A second way that the Fed can use monetary policy, or a second tool of monetary policy the Fed has at its disposal, is changing reserve requirements. A reserve requirement is the amount of customer money that banks are required to keep in reserve at all times before lending out to another bank, and the Fed directly controls this. So to grow the economy, the Fed could lower the reserve requirement. That means that banks don't have to keep as much money in their vaults. This happened during COVID. They reduced the reserve requirement to 0. They can lend more money out for shorter term interest rates, so that would be easier for people to borrow money, not spend it in the economy when it grows. They could set it at 10% though, right? They could raise the reserve requirement. Now banks are required to keep more money in their vaults. There's less money out there. It's harder for people to borrow money and spend it because of the reserves that have to be kept by each bank, and this could decrease inflation. The final tool of monetary policy that the Fed has at its disposal is changing the discount rate. The discount rate is the rate that banks have to pay when they borrow money from the Federal Reserve. So the Fed can control that discount rate. So to grow the economy, it could lower that discount rate. It makes it easier for banks to borrow money. They have more money to loan out to their customers. Short-term interest rates are reduced. It's easier to borrow and spend money and fuel the economy. To fight against inflation, the Fed could raise the discount rate. That means it's harder for banks to borrow money from the Fed. The less money they have, the higher short-term interest rates will be, and the harder it will be for their customers to borrow and spend money, and that could help fight against inflation. So when it comes to monetary policy, the major idea is the Fed wants to be able to grow the economy. They make more money available, lowering short-term interest rates, loosening credit. If they want to fight against inflation, they cut back on the money that's available. They tighten credit, and that raises short-term interest rates. It makes it harder for people to borrow and spend money. The second tool that the government and its agencies have at its disposal to fight, combat, and change economic things is fiscal policy. Fiscal policy is basically what the federal government can do to affect economic change. Basically, the president and Congress, what elected officials do, the ideas around taxing and spending. So to stimulate the economy, Congress, the president, would lower taxes. That means that you get to keep more money in your paycheck and there's more money for you to spend, and increase government spending. The more the government is spending, the more jobs it can create. It can help to fuel industrial production. For example, the government wants to build highways. They pour money into the economy to build highways, and you need supplies to help with those highways, constructions crews, you need road crews. So there's more jobs, there's more industrial manufacturing and production, helps to grow the economy. Slow down the economy, the government could raise taxes and decrease government spending. Raise taxes, more money comes out of people's paychecks, there's less money for them to spend. Decreased spending, all that money that was being pumped into the economy for jobs, manufacturing before, is now no longer there. So you have to slow down, fewer jobs, less spending for production goods, right? That helps to slow down the economy. Okay, let's now shift our focus to analysis. So analyzing investments. So we'll look at first through the perspective of an equity investments like stocks, and we'll look at other type of analysis later on as well. So there are two basic types of securities in analysis: fundamental analysis and technical analysis. Fundamental analysis involves basically looking at the financial fundamentals of the company that issued the securities that you're thinking about buying. So looking at their overall financial health. So use of public information regarding the issuing company to make an investment decision. So the important documents that are used in fundamental analysis, the balance sheet, the income statement. Now the cash flow statement is also used. It is covered in your book and it might show up on the exam, but the balance sheet and income statement are the ones that you're definitely going to see the most questions on your exam. Also looking at new products and services the company offers and information about its management team. These are all things that a fundamental analysis might look at. Now technical analysis is its second form of securities analysis, is a little bit different. Technical analysis would basically be looking at price patterns and charting this information to predict past price performance equals future results. And then they chart this information and look for patterns within the charts themselves that they're looking at to predict where that price is going to go in the future. So they use things like price charts, candlestick patterns to tell the number of shares traded, price volatility, the changes over time on the daily, 4-hour, and sometimes yearly charts. They look at technical analysis that shows past performance. It shows where the price is going to go in the future. So a technical analyst really isn't looking at any of these financial documents that show the overall health of the company, the balance sheet of their income statement. They're looking at the historical price of the company's stock to try and make a prediction about where that price is going in the future. So a little question here: which of the following would not be used by a fundamental analyst? The company's liquidity, or its 52-week moving average. A moving average is a indicator. It's basically the average price of a security over that period of time. So the 52-week moving average represents the average price of that security over the last year. So typically what a technical analysis will do is they'll look at that long-term moving average, like the 1-year moving average, and compare it to a shorter term, like a 30-day moving average. When a shorter term price averages above the long-term averages, that's a bullish signal. So basically what I'm saying is a moving average is something that a technical analyst would look at. The company's liquidity, and there are different metrics that go into finding this out on the balance sheet. That would be something that fundamental analysis would look at. It's something that helps to show the financial health of the issuing company. That's the fundamental analysis, not the technical analysis, right? So the fundamental analysis would look at, they would look at A, but not the 52-week moving average B. So B would be the answer to this question here. So now let's look at some of the metrics that a fundamental analysis might look at when they're deciding whether to make an investment, right? So they're looking at the overall financial health of the company. And a big thing that goes along with this is liquidity or solvency. So what we're looking at here is how able would the company be to pay off its debts if it had to liquidate tomorrow or in the short term, right? You know, it has to liquidate its assets to cover its debts. How able would it be able to do that, and how much money would it have left over? That's solvency, the idea of it is. So there's three main instruments here we have on the slide here that a fundamental analyst might use and might look at to determine the company's level of solvency: net working capital, current ratio, and quick ratio. Now the information needed to calculate these things is all on the company's balance sheet. So basically you need to know the current assets and the current liabilities. Current assets are assets that are either already cash or plan to be turned to cash in within 12 months or less, 1 year or less. Cash, securities, accounts receivable, inventory, prepaid expenses. Current liabilities are debts that are due in the next year: accounts payable, notes payable, taxes payable, interest payable, wages payable. So we're going to take those values and use them to calculate each of these metrics. So net working capital and current ratio basically use the same numbers. Net working capital is current assets minus liabilities. If the number is above, if it's a positive number, that means they have more current assets than to cover their current liabilities and they'll have money left over. If it's a negative number, that means their current liabilities are higher than their current assets and they could be in trouble. The current ratio basically just does current assets over current liabilities. So current ratios, so divided by current liabilities. So you get a whole number over that fraction. If it's a greater number, that means the assets are higher than the liabilities. If it's a lesser number, then there could be problems with the company because the current liabilities are higher than the current assets. And forced to liquidate, they might not have enough money in the short term to cover their debts and expenses. The quick ratio, also known as the acid test, basically takes the current assets except for inventory and prepaid expenses. It basically takes the assets that you could turn to cash, like immediately or almost immediately, takes those and divides them by current liabilities. So what the quick ratio or acid test is doing is measuring how liquid is the company, how solvent would they be if they have to cover their debts right now. So basically in a short period of time. The current ratio is measuring how able they would be able to cover their debts within a year's time. The quick ratio is how able would it be able to cover immediate period, quickly, right? So their immediate inventory, because their inventory they might not be able to sell off right away. If it's prepaid expenses, you can't turn it into cash as well. So that's why you do not include those as part of the quick ratio calculation. Another metric that a fundamental analysis would look at is leverage ratio. Leverage ratio is basically measuring how much of the company is financed by debt compared to how much it's financed by equity, private equity. Why would somebody be looking at this? Because companies often use borrowed money to increase the return, but there is potentially more risk involved if you're financing your operation. You might get more risk than equity. So basically the debt to equity ratio is debt over equity. The higher the ratio, the more debt the company has compared to equity. So typically a company's capital structure, which again, this would be found in the balance sheet, the information needed for this, the long-term debt, common equity. So basically the value of the common stock at par plus any capital surplus, right? When you sell shares of common stock, usually you sell them at a higher price than the par value, which is an arbitrary number. So that excess capital. So if during the IPO the par value was 10 cents and you sold shares for $20 a share, the excess capital would be the difference between the par value and the price you sold them at, and then retained earnings. So net income, whatever earnings you didn't distribute to your in the form of dividends to shareholders, and then preferred equity, the value of preferred stock, the par value of the preferred stock. These are all things that go into the company's capital structure. So the debt and then the types of equity, numbers 2 and 3 here, the debt to equity ratio. So where do we find the information that a fundamental analysis uses? So all publicly traded companies have to file financial reports with the SEC using these GAAP accounting standards. The most important documents, the balance sheet, which basically records assets, liabilities, and shareholder equity. Basically, assets equals liabilities plus shareholder equity on the balance sheet. The income statement, which is basically measuring the company's revenues over a given period minus all the expenses that it's incurred during that period, which leads to net income. And then the cash flow statement, which is basically a record of the cash flows that's come in and how it's spending that cash. So also footnotes to the above statements, balance sheet, income statement, cash flow statement, which retirement plan obligation, stock options. Granted, it offers them to employees, in any contingent liabilities, such as pending legal cases. These are all things that a fundamental analyst would look at. All right, let's look at the time value of money. That's another important topic related to evaluating investments that might come up on your exam. So big components of this: present value and future value. So let's look at each of those. So present value, what is the present value related to an investment? Basically looking at future cash flows that you're going to receive as a result of having that investment and discounting them based on the market rate of interest at today's value. So present value assessment, it is used oftentimes for debt securities like bonds. It can be used for dividend paying stocks as well. So when it says theoretical value of a bond or other income producing asset, a stock that regularly pays dividends would be considered earned income producing investment. So basically the idea about present value investment is knowing you're going to receive a bunch of payments from the investments in the future. You want to discount those payments using current interest rates. So basically would tell you what the actual value of the security is at this current point in time. So the present value is basically used by taking that future cash that you're going to receive and then dividing it by 1 plus the discount rate raised to the number of periods. So for instance, if you're going to get 3 years from now, you're going to get $500 payments and the current interest rate is 5%, you would take that $500 in cash, divide it by 1.05 plus that 5% discount rate, and then raise it to the third power. So you basically take that $500 and divide it by 1.53 times. 500 divided by 1.05 divided by 1.05 divided by 1.05 would tell you the present value of the $500 payment that you're going to receive 3 years is. So future value, let's look at that one. Future value is basically telling you what some amount of money that you have today would be worth in the future, given some specific rate of return, typically market interest rates and interest percentage. So why would you use this? To help determine the issuing company is worth as an investment. Would it be worth that the investment, how much is it going to be worth in a few years' time, the one you receive right now? This is often used by bonds, knowing you're going to receive payments in the future. So how would you calculate future value? You would take that present investment and multiply it by 1 plus the discount rate, raised to the number of periods of time. So say you have $500 now. You could basically invest it at 5%. So what is the value going to be worth in 3 years? $500 times 1.05 plus that 5% rate. And then you would do that to third power. So $500 times 1.05 times 1.05 times 1.05. That would tell you the future value of that $500 investment, given that rate of return or given interest rate. All right, here's a present value example. So say you own a 3-year zero coupon bond, $1,000 face value bond. Similar bonds in the market are yielding 5%, so that's going to be your discount rate. That's the typical interest rate. What is the fair market value for this bond? All right, so using the discounted cash flow, discounting to the present value is what that means. You would take that present value, so you'd take the future cash flow to determine present value by taking the future cash flow dividing by 1 plus the discount rate raised to the number of period of times. So basically you take that $1,000 and divide it by 1.05 3 times. So it says 1.05 times 1.05 times 1.05, right? Or you could just take 1,000 and divide it by 1.05 and divide it by 1 and divide it by 1.05, divided by 1.05, divided by 1.05, and the answer you'd get is $864.30. You would take that present value, so you'd take the future cash flow to determine present value by taking future cash flow dividing by 1 plus the discount rate raised to the number of period times. So basically you take that $1,000 and divide it by 1.05 3 times. So it says here 1.05 times 1.05 times 1.05 and then put your answer in the denominator, or you could just take 1,000 and divide it by 1.05 divided by 1.05 divided by 1.05, and the answer you get there is $864.30. So that's the theoretical value of this bond. Okay, so that basically tells you what you should be willing to pay for this bond right now, given those discounted cash flows. All right, now the net present value calculation here is related to this. What is the NBP? It basically helps you determine if an investment is worth making given its discounted cash flows and its current market price. So once you go and figure out what the present value is, which we did on the last slide, you would then compare it to what its current market price is, and it would tell you whether the investment is worth making. So net present value is the amount on which an investment is calculated present value and receives fall short of its current or it's going to fall short of its current market price, right? So in the previous example, using the present value calculation method, we determined that the present value of that bond was $864.30. Now, stating the current market price is $850, so the NPV of that would be the $864.30 present value minus $850. So you would have an MPV of $14.30 plus $14.30. So whenever the MPV is positive, that tells you that it's potentially a good investment. It basically means that you can buy the bond at a price that's cheaper than its actual theoretical present value. So when the NPV is greater than 0, a positive number, that means that an investment is worth making. For exam questions, the exam keeps that in mind. So if the test asks you, should you do X or should you do Y, you do the MPV to figure that out. What does that mean? That if the investment has a positive MPV, it's one that's worth making probably. Or if you're making, give an example, 2 different investments with 2 different MPVs, the one with the higher MPV would be the one that's worth making, if they're giving you 2 examples. Now let's shift our focus to another important topics on the exam, types of risk, right? You'll probably see a handful of the questions related to types of risks. So first off, when it comes to risk in general, we get 2 overarching types of risk: systematic risk and non-systematic risk. Systematic risk is basically the risk that affects all of the securities in the market. It can't be diversified away. So basically, systematic risk is the risk that the overall market is going to go down, causing the value of investments to go down. Diversification does not help in systematic risk. Non-systematic risks are the risks that a specific investment, potentially in a specific industry, is going to go down, right? In not relation to the overall market. Business risk is one type of non-systematic risk. Now, diversification does help with non-systematic risk. Non-systematic risk is one that is specific to each investment within the portfolio. So the more diversified your portfolio is, not keeping all your eggs in one basket, right? It would be less subject to non-systematic risk. So let's look at the specific type of systematic risks. Again, these are risks that are not diversifiable. For the exam, there's 3 types. One's on this slide, and then the other 2 are on our next slide. So first is market risk. So market risk is the risk that an investment's going to lose value due to overall decline in the market. the market just tanks. Securities that you own are subject to their values going down. So diversification within the equities market does not help reduce market risk. There are ways to reduce market risk by hedging. Hedging is basically like taking a position that goes in the opposite direction of your other positions, or potentially shorting, right? You know, buying puts on a broad-based index like a S&P 500 index, which often represents the overall market as a whole. Whenever you have a put investment and the overall investment goes down, that put investment's value goes up. So when the S&P 500 goes down, if you bought puts, the value of your put would go up. So a hedge would be created, protection in that instance. Another way to hedge is to sell short market ETFs. ETFs are exchange traded funds. If you buy an ETF that's connected to a broader lying index, like the S&P 500 index, and the value of the S&P goes down, when you short ETFs, right, you borrow from the broker-dealer, sell them immediately. You hope the market price drops. You have to return them at some price. You sell them when the market price is higher and the price drops and gone down in value. You can buy them back cheaper at a lower price and then return the securities to your broker and keep the difference. The second type of systematic risk is interest rate risk. This is the risk that interest rates will go up, leaving fixed income securities like bonds less desirable. When interest rates go up, the market price of bonds goes down. Long-term bonds market prices are most directly susceptible to this. Short-term bond prices will go down when interest rates go up, but not as volatility high as long-term bond prices, because your money's not locked in over a longer period of interest rate, longer amount of time, right? So interest rate risk, when interest rates go up, the market risk of bonds goes down. Purchasing power risk is also known as inflation risk. The risk that inflation will devalue a bond because money won't be worth what it is when the bond was purchased. So bonds are fixed income securities. You receive the same amount of money no matter where inflation is. So when inflation goes up, your money does not go as far as it would have when inflation was not taken hold. So inflation, it generally takes place during expansionary environments. Usually during expansionary environments, the price of stock goes up, so they're better investments than bonds are. Deflation, it occurs, it first occurs during an economic contraction. Bonds are usually the best choice during that period. The fixed income would go further when money is not deflated in value. And also, during a contractionary period, interest rates are dropping. So if you own a bond that has a higher interest rate or higher than market interest rate, the market value of your bond will drop. So that's a reason that during deflationary environments, bonds are considered better investments than stocks. Let's look at unsystematic risk. Unsystematic risk is a unique risk associated with a specific investment or asset. So diversification within a portfolio helps with these. So generally speaking, different stocks or different companies, you have a broader portfolio, the less subject to each type of risks, these risks you'd be subject to. Let's look at non-systematic risk now. So business risk. Business risk is the risk that a particular business or industry might face that's unique to each business. So in essence, their products becoming obsolete, more competition within the industry, poorer management, poor earnings. So the more businesses or investments you have invested in, the more you have a diversified portfolio, the less subject you are to business risk. Just because if one company is poorly managed, that doesn't mean your overall portfolio is going to go down. So diversification will help with this. Sector risk is the risk that investments in the same economic sector will decline in value. So the whole sector, for instance, the travel sector is down, right? Travel industry is all down. In general, you have a bunch of stocks in the travel industry. That's sector risk. So diversifying against different sectors across different economic sectors and not aiming too strong a focus in any one sector is a primary way to combat sector risk. Regulatory risk is the risk that regulatory laws in the industry may change and affect the investment. So there's a problem in U.S. markets. It's also known as legislative risk. Laws, regulations are passed, again, change and cut into the profitability of a company that issues securities. For instance, alcohol, tobacco, and firearms are highly subject to legislative risk. Assuming companies within those industries, oftentimes if there's laws or regulations passed that negatively impact the price of securities, that they negatively impact the ability to sell their goods and services, that's going to affect securities price. It's not the same as political risk here, but which we'll talk about next year. Political risk is the risk that the political situation in a country might change and cause investments, securities issued in that country to lose value. So this is a risk associated with foreign investments, foreign exchange, right? Typically in developing countries or sometimes called third world markets. So the idea that a country ends up in a finicky situation and may be unstable, like an election, a regime change, or something like that, it could lead to further instability. It could lead to a reduction in values of the securities position that the investor is investing in. Geopolitical risk is the risk that investments would lose value caused by competition or conflict between nations over natural resources, markets, or trade, risk of terrorist or hostile action. So geopolitical events could negatively impact the value of securities. Liquidity risk is the risk that an investor won't be able to sell their investment at a fair price. So the idea that the investment might not be in high demand, so it might be hard for you to sell it, find a buyer, you might not be able to get a fair price for it. Now, this is usually associated with things that are hard to trade, like thinly traded stocks, typically not exchange traded stocks. Municipal securities are also not as liquid. Private equity, real estate, things that are harder to sell. Limited partnerships, DPPs, direct participation programs. Liquidity risk typically is not an issue for things like U.S. Treasuries, exchange-listed stocks. These things are easily negotiable, and they're typically easy to find a buyer for and don't run into a liquidity risk as much with these type of securities. Well done. You've completed Chapter 1 of our video lecture. Moving on to Chapter 2. It's time now that you go over to millionairesintraining.com and take our practice simulated exams for Chapter 1. Do all the subchapter tests and the chapter final. Keep doing these exams until you can 80, 90, or if you're serious, 100% our exams on Millionaires in Training, ensuring that you'll pass your test on the day of your exam. Keep at it, and I'll see you in the next chapter. I'm Colin Kleck, representing millionairesintraining.com. I'll see you in the next video. When we talk about equity securities, we're talking about an investor buying a piece of ownership in the issuing company. And the most commonly invested in type of equity security is common stock. Common stock is a basic unit of ownership in a issuing company and most commonly traded as an equity security. And on the exam, they mention someone buying 100 shares of ABC Corporation. They're talking about that person buying common stock. There are a couple of reasons an investor would purchase common stock. Number one, investors are often looking for capital appreciation. They hope to buy the security at one market price and then sell it at a higher market price. So buy low and sell high. So they might do that if they expect the company to grow in the future, their earnings to grow, and in turn the market price would grow. You buy the stock at $10 a share, its market price rises to $200 a share. You can make a lot of money when you sell the stock at some point in the future. The second reason somebody might buy shares of common stock is in order to receive income, typically in the form of dividends. Now, when we talk about income, what we mean is money that you receive while you hold the security. You still own it, and you're receiving some sort of payment, either in the form of cash, dividends. When we talk about stock, what you're going to receive is cash dividends. When we talk about bonds later on, we're going to talk about how you receive interest payments. Right here, we're focused on common stock. So cash dividends are issued by companies. Now, usually, or more often than not, the company is likely to issue a dividend when its earnings are high, when it has extra money to hand out to investors. So it's at the mercy of the board of directors to decide when and if and how much a dividend is going to be if it's paid to common stockholders. Dividends are paid quarterly, but there is no guarantee that the company is going to pay dividends any of those quarters or all of those quarters. Again, it's at the discretion of the board of directors on whether or not it's going to pay common stock dividends or not. Okay, so let's look at some more common stock basics here. There's two different types of shares: authorized shares, issued shares, treasury stock, and outstanding shares. Okay, authorized shares are basically the number of shares that the company is authorized to issue in the future. Before a company sells any shares of stock, it first must be authorized to do so. So within the company's charter, corporations are often are authorized to issue up to a certain number of shares, and those are called authorized shares. Issued shares are shares that the company actually issues and sells to investors in order to raise money. They issue the shares new, they take in the money from selling those shares and use it for corporate expenses. So for example, ABC Pizza raises $200 million by selling common stock with a public offering price of $10 a share. That means that it issued 20 million shares. 20 million times $10 a share, 200 million total proceeds from that issue. Now, oftentimes, a company will buy back some of its shares of stock. When it does that, that is known as treasury stock. Treasury stock is stock that has already been issued at some point, and now the company wishes to buy the shares back, and they'll be traded on the secondary market. So once the shares are issued, they're traded on the secondary market. They can trade it to other investors. If the company can buy it back, that becomes treasury stock. Those shares of treasury stock can no longer be traded among investors. So now we're left with outstanding shares. Outstanding shares are the shares that are actually out there on the secondary market that can be traded. So basically calculate the number of outstanding shares. We would take the total number of issued shares and subtract the number of treasury shares the company's bought back, and that way that would leave you with outstanding shares. Treasury shares are no longer considered to be outstanding shares. They're issued shares, but they are no longer outstanding shares. So issued minus treasury equals outstanding. Now, why would a company buy back shares of stock and make it treasury stock? Well, when there are fewer shares of the company's stock outstanding, the company's earnings per share goes up. The earnings per share is basically the net income minus any preferred dividend shareholder paid divided by the number of shares outstanding. So the earnings basically states that treasury stock is purchased. The earnings basically say in the same number, the number of shares goes down. So if the equation is earnings divided by number of shares outstanding, then the number of the denominator goes down and the overall EPS is going to go up. And often when the EPS goes up, the market price of the company's stock might also go up. So the company might buy back shares of its stock in order to increase its EPS. It's also consolidate company control, or to kind of control the company's shares of stock. Let's look at common stock shareholder rights. So when somebody buys common shares of stock, there are privileges that go along with that. Ownership, right? So that's what we're going to look at. That is what we're going to look at here. What somebody obtains when they own common shares of stock, first off, the big one is the right to pertain to shareholder meetings and vote, right? You own shares of common stock, you're part owner in that company, you have the right to vote on certain matters relating to the company's business. So what matters do you get to vote on? Things like stock splits, mergers and acquisitions, elections, members of the board of directors, changes of business objectives, and some states allow that last one, some states don't, but there is potentially something that is available for common stockholders to vote on. One thing common stockholders do not have the right to vote on is dividends. Whether a dividend will be paid or how much the dividend will be, that is determined by the board of directors. The right to dividends, basically, dividends are paid when the board of directors declares it. So we talked about voting in this company meeting. Stockholder votes are equal to the number of shares. So if you have more shares, you have more power at these shareholder meetings. Another right that a common stockholder has is the right to transfer shares. You might see the phrase, the certificate is negotiable. We see negotiable related to what? Securities. It means that you can trade it to somebody else at its market price. And you buy shares of common stock, you are able to trade them to somebody else. Also, the right to seek quarterly and annual reports of the issuers, so you could check on the company's health. You have a preemptive right. This is the right of residual claim, right? Preemptive rights are not always offered, but it is a potential right that a common stockholder buys. What is a preemptive right? It is a right to buy a certain number of newly issued shares and keep your ownership percentage the same. So for instance, a company issues 1 million shares as IPO and you own 2% of those 1 million shares. Now they issue 1 million new shares in a new offering. If you don't buy any new shares, that's going to dilute your ownership percentage. Preemptive rights would give you the opportunity to buy the same percentage of shares that you own in the company to keep your ownership percentage the same, and usually have the right to do so at a discounted price. Normally, preemptive rights are offered at a discount. Let's look at common stock valuations. The PE ratio, the price to earnings ratio, just referenced that a couple minutes ago, but basically this is the per share market price of the stock divided by the EPS. EPS is net income minus preferred stockholders' dividends divided by number of shares outstanding. So whatever the stock is trading at in the secondary market, dividing by its EPS is the PE ratio. So you might see this referred to as the multiplier effect. In the industry, this is often used as a multiple in the exam. It's probably could show up on the this could show up on the exam in the multiple. It's talking about the PE ratio. So the PE ratio is determining if the stock is over or undervalued, and it measures the price investors paid for the stock per dollar of earnings. So sometimes the stock are known to have higher PE ratios, like growth stocks. Stocks, of small companies who are expected to grow over time. Sometimes investors are willing to pay a little bit more for a stock that otherwise would be based on its earnings because the expectations of the company is going to grow over time. Usually, like value stocks or have a higher PE ratio, the market price is closer to where its earnings are. But the different types of stock that have different types of PE ratios. Now, a different type of duration method that might be used for stocks is the dividend discount model. This is used to assess the stock's fair market value of its expected dividends. The dividend discount model basically basically says that a fair price of the stock, a good price to pay in the market, is you would take the annual dividend divided by the expected rate of return minus the expected growth rate. So the expected rate of return is the rate of return that the investor wants or needs to see for an investment to be profitable for a client. So basically you perform that calculation, take the annual expected dividend, divide it by expected rate of return minus expected growth rate, and that tells you if you can get the stock for that price or better, it's an investment worth making. Now let's shift our focus to preferred stock. This is another type of equity security. It represents ownership in the issuing company, but it's different from common stock. There are differences between common stock and preferred stock. Big difference. Preferred stock comes with a higher expectation that dividends will be paid. Preferred stockholders receive dividends before common stockholders receive dividends. They have a preferred dividend treatment, and typically they receive dividends in some fixed percentage of the common stock's par value. So there's a fixed rate at which a preferred stockholder receives an annual dividend. So, for instance, if an IBM 5% preferred stock comes with a $100 par value, but on the exam, preferred stock is going to come with a $100 par value. That means it pays a $5 per year dividend. It pays 5% of that $100 par value in dividends. That's provided that all dividends have been paid during the percent of the year, that they're caught up, right? So the dividend is still at the mercy of the board of directors. They do have the right to not declare dividends, and if they don't, then the investor would not receive $5 total during the course of the year. However, preferred stockholder dividends need to be paid before any dividend is paid to common stockholders. So in the case that common stockholders receive dividends, that means that preferred stockholders have already received all their dividends that year, that quarter. Dividends are usually paid on a quarterly basis. Who buys preferred stock? Most retail investors don't buy preferred stock. Usually it's corporations. That is because there is a big 50% dividend deduction for corporations. Basically, 50% of the dividend amount will be subtracted from the corporation's overall dividend per year. So it's a pretty major tax benefit that goes along with corporations and preferred stock. Typically, retail investors do not get this. So that's why a majority of preferred stockholders are corporations. All right, let's look at preferred stock valuations when we're talking about how the market value of preferred stock. It does trade in the secondary market just like common stock. The market price of preferred stock, though, typically fluctuates based upon interest rates. It's interest rate sensitive, just like bonds will fluctuate in relation to price and interest rate changes, just like we'll see here coming up in a little bit with bond prices. Also fluctuating with interest rates. They're inverse relationships, meaning when interest rates rise, the market price of preferred stock goes down. When interest rates go up, when interest rates go down, the market has already issued preferred stock, the price typically goes up. It's an inverse relationship. So say, for instance, we own one ABC 5% preferred stock at par. The market rate for similar preferred stock rises to 6%, and that's usually because interest rates. have risen to 6%. So what would happen to the market value of preferred share? It would go down. For example, it might go down to $80. Even though par value is $100, it might drop to $80. So why is that? So we have preferred stock that's a 5% annual dividend rate. Now interest rates go up to 6%. So now newly issued preferred stock, you would have around a 6% annual dividend percentage rate. If we're going to sell our 5% of the preferred stock, we're going to have to sell it at a price that's lower than the par value, right? Why? Because why would somebody buy our 5% preferred stock at par value when we could buy a newly issued 6% preferred stock for par value, right? So that's why they're going to have to take a little bit of a loss. And when interest rates go up, price goes down. Even though when the market rate does fluctuate based on interest rates, it's not acknowledgeable to the price of common stock. With common stock, there's much of a chance of capital appreciation with common stock because the price of preferred stock does fluctuate slightly. It doesn't fluctuate as greatly as prices of preferred stock. Most preferred stock investors are looking to make money on those regular dividend payments, not so much off of the rise of the market price, capital appreciation, like you would with common stock. There is one exception with that we'll get into in a few minutes. Let's look at the different types of preferred stock. First off, cumulative preferred stock. So we said a little bit earlier that even though preferred stockholders receive dividends before common stockholders, the dividend payments are still based upon the board of directors' discretion on whether or not they're going to pay dividends or not. With a cumulative preferred stock, any unpaid past and present dividends, they accumulate. And so before any common stockholders can receive a dividend, a cumulative preferred stockholder would have to receive all the dividends missed in arrears. So say for instance, ABC Corporation has cumulative preferred stock and ABC did not pay dividends in quarters 1 or 2 or 3. They're going to pay a dividend to common stockholders. Cumulative preferred stockholders would need to receive the quarter 1, 2, and 3 dividend payment before common stockholders can receive a dividend. Participating preferred stock, this is a type in which the investor receives a regular dividend when the board of directors decides to pay it, and they might also get a little bit extra depending on a benchmark rate. And usually the benchmark has to do with the issuing company's performance. A common benchmark is if common stockholders get a dividend of at least a certain amount, the preferred stockholder would get the regular dividend plus some extra amount. All right, callable preferred stock. So this allows the company to call the shares and buy back the preferred shares when the investor makes investors want to sell the shares back to the company at the issuing value, sometimes slightly higher at par value. So usually they would do this when interest rates drop and they can issue new preferred stock at a lower percentage. When interest rates fall, expect a call, right? So callable preferred stock is a little bit riskier. You risk your preferred stock being called and losing those dividend payments. So why would somebody buy callable preferred stock? Normally the dividends are a little bit higher than with the callable preferred percentage than other type of common stock with different types of risk that their stock will be called. And then there's convertible preferred stock. This is a little bit different than preferred stock. This allows the investor to convert the preferred stock into a certain number of shares based on the company's common stock, if they decide to do so, to be profitable. So this is one type of preferred stock that comes with capital gain, capital appreciation potential, because the market price of cumulative preferred stock is directly tied, or convertible preferred stock is directly tied to the market price of common stock. Remember, if the market price of common stock goes up, the market price of common stock can go up a higher percentage than preferred stock, and if it does, then the value of the convertible bond or convertible preferred stock would also go up. If you convert your bond to common stock has a greater capital appreciation potential overall than preferred stock does. So this is the one type of preferred stock that the market price is not really dependent on interest rates. It's more connected to the price of the common stock. But a drawback to this type of preferred stock is it normally has a lower dividend percentage than any other type because you have the ability to convert it to shares of common. But it does come with the advantage of capital appreciation, whereas other types of preferred stock really don't. Let's look at a different type item related to the investments. Stock options. A stock option is typically associated with a company that gives you the option to buy some shares of their stock. There are two different types of stock option, a non-qualified and a qualified. A qualified option is always given to employees of the company. So what the stock option does is it gives you the right to buy the shares at a certain price. So usually, like if the market price of the share rises above that exercise price, that would be a case in which you would exercise your stock options and your right to buy. So a qualified stock option means that once the employee exercises the option, now they own the shares. They don't have to pay any taxes yet. Their holding period starts. The date on which you buy the shares, your holding period starts, and you're not taxed on anything yet. So you're not going to be taxed on those shares until you sell them. When you sell those shares you purchased with a stock option, you'll be taxed at capital gains, right? You bought them at the exercise price, you sell them at whatever their market price is at the time. If you hold them for over a year, you'll get the preferred capital gains rate, which is 50%. Most investors want this. They get the short-term rate, whatever the person's income tax bracket. So whatever you hold it for the year, you get that capital gains. A non-qualified stock option. These are given to employees, sometimes non-employees of companies. Sometimes people that have been with the company might get non-qualified stock options. These work a little bit differently. So by the time the option is exercised, you have to report at that point something on your tax form. The tax isn't deferred as it is with qualified options. And the tax that you'd have to pay would be the difference between the exercise price and the market price. And you would pay it at your ordinary income tax rate. So say, for instance, the stock price is exercised was at 15. You would exercise it when the shares are trading at 20. You would have to report a $5 worth of ordinary income per share for a non-qualified stock option in the year that you exercised it. You would pay taxes in your ordinary income rate, your tax bracket, which is higher than the long-term capital gains rate. All right, let's look at other types of equity securities, ADRs, American Depository Receipts. So an ADR is basically receipt of a foreign security that's traded on American exchanges. Foreign securities traded in domestic markets. So the actual shares that are purchased by the U.S. bank, the depository bank, and they put those shares in a custodian bank, which is usually a branch of a bank located in the issuer's country. So say we have an American bank, ABC Bank, that has branches in Japan. They decide to buy shares of stock issued by a Japanese company. They buy those shares, they deposit them in one of their branches, and then the depository bank issues ADRs. Those ADRs represent shares of the actual foreign stock that are held by the custodian bank. So an ADR in this example represents shares of the Japanese stock that's held in that bank in Japan. ADRs are what sell on American exchanges. Now, ADRs need to be registered with the SEC. They can trade either on an exchange or over the counter, and the value of an ADR's market price is going to be dependent upon the price of the foreign securities trading on that exchange. The foreign security is held in the depository of that bank, so the price rise and falls with the representation of the underlying shares. So let's turn away from equities and look into more debt investments. Bonds. Bonds are the big type of debt investments that you'll need to know for the exam. So a bond is essentially a loan that's made to the issuer, whoever issues the bond. They sell the bond to the investor. They take the investor's money at some point. In the future, they're going to have to pay that money back to the investor. And usually along the way, they're going to have to make interest payments to the investor who holds the bond. So for corporate treasury bonds, the par value is almost always $1,000 on the exam. And the examples are going to be $1,000. If they say 5,000, that means they're asking about 5 bonds. The yield or the coupon rate is the stated annual percentage of par value that the investor receives in interest. Now, these coupon and interest payments are made semi-annually. So that means, for instance, an investor has 5% interest rate, that's 5% of $1,000. You receive $50 total yearly in interest, but it's broken down into two $25 semi-annual interest payments every 6 months. All right, the current yield. Current yield is an important feature for bonds. Essentially, the current yield would be on a bond. Yield is the expected return for the investor. So the current yield before a bond can be calculated, the equation is the annual income, annual interest payment you receive divided by the bond's current market price. The current market price, the secondary market price, fluctuate on the bond. So that number, that denominator can change. The annual income is always going to be the same. It's the nominal yield stated on a fixed percentage that's stated on the bond every year. So for example, a bond buys one bond, 30 years GE electric bond with a 5% coupon payment. if similar market interest rates rise to 8%, the value of the bond will go down, right? Interest rates up, prices drop. Inverse relationship between price and interest rates. So in this case, it's representing 700. That's a hypothetical. It's dropped below the par value. So the current yield in this case would be the $50 coupon payment, 5% of 1,000, divided by the new market price of 700, 7.14%. 50 divided by 700, 7.14. I would remember how to calculate current yield for the exam. Write it out, the formula. Current yield equals div divided by current market price, or current yield equals annual interest divided by current market price. Calculating the current yield helps you figure out the correct answer choice to other questions if they asked about nominal, or if they ask about yield to call or yield to maturity. Bond relationships, right? So we've already talked about the relationship between interest rates and bond prices. They have an inverse relationship. Interest rates and price are inverse. So when price goes up, interest rates go down, and when price goes down, interest rates go up. The bond's market price goes down. When interest rates go down, the bond's interest rate or the bond's price goes up. So bond yields, interest rate and bond yields. Well, there is a direct relationship between interest rates and bond yields. What does that mean? That means when interest rates go down, the bond's yield also goes down. All right. To think about why this would be the case, remember that current yield equation. The current yield equation, the annual interest received divided by current market price. So when interest rates go down, when interest rates fall, the bond's market price goes up. Okay, so when the bond's market price goes up, its current yield is going to go down. The yield to call is going to go down. And the yield to maturity is going to go down. Right? The annual interest divided by the current market price. When the interest rate goes down, the market price goes up. So remember, the denominator goes up, the yield goes down. So interest rates go down. Conversely, when interest rates go up, market prices of bonds go down. So now when the interest rate has gone up, the market price in that current yield equation has gone down. So that means the current yield is going to go up. Interest rates up, yields go up. So there's a direct relationship between interest rates and yields, and there's an inverse relationship between interest rates and prices. So when interest rates go up, bond prices go down. Now, market risk is the risk of value of anything going down. Anything in the market, trading in the market goes down in value. So what bonds are more volatile in price? Meaning which types of bonds would see their market prices shift more with changes in interest rates. So longer term bonds are more volatile than short term bonds, meaning when interest rates rise, the market price of a long term bond is going to drop more than the market price of a short term bond. And also lower coupon bonds are more volatile than higher coupon bonds. So on the test, you're kind of looking for long and low volatility, right? The coupon rate is lower, usually its market price will fluctuate more with interest rates movements than a bond with a higher coupon rate. So long and lower ego, more volatility that you have. So buying a 30-year zero coupon bond has a lot of market risk for volatility, right? You're not receiving anything. It's a zero coupon bond. It's without an interest payment. You got to be long term, 30-year period, and there's no interest payments. So low interest payments, no interest payments, right? Each market price would fluctuate more than just about any other type of bond with a shift in interest rates. All right, let's look at different types of yields for bonds, yield measures. The nominal yield, that's the stated yield. It's the same thing as coupon percentage. Annual percentage for turn, stated on bonds face that never changes. 5% coupon rate on a $1,000 par bond pays $50, right? So the current yield that we already looked at, the annual percentage divided by the current market price, annual interest received divided by current market price. Now when a bond is a discount bond, meaning that its market price is trading lower than its par value, the current yield is going to be higher than the nominal yield. If it's a premium bond, meaning its market price is higher than its par value, the current yield is going to be lower than the nominal yield. So again, discount bond, trading below par value, market value is lower than par value, $800, the current yield is higher than nominal yield. The premium bond is higher than the par value, current yield is going to be lower than the nominal yield. Yield to maturity, this is the annual percentage return based upon buying the bond at its current market price. So it includes its prorated gains of the bonds bought at a discount annual or prorated loss if it's bought at a loss or discount or bought at a premium. You don't need to know how to calculate yield to maturity, but I try to remember that they're the sensitive into to current yield and yield to maturity, yield to call. Right? I try to remember that premium bonds yield to call is the last one on the teeter-totter. Right? That's all the way on the end of the teeter-totter is when the bond is going to be called by the issuer before the maturity date. It's the same as yield to maturity, but increased at any date if a discount bond is called early, or increases annual loss on premium bonds. Again, you don't need to know how to calculate yield to call, yield to maturity, but you just need to understand the relationship on the teeter-totter between the interest rates and prices. Understand that a discount bond's yield to call is greater than the yield to maturity, and a premium bond is less than the yield to maturity. All right, so this is where the bond seesaw comes in. The bond seesaw is a way to help you keep in mind the relationship of these yield values to each other depending on the type of bond that you have. Par value bonds are easy. Nominal yield is equal to current yield, it's equal to yield to maturity, is equal to yield to call. So if the bond, is when it's first issued, if it's first trading in the secondary market at par value, these things are all equal. Remember, for discount bonds, nominal yield, the coupon rate is the lowest, the next yield to maturity, next yield to call. Premium bonds, it goes in descending order. Current yield's the highest, YTM, and then YTC. The way I suggest that you try to keep these things in mind is by drawing out the teeter-totter. Memorize the order of nominal yield, current yield, yield to maturity, yield to call. There's different, things that people use for this, but I would recommend using the teeter-totter. Now you need to know or remember whether it's ascending order, meaning it goes from nominal yield to lowest, or descending order, meaning it goes from nominal yield to highest and yield to call at the lowest. The way that I remember that is I remember that current yield equation, annual interest received divided by current market price. When you got a discount bond, what's happening to the market price of the denominator? It's going down. Annual interest received is the same, so the number of the denominator goes down, the current yield goes up. So for a discount bond, we got current yield going upward. We got our seesaw pointing upward. Premium bond is the opposite. That annual interest received is still going to stay the same. When a premium bond is when it's selling for higher than its par value. So remember that denominator goes down, the numerator stays the same, then the denominator goes up with the premium bond. Now the current yield is going to go down. So you have your seesaw pointed downward because price went up. So using that current yield equation, that gives you the answer sets. So where does this come in on the exam? You have questions that say the following. ABC $100 or $1,000 par value bond is trading at $900. It's got a 5% nominal yield. Which of the following could be true? So we know that's a discount bond. Par value is 1,000, is trading at 900, so price went down. The coupon rate is 5%. So if you had an answer choice that said the current yield is 4%, that couldn't be true, right? Because for a discount bond, the current yield has to be higher than the nominal yield. However, if one of the answer choices said the yield to maturity is 7%, that could be true because the yield to maturity would be higher than the nominal yield for a discount bond. So that's an example of using the process of elimination, using the bond seesaw on an exam type question. All right, let's look at types of corporate bonds. Corporate bonds are bonds that are issued by corporations and sold to investors. So the general types are secured versus unsecured. A secured bond is one that's backed by a specific asset of a company. So that means that the company otherwise cannot pay interest and principal on the bond. The investor just gets the asset. Usually what happens is the company will sell the assets off and give the money from the sale to the investors who they owe money to. So a few different types of secured bonds. Equipment trust certificates, basically backed by some type of equipment like planes. You could at least sell the nuts and bolts for something used by transportation companies. A mortgage bond is backed by real estate, actual mortgages, and a collateral trust certificate is backed by stocks or securities that are held by that company. So in each of these cases, the company can't otherwise pay the interest and principal. It would sell off the asset, take the money, and take the money to pay off bondholders, creditors. An unsecured bond is one that's not backed by assets, backed by the full faith and credit of the company. And a debenture is simply a corporate bond, secured corporate bond. A guaranteed bond is one that has to pay the minimum interest payment guaranteed by a parent company, kind of like a cosigner. Like if you ever bought your first house, you parents co-sign on your first house. An income class adjustment bond, basically a company that are being restructured. They're regular bonds that can't make payments on, so they reissue them as income adjustment bonds. They would only pay, in this case, the interest and principal if the corporation is profitable. So the agreement is that the investors will buy them, but you may not receive interest payments. You'll only get those interest payments if the corporation is profitable. So these are risky investments not suitable for most retail investors. So an investor, John Jones, has an investment objective. Which would you recommend to him? An income bond, a mortgage bond? Because he might get the income payments. Which bonds in this case? With just about all other types of bonds, he's supposed to get those regular semi-annual interest payments. So you would be least likely to recommend the income adjustment bonds to someone looking to receive regular interest. So zero coupon bonds. This is a bond that doesn't make any interest payments. Instead, with a zero coupon bond, how do you make money? Well, they're usually issued at a steep discount in the primary market. There's no interest payments, but essentially you buy them at a discount. The par value might be $1,000. You might buy the zero coupon bond for $400. When it matures, you receive $1,000. Now, you still do have to pay income amount. The IRS basically treats that discount as interest that you receive on the bond. So every year you have to pay some percentage of that or some amount of that discount. You're paying tax on interest you're not actually receiving. They call that straight amortization upward called accretion. So say you had a $600 discount and it was 10 years to maturity, you would have to pay a tax on $60 per year on that bond. Now every year the cost basis on that bond is accreted by the beta interest amount. So every year you would add $60 to the cost basis. So if you bought it for $400, every year you would accrete $60 to the cost basis. And by the time the bond reaches maturity, the cost basis would be the same as the par value. So you wouldn't have to pay capital gains tax in that case. Capital gains is basically proceeds minus your basis, and your basis would be the same as your proceeds, the premium or the principal that you received. So you're basically paying tax along the way in this case. Every year you're paying some amount of tax on that phantom income, that maturity that you're adjusting the cost basis upward, so that the time the bond reaches maturity, you won't have any capital gains tax to pay because you've already paid all your taxes during the lifetime of the bond. So they pay at a par value at maturity. Convertible bonds. So convertible bonds are basically a bond that can be converted into a fixed number of shares of common stock of a company. The conversion price is set when the bond is issued. You can take that conversion price and help find the conversion ratio. You take the par value of the bond and divide it by the conversion price, and the conversion ratio is going to tell you how many shares of convertible stock how many shares you can get for each bond. Now, parity price, something else that might come up on a bond, is the number of shares of common stock you get with the conversion times the market price of the common stock. What that tells you, it gives you a value, and then if the bond is trading at the same value equal to, it is trading at parity. That means that each market price is the exact same as the market price of the shares of common stock that you would get if you made the conversion. So an ABC convertible bond is trading at 98. Its conversion ratio 980. Its conversion ratio is 10. ABC common is trading at 90 a share. So 10 shares times $98 a share is $980. So that convertible bond would be trading at parity. It would be trading at the exact same price as the shares of stock are worth. So now, when you try to determine whether it would be profitable to convert your bond to common stock, you basically look at the market price of the bond and the market price of the stock and the conversion ratio. The conversion ratio times the market price of the stock gives you a number that's greater than the market price of the bond. And the bond in that case would be trading at a price that's below its parity price. It would be profitable to convert. You would take your bond and convert it into common stock that it would be worth more money than the bond is currently paying, right? So let's now shift our focus away from bonds and into government bonds. What are they? These are bonds issued by the government, Treasury. Treasury bonds issued and backed by the U.S. government. The U.S. government has never defaulted on the loan. They come with no credit risk. This is the risk that the issuer is not going to be able to make interest payments. AAA is the highest interest rating that companies are going to be able to make their interest payments for sure. They're very, very safe. They are also very low risk. They're very frequently traded. They're the most actively traded market of any bonds market in the world. So you buy them, you make an investment, it's easy to trade them. So now, they usually come with lower interest rates than corporate bonds sometimes, and also sometimes municipal bonds. It's a lower return than those bonds, but they are very, very safe. Let's look at some specific types of government bonds here. T-bills, T-notes, and T-bonds. These come one after another in length. Typically, T-bill is a bond. It's a short-term debt instrument maturing in 1 year or less, right? So it's short-term. The maximum maturity is 1 year. They come in different increments: 4 weeks, 13 weeks, 26 weeks, 52 weeks. They're issued at a discount. They mature at their par value, so they're a zero coupon instrument. So an example, an investor buys 6 3-month T-bills, $20, or at 60, or at 6 times the face value, right? Par value. T-notes are longer term debt instruments. They have a maturity of between 2 and 10 years, 2, 3, 5, 7, and 10 increments. They are issued at par value, and they come with a fixed coupon rate with interest payments made semi-annually. T-bonds come with three varieties: 10, 20, and 30-year periods. The 30-year is called the long hold bond. Sometimes they're issued sometimes with a fixed coupon rate as well, and they make semi-annual interest payments. So T-notes and T-bonds make semi-annual interest payments. T-bills do not. You buy T-bills at a discount. They may mature at their par value. Okay, tips. Treasury inflation protection securities. They're another type of Treasury security. They stand for Treasury Inflation Protection Securities. The idea behind these are debt instruments that are protected against inflation rising. Usually with a debt instrument, it comes with a fixed coupon payment. You have inflation risk. The risk that you're going to receive some amount of money and your money is not going to go as far. TIPS remove that risk because of how they operate. So what happens with one of these? It's the principal, the par value, is adjusted according to the inflation rate as measured by the CPI, the Consumer Price Index. So at maturity, the investor is going to receive either the inflation adjusted principal, provided that the CPI went up during the life of the bond, or the original principal, whichever is greater. The only case in which the original principal would be greater than the original adjusted principal is if deflation took hold while the period the bond was issued. So they have to get the higher rate, so either the adjusted inflation or the adjusted principal. In addition to that, they come with a fixed semi-annual interest rate. But the interest payment is going to fluctuate based on the bond's par value of that principal. The par value of the principal goes up when inflation goes up. So then the coupon payment amount would also go up, right? So even though you got a fixed rate, so you got a 5% rate, if the principal goes up, now you're multiplying a larger number by 5% than you were before, so the payment, the monetary payment, would be higher. Now the principal is adjusted daily. The amount that matters is where the principal is when it's time for a coupon payment to be made. So the idea here is that they offer inflation protection. If inflation goes up, the amount you receive related to the bond also is going to go up. The interest here is state and local taxes. It's actually true of any Treasury security. All interest from Treasury bonds is free from state and local taxes. Not federal taxes, though. You still pay federal taxes on the interest received from a Treasury bond. You don't pay state and local taxes. All right, the last instrument here that's associated with Treasury securities is STRIPS. STRIPS stands for the Separate Trading of Registered Interest and Principal Securities. So the basic idea behind STRIPS is you have a long-term zero coupon bond that consists of payments between U.S. Treasuries. The basic idea here is that a private issuer, a bank or a corporate dealer, would buy a long-term U.S. Treasury security, either a T-note or a T-bond that's long-term, and take each of the payments due on that security, strip them, and sell them separately to investors. They sell them at a deep discount. They're zero coupon instruments. So for instance, a broker-dealer bought the bond. XYZ brokerage purchased a 10-year bond with a $20 face value with a 10% annual coupon. It then strips the 20 future coupon payments in the future for the bond and sells each of those separately to investors at a deep discount. So the later interest payments will be allowed to be purchased at a deep discount, and the interest payments are going to be made first. So those interest payments going to be made in 9 and 10 years would be sold at a deeper discount than the ones that are due in 6 months or 1 year. So an investor purchased the first interest payments might be $950, while an investor who purchases the latest interest payments might pay $400. So that goes along with some of the points here, the increase in value each year until they reach face value at maturity. And the deepest discounts ones, the long term, take the longest term to reach maturity. So because they're issued zero coupon, they're still subject to the phantom interest. The phantom interest, you're paying interest, a tax on interest, you're not actually receiving the annual amount. You'd have to pay taxes on associated with strips. All right, let's now look at government agencies, housing bonds, Ginnie Mae, Fannie Mae, and Freddie Mac. These are agencies that basically buy and pool mortgages and pool them together and sell them to investors. Right. This is the idea of securitization. They make a security out of a cash flow, the interest payments on the mortgage, the principal payments on the mortgage, and then they pass that money through investors. Now, investors buy these bonds in minimum increments of $25,000. So when you buy one of these bonds, you're basically buying interest in a pool of mortgages. You receive access to some of the percentages of payments related to those mortgages. So why would somebody purchase these? Well, they're relatively safe. They're relatively safe. They are backed by the explicit backing of the federal government. And then you get regular income. They make monthly payments because people pay their mortgages monthly. They're based upon the return of the mortgage and principal, or the interest and principal, part interest, part principal. They're also backed by the U.S. government. It's AAA, AA rated with no credit risk, right? They apply to the backing of the federal government, so they're also very highly rated and have very low to no credit risk that the issuer is going to make the payments on the bonds. All right, there is a problem with these, and that is you don't know when you're going to get your principal back because the payments you get are based upon interest payments on the underlying mortgages, and this is where prepayment risk and extension risk come into play. Prepayment risk is that the mortgage holder gets paid off early, right? They get their principal back, they pay the home off early, your interest payment stock. This doesn't sound like a risk on the surface, right? They're getting your money back earlier than you expected, right? Why is that a risk? Well, usually that happens when interest rates go down. People refinance their mortgages and pay off their mortgages early when interest rates go down. So now you've gotten your principal back. You've got that money from the bond, you want to invest it, but now you're investing in other bonds where interest rates are low, so you're probably buying bonds with lower interest rates. So that's the problem with prepayment risk, right? You get that money invested and you want to invest it into new bonds, you're probably going to be investing it into bonds that has lower interest rate risk or lower interest rates. Extension risk, on the other hand, is the risk that the mortgage holder takes longer than expected to take their mortgages. That typically means that interest rates are high, right? So you'd like to get your money back when interest rates are high because then you can reinvest it in new bonds in a current higher market rate and be receiving a higher rate, right? But with extension risk, you're not getting your interest back early, so you're not getting that money back just yet. Now let's look at municipal bond. What is a municipal bond? It is a bond that is issued by a state, county, district, political subdivision, agency within in this case. They're issued at par value, typically $5,000, with a fixed coupon rate, paid semi-annually. A big benefit of a municipal bond is they're issued with interest, with a couple exceptions. The interest is exempt from federal taxes, so people in retired tax brackets. They can also be free from state and local taxes as well. If the investor lives in the state in which the bond is issued, they will not have to pay state and local taxes on the interest payments. And if they live in the locality, like the municipality in which the bond is issued, they would also not have to pay local tax. So you might see them referred to as tipple tax fee bonds because you might not have to pay any taxes on the interest, federal, state, or local tax. And that could be a huge benefit to investors, especially high income tax bracket investors. Concerns, though, is the lower yields. Because they come with those tax benefits, municipalities can get away with paying a lower interest rate. Someone in a lower tax bracket usually is better off buying a corporate bond. Corporate bonds come with higher interest rates. Someone in a higher tax bracket may benefit from a muni. So think about it this way. The corporate bond has a 6% interest rate and a muni has a 4% interest rate. An investor who pays a high level of tax, say they pay 32% federal tax, 8% state tax, and 4% local tax, they're having a lot of money taken out of their interest payments from their corporate bond because they're paying all of those taxes with the corporate bond. If you buy a municipal bond, you're not going to pay the federal tax, and you'll potentially won't have to pay the state and local either, so that at the end of the day, they could take home more money, that 4% municipal bond, than they could with their 6%, because they're not going to end up paying any taxes. People in a lower tax bracket, usually that's not the case. Another concern with a muni bond is secondary market. There is a secondary market, but it's not very active. They're often hard to sell at a higher price. So specific types of muni bonds, there's two major types. GO, general obligation bonds, and revenue bonds. GO bonds are used to build schools, parks, and for general basic overall improvement of the municipality, they are backed by the full faith and credit of the municipality, including the taxation ability. In order for a municipal bond to be issued, a referendum has to be put in order, and part of that referendum says that if you approve this bond issue, you are agreeing to pay a higher tax. The people of the municipality are assessed the taxes to pay for it. It's usually lower property tax, but it can be sales tax, excise tax. In order for the bond issue to go forward, first the voters have to approve of it. Now, if it does go forward and it is approved, now the municipality has the ability to raise taxes on its residents, and they are required to raise those taxes if it's necessary to make the bond payments. For that reason, they're considered the safest type of municipal bond, right? If you want to live in the municipality and there's a higher property tax related to the GO bond, the municipality will raise your property tax if they need to. And if you want to keep living there and not get in trouble, you have to pay that property tax, the money to pay bondholders. A revenue bond is the second type. These are riskier. Revenue bonds are used to fund things like roads, bridges, water, sewage facilities. They're backed by the revenues raised by the project. So tolls, user fees from the project, no voter approval required, because there's no taxation authority to go along with those bonds. So for instance, a municipality might issue a bond and use the proceeds to build a toll road, and now the toll is collected on that road. The money from that is used to make interest and principal payments to bondholders. Okay, revenue bonds are riskier because they don't come with that taxation authority. Let's look at bond comparisons. Corporate bonds, they offer the highest yields, highest interest payments. These are bonds suitable for people in higher tax brackets. Government bonds provide safety and liquidity, usually like a slightly lower return, but they do provide safety and liquidity. They offer the GO bonds offer those regular monthly payments, and typically they're relatively safe and they're good for people who want income. Ginnie Mae and Fannie Mae's, they make regular monthly payments. Let's look at money market securities. These are basically short-term debt. Everything we looked at so far with bonds has been, 7-year maturity periods. They're short year, 1 year or less, maximum maturity of 1 year or less, right? So primary examples are commercial paper issued by big-time issuers or banks, short-term debt, corporate debt to cover short-term needs. They're issued by banks and corporations, mature at par value, issued at a discount, maximum maturity at 270 days or less. Most money market securities are typically pretty reliable, low-risky investments. T-bills, we already talked about short-term government debt. The maximum maturity is 1 year or less. BAs, bankers' acceptances, these are short-term debt used by importers and exporters. It's a promise that the bank will give a certain amount of money on the date. Sometimes importers and exporters use them to gain confidence overseas. If a company overseas, importer knows they're going to be paid by the U.S. bank, which they would be with a banker's acceptance, they're more likely to accept the terms of the deal. Repo, repurchase agreements. These are overnight loans, unsecured loans between banks, directly between institutions or the Federal Reserve. Basically, a repo promises that when it's going to buy the security, it's going to sell it back at a designated price short term. So why would you recommend money market instruments? They're very liquid, they're short term, they're very safe. And when interest rates rise, the rates or the market rate associated with these things typically will go up as well. Okay, bond risks. We already mentioned a couple of risks earlier. in the previous chapter: interest rates, purchasing power, inflation risk. But there's some other risk: default risk, credit risk. This is the risk that the issuer may default on the loan. If they default on the loan, that means they're not making payments. The bond rating agency, Moody's and Fitch, all rate the bonds for risk of default. AAA is the highest rating, that's the best, least likely to default. Treasury bonds are seen at low credit risk. Call risk is the risk that interest rates drop. Call the bonds will be called. When that happens, the investor will get their par value, but won't be able to reinvest it at perhaps the same rate. They're going to have to reinvest their money, and it's probably not going to be as good of a rate as good of a rate as the first rate, because interest rates dropped. When interest rates fall, expect to call. They drop, they can't reinvest it. If you want to keep investing in bonds, you're probably going to have to buy a bond with a lower rate than what you just turned in. Reinvestment risk. This is the risk that future bonds are going to be reinvested. They have the intent to reinvest those future interest payments and whatever the current market rates are at the time, but you don't know what the market rate's going to be in the future. So zero coupon bonds like Treasury strips have no reinvestment risk because there's no interest payments during the life of the bond for maturity, right? So for example, Barry holds several bonds at a 4% interest rates with 10 years to maturity. He plans on investing into the coupon payments for his bonds to purchase newly issued bonds. So if interest rates have dropped to 3%, his coupon payments will be used at that time to buy bonds with a significantly lower interest rate than what he currently holds. So let's now look at a valuation metric when it comes to bonds, when it comes to cash flow method, aka the present value method. So this is what we're doing here. You're basically taking your future cash flows and discounting them to the present value based upon the market interest rate, based upon current market interest rates. So why would you use this? Basically to come up with a theoretical value of the bond. The formula here is present value equals future cash flows divided by 1 plus the discount rate, raised to the number of periods of time, so the number of years until you get that. So basically what you're looking at here is you're taking those expected future cash flows, you're discounting them based on current interest rates, and it's telling you what the present value of the bond should be. All right, so for instance, you want a 3-year IBM zero coupon bond, and the only cash you're going to get is at par value maturity. Similar bonds in the market are going to yield 5%, so that's like the current market interest rate. So using the discounted cash flows is going to give you present value. You take that future cash amount, the par value at 1,000, assuming $1,000 par value, divided by 1 plus the discount rate, raise the number to period of time. So you're basically taking that $1,000 while dividing it by that 1.053 times, or 5 times 1.05 is 1.157. We use that denominator, you get $864.30. That's the theoretical value of this particular bond. All right, what you do with that is you take that theoretical value and compare it to what the market rate is. If the market rate it's selling for is lower than the theoretical value, then it's a good investment. That's the present value calculation. Okay, let's now look at liquidation. So we're going to talk about here is the priority of claims in liquidation. If liquidation and a company goes bankrupt, it's forced to liquidate. Who are the people with claims, and in what order are they to be paid? So secured bondholders are paid first. They have those assets that backed by bonds. Those assets are going to be sold bonds. They're used to make the payments to those secured creditors. Next in line are wages and taxes. So wages to employees up to a certain amount, taxes due to the IRS. Now we get to general creditors, unsecured bondholders, like those debenture holders. The subordinated debt, also creditors who are behind debenture holders in line. And then we get to equities, so preferred stock and common stock. So preferred, in the case the issuing company liquidates, is ahead of common stockholders in order of priority to claim. Common stockholders have what's known as residual right. They're paid with whatever money is left over. Preferred stock would be based upon the company's par value on their shares. So again, secured bondholders, unsecured, or wages and taxes, unsecured. This is where your debentures come in. Subordinated debt holders, preferred stock, and then common stock. That's the order in which claims upon issuing companies would be paid. Let's look at investment companies and life insurance products. Investment companies are regulated by the Investment Company of 1940. That piece of legislation names 3 types of investment companies: face amount certificates, which are not covered very much on the exam, unit investment trusts, and management companies. So the two major types of companies are management companies and unit investment trusts. Face amount certificate companies are kind of an outdated investment company, and there's not really a lot of them around anymore. Recommend investment companies to clients? Well, there's a few reasons why we recommend these. Typically buying into investment companies, buying shares in investment companies because of the low minimum cost. So they're available to most investors. There's something most investors can access. When you buy shares of an investment company, you buy shares of ownership in a portfolio of securities, meaning they provide diversification. You're not just buying one share, one stock that represents ownership in one company. You're broadly diversified in a package of securities that represents ownership in a bunch of different companies. So there's dozens or hundreds of stocks and bonds within the package of securities. And then professional selection. Investment companies have a portfolio manager or investment advisor that is deciding what to buy or sell within the fund. And so that's professional selection goes along with that. So you get, professional selection, ease of ownership, and diversification. Let's start off by looking at management companies. Management companies are one of the three types of investment companies defined under the Investment Company Act of 1940. There's two types of management companies, an open-end management company or an open-end fund, and a closed-end fund or a closed-end management company. Let's first look at open-end management companies. So open-end management companies, the most prominent type is a mutual fund, and that's the one that you're most likely to see lots of questions or several questions on the exam. So what is a mutual fund? A mutual fund is an investment company that continuously raises money for clients and issues new shares of securities. Think of continuously issuing shares. A mutual fund is an operation. It's selling new shares of ownership to clients. It also redeems those shares from the clients when they want to sell. They don't sell them to someone else. They issue new shares when people buy more shares on an ongoing basis. When somebody buys shares in a mutual fund, they buy the shares directly from the fund. Each new mutual fund share is considered a newly issued security. The fund issues a new, it sells it to you new. You're supposed to get a copy of the mutual fund's prospectus when you buy it because it's considered a primary market offering. The price that you would pay for mutual fund shares is the POP, the public offering price. In this price, it's based on the mutual fund's NAV, which is calculated at the end of the trading day, forward pricing, Eastern each day. So the value of the mutual fund share is going to fluctuate largely dependent upon the value of the securities in the fund minus the expenses of the mutual fund to help determine what the NAV is, and the public offering price is the NIV, or is the public offering price is the NAV plus the sales charge. So how do you liquidate or sell off your mutual fund shares? They're redeemable to the mutual fund, meaning you sell them back to the mutual fund that issued them. They're not tradable or negotiable. You can't trade them to other investors. They're not negotiable. They don't trade in the secondary market. So you buy mutual fund shares from the investment company and you sell them back to the mutual fund company. There's no secondary market for mutual fund shares. They don't trade on exchanges or over the counter. Now the price that you'd receive when you redeem your mutual fund shares is that net asset value that's calculated at the end of the trading day, every day at 4 p.m. NAV plus sales charge, that's the price that you would pay up front for buying it. When there is a sales charge on the mutual fund shares that you're buying, you'd redeem them at the net asset value. Now let's look at the second type, closed-end funds. This is the second type of management company. So what is a closed-end fund? A closed-end fund upfront raises money from investors by selling shares of ownership, and when they hit a certain amount of proceeds that they've received from investors, they close the fund to new investors. So this is a one-time issuance, and then they go on to trade supply and demand. It's kind of like an IPO. Stocks are sold a first time on an IPO. Once the IPO ends, then the issuing company is no longer issuing new shares at that time. Same deal with closed-end fund. They issue shares during the IPO. When they've sold enough shares to raise enough money, they close the offering, and now they no longer issue any new shares. So if you want to sell your shares at that point, you've got to sell them to somebody else. They trade in the secondary market. So that goes along with how you purchase them and who regulates these. You get them up front during that initial offering, or you purchase them on the secondary market on an exchange. For instance, So these are traded on the secondary market. Open-end fund shares are not. Closed-end fund shares are. Very important distinction between them. The price you'd pay when you're buying the closed-end fund shares on the secondary market is the current market price. They also do come with an NAV. It's calculated every day at the end of the trading day. But that is not the price that the closed-end fund is trading at. It's trading at its market price. Now, if the market price is higher than the NAV, it's trading at a premium. If the market price is lower than the NAV, it's trading at a discount. And sometimes by coincidence, the market price is the same as the NAV, but it's usually not. So these are publicly traded funds. They are traded on the secondary market from one investor to another. So how would you liquidate closed-end fund shares? You sell them to somebody else on the secondary market. You do not sell them back to the management company, right? Open-end fund shares, you do sell back to the management company. Closed-end fund shares, you would have to sell to another investor. So because of the fact that you're trading these on the secondary market, they're regulated under the Securities Exchange Act of 1934, the second act governing the secondary market. So remember, C for closed-end fund is C for commissions. When you trade something on the secondary market, the broker-dealer's assistance, you typically pay a commission. So one way to remember the very basics between an open-end fund and a closed-end fund, think of it as the open-end fund, its doors are always open. It sells securities out the front door, sells of ownership out the front door continuously. It buys those securities back continuously. Think of it in the back door, right? So it's open. The doors are always open. A closed-end fund, they open that front door during the initial offering and sell securities out the front door at that time, and then they close the door. And after that, they're no longer selling securities out the front door. The back door is never opened again. They're never buying shares back from investors. So that's the way to kind of sort of picture this in your mind, the major difference between these types of offerings. New issues, IPOs, open-ends, 33 Act, secondary trading, 34. So here's a comparison of the two of them right here. With an open-end fund, mutual fund being the most prominent example, the number of shares issued is unlimited. These are always issuing new shares. With a closed-end fund, these are publicly traded. There's that one-time issuance. So what price do you purchase them at? With an open-end fund, you are buying at the POP, the NAV plus a front-end sales charge. With a closed-end fund, you're buying them on the secondary market, being in an exchange or whatever the market price is at that time. Charges to investors. Open-end funds come with sales charges, usually front-end sales charge. They can come with a CDSC, sometimes a back-end sales charge, a deferred sales charge. If it's assessed when you sell the shares back, then the sales charge. Right, closed-end funds don't come with sales charge, but you do have to pay a commission to the broker-dealer who's effecting the transaction for you. What about discount to the NAV? Can you purchase at a discount to the NAV, right? They both calculate their NAV on a daily basis. But now we're asking about buying at a discount. An open-end fund, no. With a mutual fund, you cannot buy them at a discount to the NAV. The minimum price you would pay is the NAV. So if it has no sales charge, no front-end sales charge, you would pay the NAV. With a closed-end fund, yes, you could, and oftentimes you do, buy in closed-end funds at a market price that's lower than their NAV. That's buying at a discount. So for example, the NAV of the fund is $10. Could the market price be a discount premium to the NAV? Yes. So for example, you bought it for $9 and the NAV is 10, you'd be buying it at a discount. You bought it at $11 and the NAV is 10, you'd be bought it at a premium to the NAV. What about liquidation? How do you liquidate the shares and at what price? With an open-end mutual fund, you redeem with the fund, you sell them back to the mutual fund at the NAV based upon the closing price. NAV that you get or pay or receive for your shares is the next calculated NAV. It's called forward pricing. With a closed-end fund, whatever the current market price is, you're trading it to another investor at whatever the current market price is. Here's a question. Investor Jones is considering buying an ABC fund. The current NAV of the fund is $20 and the investor can purchase the share currently at $18. So what type of fund must he be buying? A, an open-end management company. B, a closed-end management company. Okay, so he's buying at a discount to the NAV. This has only happened with a closed-end fund. That's only possible with closed-end management company. He's buying it on the secondary market, so the answer here would be B. All right, let's look at some of the entities involved with with funds here. Management company, key players. Some of the cast of characters here. The board of directors is who manages the fund. It's basically the shareholders get to vote for the members of the board of directors. It can either be cumulative or statutory voting. So by rule, under the Investment Company Act of 1940, it leaves 40% of the board members have to be non-interested, meaning the only involvement they have in with the mutual fund is with their presence of the board of directors. At least 40% has to be disinterested. Second key entity here is the registered investment advisor, often called the portfolio manager. So this is basically who manages the investments within the fund. They are appointed and approved on an annual basis. The custodian, this is basically who hold the money within the fund, does the accounting, manages record and dividends, mutual funds, management companies distribute dividends to investors, receives funds, meaning when somebody buys shares, the fund is the custodian, right? They receive that money and then it releases funds from purchase, meaning they pass it along to the registered investment advisor, who then buys more securities for the portfolio of the securities. The transfer agent, this basically deals with the public, issues new shares to buyers, redeems shares from sellers, distributes income to shareholders, and an important way that these funds function is that taxes and securities often pay dividends, bonds are making those interest payment, and that money is passed along to investors at least once a year. So the transfer agent that's distributing that income to shareholders, they also send out shareholder reports. And the underwriter or sponsor, this is basically who markets and sells the fund either directly to a broker-dealer, through a broker-dealer. Somebody who agrees to buy mutual fund shares, the mutual fund will sell the shares to the underwriter. The underwriter will charge the NRV and will charge the public offering price to the investor. All right, let's look at the diversified fund rule. A fund can either be diversified or non-diversified. In order to be a diversified fund, right, one that comes with a distinct high level of diversification, each of these qualifications must be met. At least 75% of the total assets of the fund need to be invested in securities. No more than 5% of those assets can be in any one company, and no more within the fund, they can own no more than 10% of the maximum shares outstanding of the company. This is called the 75-5-10 test. Let's look at that. 75% of the assets in securities is pretty straightforward. 5%, no more than 5% of the assets in any one company. So say that the ABC Mutual Fund has $1 million invested in securities, and that's more than 75% of the assets. So hypothetically, they held that $1 million in securities. It has 100,000 invested in stock. So that's more than 5% of its assets invested in one company. So that would not be diversified. If it's got 1 million in total invested securities, it can have no more than 50,000 invested in any one company. Same mutual fund. Let's say that they own shares of stock B. Stock B has a total of 1 million outstanding shares, and this mutual fund has 150,000 shares of stock. That's 15% of the total outstanding shares. So again, that would preclude them from being a diversified fund because they have more than 10% of the shares that stock B has issued. Now, if the fund meets all these qualifications, 75% of its assets invested in securities, no more than 5% in one company, no more than 10% of the shares, outstanding shares of a company, then they would be qualified as a diversified fund. A non-diversified fund would be one that does not meet these requirements. Let's look at types of mutual funds. So first you look at equity funds. An equity fund is one that contains equities, equity securities. It contains shares of stock primarily. So what we're going to do here is some real basic stuff with types of funds. A growth fund is one that invests in growth stocks. What are growth stocks? They're stocks issued by non-established, usually relatively new companies whose earnings are expected to grow over the long term. Oftentimes, growth stocks have high PE ratios. There's an expectation that the earnings are going to grow over time and catch up to where the price is. They are not known for paying dividends. If somebody wants to receive income as far as their investment objectives go, a growth fund is not for them. Instead, they are meant for investors who have a goal of capital appreciation and a long-term investment time horizon. Because usually these stocks are going to take years to see their prices grow to the point where they're going to be profitable. So it's more of a long-term attitude. So younger investors who can take risk, growth funds are usually relatively risky types of mutual funds. Number one, because they don't pay any dividends. Number two, because even though there's an expectation that the stocks within the fund are going to grow over time, there's no guarantee. These companies have never shown that they can have high stock prices before, or that their stocks have never hit the level that you hope they're going to be at in the future. So there's some volatility and risk that goes along with that. Second type is a value fund. This is another type of equity fund. A value fund basically invests in companies whose share prices are down but also pay dividends. So oftentimes the stocks in the value funds are from established companies for a reason whatever reason their share prices have dropped recently. So the expectation, the portfolio manager who looks at the stock does some fundamental analysis and determines that there is a good expectation that the market price is going to grow in the future, because based on the financial funds, they don't really see anything wrong. So they're going to take the chance that the prices will go back up in the future. Now, the stocks within value funds, even though their market prices are down, still oftentimes they're paying dividends. So there are dividend expectations that go along with value fund stocks. So who would buy value fund stocks? Somebody who hopes for relatively short-term value appreciation. Pardon me. They're typically long-term, short-term capital appreciation and income. These stocks within value funds are oftentimes still paying dividends. All right, so now let's look at income funds. An income fund is one that makes regular income payments. Now, the emphasis here is on bonds, because bonds, right, make those regular interest payments. I will also say that it is possible to have an equity income fund as well. Equity income fund would be one that contains stocks from companies that are known to pay dividends. But bond funds are always types of income funds, because bonds are always making interest payments. So the focus here is on bond types and income funds. So like a U.S. government bond fund, treasury bond fund, a municipal bond fund would be good for somebody seeking income, but is in a high tax bracket, right? Because usually munis pay lower interest rates, but you don't have to pay federal taxes are beneficial, for somebody who's in a high tax bracket. Somebody who's in a lower tax bracket probably better off with the corporate bond. That's the next type here, a corporate bond fund. Money market funds, right? So money market funds invest in short-term debt, things like commercial paper, repurchase agreement, and other types of short-term debt instruments. Money market funds is one of the safest, if not the safest, type of mutual fund, money market mutual funds. Their NAV is pretty much usually set to stay at the same level, $1 per share. That means you're not really getting any capital appreciation, but there's not really any capital loss potential. That's what makes a money market fund, is on these relatively small dividend payments from the fund. The fund is based on the securities within the fund. They're very safe, very secure. Other funds, a balance fund. A balance fund is a fund that contains some stocks and some bonds. They balance out. The stocks are there for growth, capital appreciation, and the bonds are there for income payments. A sector fund is one that has all of its investments in the same economic sector. Sector funds, drawbacks of these is that they are not as diversified as other types of mutual funds, right? We said that one of the benefits of owning shares of a mutual fund is you get diversification, ease of ownership when you package the securities. Sector funds, you still have ownership in a bunch of securities, but they're all from the same sector. So if that sector is down, then it's likely the value of your portfolio is going to be down. However, if the sector is up, your gains are going to be multiplied. All right, so sector funds, even though they're riskier, they do come with the potential for more gains. An index fund is another common type of mutual fund. The investments within one of these funds, they're usually equity funds. They are sometimes bond income funds, but they're most commonly equity funds. But the investments are set up for to track an index, like the S&P 500 index, the Russell 2000 index. The portfolio manager, fronts out a bunch of stocks that they think are going to track that index. So if the stocks go up by a certain amount, then the fund is expected to go up with it. These are passively managed funds. The investments are selected up front, and then they typically don't change. The investments within the funds have lower expenses go along with that, so a lot of buying and selling within the fund. So again, the idea here with an index fund is that the stocks are selected, or sometimes bonds do this, to track a market index. And usually an index fund provides a steady growth over the long term. It's not like the most dynamic type of growth investment. Usually they do provide pretty reliable, steady growth over the long term, but they're good for investors who are not the highest risk investor, maybe somebody who's willing to take on moderate to low risk, looking for some level of capital appreciation and income. All right, let's look at some other ideas here that relates to mutual funds. Fees, 12b-1 fees, they're a big part of investing. We already talked a little bit about sales charges, but there are other fees that go along with having fund shares. The big one is the 12b-1 fee. A 12b-1 fee is a fee that's charged for marketing and distribution, right? It's charged annually to investors, deducted out the NAV, and when it's collected, it goes to cover marketing and distribution expenses, sometimes salaries of employees who work for the fund, right? So are there rules associated with 12b-1 fees and how high they can be? The maximum allowable 12b-1 fee is 0.75% of net assets per year, which is very low. The other qualification here is for a fund with called a no-load fund. You might hear the term no-load mutual fund. Its maximum 12b-1 fee is 0.25% of assets. If it's higher than 0.25%, then the fund cannot call itself a no-load fund. A no-load fund is basically one would come with no sales charges, and it also has to have an NAV that's lower than 0.25% of the assets. All right, let's look at classes of fund shares. So there are three basic classes of mutual fund shares that can be sold to investors that you should know the basics of these types of funds for the test. A, B, and C shares. It's kind of like the alphabet here. So Class A shares, these come with a front-end sales charge. Okay, so that means the investor does the NAV plus the sales charge, right? So the maximum allowable sales charge is 8.5% allowed by FINRA. In order to charge the maximum allowable by law 8.5% sales charge, the mutual fund has to offer some specific benefits to the investor, breakpoints and rights of accumulation, and a letter of intent. We'll deal with each of those things in a minute. But 8.5% is the maximum allowable. Class A shares can come with 12b-1 fees. When they do, they are lower than 12b-1 fees for other types of shares. So Class A shares are suitable for a large investor who can meet breakpoints and hold the shares for a long term. A breakpoint is the minimum amount that if you invest that amount or higher, you get a lower sales charge. Usually they're set in the tens of thousands of dollars. So to reach that first breakpoint, normally you have to have quite a bit of money in the fund. That's why they're suitable for larger investors. Class B shares, they do not have a front-end sales charge. The only time mutual fund shares have a type that have front-end is A. A is the first letter of the alphabet. They have a front-end sales charge. B's do not have a front-end sales charge. Instead, they have a back-end sales charge, often called a CSC, a contingent deferred sales charge. It's a charge that you pay when you redeem the shares, when you sell them back to the issuer. So when you sell them back, you would have the NAV minus the contingent deferred sales charge. Now, Class B shares usually have 12b-1 fees that are higher than Class A shares. But if you hold on to your B shares long enough, they can convert to A shares. And if they convert to A shares, they're going to have the 12b-1 fees that go along with A shares, and then they're not going to have a back-end sales charge. So if you have the back-end shares for long enough, you won't pay a front-end sales charge or a back-end sales charge because they've decreased to zero, right? You're not going to have to pay that back-end. They decrease over years, right? So, year one, it'd be 6%, year two, 5%, 4, 3, 2, 1, all the way up, right? So, these people hold the shares for a longer time over a period of time. C shares, the last one. These also do not have a front-end sales charge, but they do have the highest 12b1 fee. They might be subject to a back-end sales charge sometimes, some are, some aren't, but even when they are, it's usually not very high. It's not very high of a percent of the value of the shares. If you hold them for over a year, it goes away completely. The back-end sales charge goes away if you hold it for a year. You don't ever convert them to A shares, though. So the disadvantage of the sales charge is that you can't convert them to A shares in the 12b1 fees are 12b1 fees on the C shares are pretty high, and they're suitable for short-term investors who can't meet breakpoints, because the longer you hold the shares, the more the higher the 12b1 fees become a drag on the performance of the portfolio. So they're for short-term investors. Let's look at sales charges. Remember we said a couple minutes ago, when a mutual fund has a front-end sales charge applies to A shares, the highest maximum sales charge is 8.5%, and they have to offer rights, letter of intent, and breakpoints. If they're going to charge 8.5%, they have to offer those three things: rights, letter of intent, breakpoints. So they can offer that high 8.5% sales charge as long as they offer all three of these, and to reduce that front-end sales charge. And that's a FINRA rule, by the way. So I know you're taking an NASAA exam, but that's something you should know. It's a FINRA rule. 8.5%. In order to offer that high sales charge, they have to offer these three things. We'll talk about what these three things are: breakpoint, letter of intent, and rights of accumulation. So breakpoint, what's a breakpoint? A breakpoint is a dollar amount at which you would get a lower sales charge. So the sales charge is reduced. So mutual funds have breakpoint schedules, and it will show the investor, you have X amount invested, you would get a reduction in your sales charge. So let's say, for instance, that ABC mutual fund, your standard front-end sales charge is 6%. However, if an investor has $25,000 invested, they get a 5% front-end sales charge. If they have $50,000 invested, they get a 4% front-end sales charge. If they have $75,000 invested, they get a 3% sales charge. It's a decreasing schedule the more they invest, right? So those amounts are breakpoints. 25, 50, 75,000. It's illegal to not tell a client when they're approaching a breakpoint. It encourages the customer to invest more in the fund in order to get a lower sales charge. Breakpoint sale, it's a FINRA violation I just mentioned. It's when a registered rep is selling shares of a mutual fund to a customer. That customer is close to the next breakpoint threshold, and they don't tell them about it in order so they can receive the higher sales charge. Let's say the breakpoint gets in at $25,000, and Joe is investing in the mutual fund, and he's got $24,500 to invest, and you don't tell him that if he doesn't kick an extra $500 in, he would receive the lower sales charge. He would get the breakpoint. That's a breakpoint sale. You've committed a FINRA violation. And that is a FINRA rule. When you get later in this class, we will talk about NASAA rules related to mutual funds communications. So you'll see the NASAA standards that you are supposed to disclose lots of different information to customers at all times when you're discussing mutual funds, buying mutual fund shares with them. But FINRA breakpoint rules is that if the customer is close to a breakpoint and they're going to buy the mutual fund shares, you need to tell them that they're approaching a breakpoint, right? If they invest a little more, they hit the breakpoint. It doesn't mean they have to invest the amount to reach the breakpoint. It just means you have to inform them that if they invest more, they're going to hit the breakpoint. The other two here are reduced sales charge, letter of intent, and rights of accumulation. These are both connected to breakpoints. The letter of intent is basically an agreement that a customer can sign that says, I don't have enough to reach the breakpoint threshold now, but within the next X amount of time, it's usually 13 months, I will have enough of my money into these mutual funds to reach that breakpoint. Letter of intent is only binding on the company, not the customer. It gives the customer the opportunity to deposit the difference between the balance and the breakpoint schedule threshold, and they can immediately start accessing the breakpoint. If they don't hit it, the mutual fund goes in and pulls out the equivalent. If you can actually backdate it, you could first start investing in the mutual fund. You can actually backdate it 90 days and count for the purchase you made at that point to your mutual fund account. Capital appreciation doesn't count for reaching a letter of intent. So what does that mean? Let's use the same hypothetical $25,000 breakpoint. So I invest in the mutual fund. I buy $20,000 worth of a mutual fund share. Now I don't have to put in 25,000. I have to 25,000. It says within the next 13 months, I will have put an additional $5,000 of my own money in here to reach the breakpoint threshold. Now, the value of the shares I bought, say that I don't buy any new shares for the next 6 months, the NAV of the shares that I bought, the net asset value goes up. Because no effort of my own, right? I'm not putting any of my own money in the fund, but the NAV goes up to a point now that I own shares that are worth more than $25,000. I still have not reached the term of my letter of intent. To put the term of my letter of intent, I have to put my own money, the extra $5,000, into the account. This is where capital appreciation doesn't count, because the value of my shares have appreciated from 20,000 to 25,000, not by me purchasing any more shares, just because the value of the securities have gone up, so the NAV has gone up as well. To reach the terms of the letter of intent, to access the breakpoint, I need to put the balance of my own money into fund shares. Rights of accumulation, another way to reduce sales charge, is this goes along with the value of the shares going up and being able to access that breakpoint because the value has gone up. So over time, if the client invests, the sales will become lower amount of money invested when they reach the breakpoints. So rights of accumulation, capital appreciation does count. So say I invest in a mutual fund, I put $22,000 in there, the breakpoint kicks in at $25,000, I don't buy any new shares, and a few months later the capital is appreciated, the value has gone up, and it's risen above $25,000. Now I didn't sign a letter of intent, but by rights of accumulation, now I have shareholder of $25,000, so any subsequent shares that I buy, the breakpoint would kick in at $25,000. So this is a benefit for a smaller investor who doesn't have a ton of money to invest in a mutual fund, and they can't keep buying new mutual fund shares. But if the value of the share grows over time, they will be able to access those breakpoints. Okay, let's look at now another type of other ways you can avoid front-end sales charges. This goes beyond reducing them. This is a way you can actually avoid paying front-end sales charges. Reinvestment of dividends and capital gains. So what are the big benefits of owning shares in a mutual fund? Is that you get these dividend distributions at least once a year, right? And also capital gains are distributed. The portfolio manager is buying and selling securities within the fund. They buy it for one price, sell it for a higher price. That's a capital gain. The money is passed through investors to investors at least once a year. When you receive that money, dividends, capital gains, there are several things you can do with it. You have to decide what you want to do. Number one, you can take it and put it into your bank account or go spend it, buy a new car or something like that, right? That's one thing you could do with it. Or you could like to have those dividends automatically reinvested. So when that happens, instead of it hitting your bank account, your pocket, it just goes into buying more fund shares. So you're getting a $1,000 dividend distribution and you've chosen to reinvest dividends, then you've basically just purchased $1,000 of mutual fund shares. When you automatically reinvest your dividends, which most mutual funds offer this, you'll be able to purchase them at the NAV. So if there was going to be a front-end sales charge, you'd be paying the NAV at that price. If you're reinvesting your dividends. Now, you'd still have to pay taxes, right? If it's dividends, you'd have to pay tax at your ordinary income rate. If it's capital gain amount, capital gain taxes, long-term or short-term, depending on how long you've held the fund, held the shares that result in the capital gain. You'd still have to report that on your tax form. So there aren't any tax benefits that come along with reinvesting dividends. The benefit is that you get to purchase those new shares at the NAV instead of the public offering price. All right, let's now shift our focus to unit investment trusts. So unit investment trusts are another type of investment company under the Investment Company Act of 1940. So they're like a fund, but they don't have active management. They don't have a portfolio manager or investment advisor. So what does that mean? Basically, that means a UIT raises money, shares of beneficial interest, getting packages of securities in the fund. Most UITs are bought in packages of bonds. The shares are redeemable with the trust, or the trust will offer sometimes to buy all the shares back from everybody at the current NAV. There's no secondary market in a unit investment trust shares. You basically are selling them back to the company. So once the company or portfolio within the fund is selected, it's not actively managed. It's set and forget it. It's passive management. They select up front which securities are selected, and then they're not actively buying securities. So there's no management fees. There's no buying and selling in the fund. You have lower costs, lower expense amount ratios for investors. So again, most are bond portfolios, meaning they come with a termination date. Usually it's the day the last day the bond matures, the trust will be dissolved. So what you get with these is diversification. You get a package of bonds, professional selection, because when they're selected up front, they're selected by a securities professional, investment advisor, and monthly income. And then you get bonds within the funds, a bunch of different bonds. There are those interest payments that accumulate when the bonds matures, and the principal payments, and they distribute the monthly income to investors. For somebody seeking regular income, this might be suitable. All right, let's now look at an exchange traded fund, or an ETF. An ETF is technically a type of investment company. It's technically an open-end management company, but it operates more like a closed-end management company. So what does that mean? Well, one thing, you trade them on the secondary market, and that's like a closed-end management company, whatever the current market price is. So basically the way that an ETF operates, it's very similar to an index mutual fund, right? A bunch of investments are selected, and usually anyways, with the most commonly traded ETFs, they're selected to track an index. And so they're passively managed. They select the securities, they set them to track an index, and then investors buy and sell them on the secondary market. So you buy them on an exchange, you charge a commission, just like a closed-end fund, and then they're constantly managed. You select these investments, they track the index. The example with adding Tesla, examples we give in here, even though they're passively managed, there are times when new securities, that are thought to help track that index more reliably are added into the fund. So it's not like there's never anything added. It's just that not that often. So management fees in an ETF are generally very low. If you're not actively buying and selling, that cuts down on the management fees. All right, so let me get at an item that's really not mentioned here too much, but it says, if you're an open-end management company, you operate kind of like a closed-end fund. We kind of already talked about how they operate more like a closed-end fund. They're traded on the secondary market, their current market price, and instead of being redeemed at the NAV. Why are they kind of like an open-end management company, though? It's because even though regular investors buy shares in these things, buy them on the secondary market, and if you want to trade them, you trade them to another investor. You don't redeem them with the fund. There is a case in which new shares can be issued in or sold back to the fund, and that is in the case of creation units. It won't happen here. Is a large institution has a bunch of shares of stock. Some of the shares of stock that track the fund, they own shares in large amounts, and they sometimes will sell those shares to the ETF. In an exchange ETF, you have new ETF units. You sell them to these institutions, and they can either redeem these shares sell them to somebody else, or they can redeem these shares. So the reason the ETF is allowed to create new shares, redeemable shares in these creation units, it is considered an open-end fund, even though in every other way it operates and looks like a closed-end fund. All right, so we just talked about there are traditional ETFs. There are also riskier ETFs, inverse ETFs. Traditional ETFs are typically suitable for retail investors. The fees that we're going to look at here, the inverse ETFs are not. They're pretty complex products and are only suitable for institutional investors. A leveraged ETF is set up to multiply the gains on the index, like a 2x or 3x. 2x is set up to double the gains that the index is returning, 3x to triple the gains of the index. It uses borrowed money to increase the percentage of returns on the index. For example, if you own a 2x on the S&P 500 index, if the S&P 500 rises by 10%, the market value of the index or your portfolio is going to rise by 20%, 2 times the rate of the underlying index. So these are used by short-term investors like day traders. Their values are reset every day. FINRA basically says that you're not supposed to hold them. An inverse ETF basically goes in the opposite direction. the underlying index. So a manager uses short selling futures contracts, you get inverse returns versus the index. For example, if you use an S&P 500 inverse ETF and the S&P 500 drops by 5%, then the inverse ETF would be increased by 5%. These are usually used by bearish investors. They think the market's going to go down. They might invest in these. The value of the ETFs will go up. If the market goes down, okay, let's look at other exchange-traded products. We just talked about ETFs. ETFs are equity funds that pool investments of the underlying securities designated to track an index. Because they are equity investments, they don't come with credit risk. They don't come with market risk. They are equities being traded in the market. If the market goes down, the value of an ETF goes down. They do have market risk. An ETN is a different type of exchange-traded product. An ETN is an exchange-traded note. It's issued by a bank, does not pay interest. So even though it's a debt instrument issued by a bank, it does not pay interest. It's basically set up to track an index, just like an ETF is. Whereas an ETF is an equity product, an ETN is a debt product. It doesn't make regular interest payments. So what would the investor get? It comes with a maturity date, right? So it comes with a maturity date. At maturity, the investor will get the cash value, which is based on the index's performance. So the index's overall performance is going to determine how much the security is worth and how much the investor receives at maturity. Because it's a debt instrument issued by a bank, it does come with credit risk, and it also comes with market risk. So both of these, trading on an exchange and taxes, capital gains, the difference between what you buy it at and what you sell it for, right? So in the case of an ETM, if you hold it to maturity, it's the market price you buy it at, and whatever cash value you receive would be the capital gain that you would have to pay taxes on. Now, if you go down in value, you'd have a capital loss. Assuming it goes up in value, you'd have a capital gain. You'd have to pay. Let's look at REITs, real estate investment trusts. This is another type of, not technically an investment company, but similar in the way it operates. In this chapter, in this segment, we'll look at REITs here. REIT stands for Real Estate Investment Trust, basically a diversified pool of real estate. For example, ownership in malls, commercial buildings, regular real estate, rental properties, typically not single-family homes. They don't generate any income. A REIT will typically generate monthly incomes, sometimes quarterly, but normally monthly payments. It distributes some of the income, the dividends, associated with those real estate investments. So there's two basic types of REITs, equity REITs. This basically has actual properties. So this comes with both growth and income, right? Buy a property at one price, sell it at a higher price. Or if the properties are making rental payments, your rental payments, right? That pass through as income, or mortgage income rates. So basically this is a pool of mortgages. Think of it as a Ginnie Mae or agency bond, right? It gives the investors here who sold the income, the payments of those mortgages, the principal and interest is paid, and that money is passed through to investors. Both equity REITs and mortgage REITs are liquid, tradable on a stock exchange. There are non-tradable listed REITs, and those are not liquid, but most REITs that most investors are buying are listed REITs that trade on exchanges, so they do come with liquidity. You do not share in the loss of deductions of real estate. So REITs, somebody who owns a REITs, they get these regular payments. Their tax bill, right? It's not helping it, right? You pay more taxes because you receive these monthly payments and you don't have any losses related to them that you can deduct, any losses that related real estate that you can deduct for tax purposes. So if you're an investor who's worried about paying less in taxes relating to probably a REIT is not a suitable investment. You're looking for somebody that's looking for regular income payments, though, a REIT would potentially be suitable for that investor. All right, now let's shift our focus to insurance-based products. First, we'll look at annuities. Two basic types of annuities, a fixed annuity and a variable annuity. Let's look at a fixed annuity first. A fixed annuity is an insurance product, but is not a security. The characteristics of a fixed annuity, it comes with a guaranteed fixed rate of return. Hence the word fixed annuities, premiums, the amount that somebody invests into their policy are invested in the insurance company's general account. The general account investment's performance does not affect the payment. The investor, the annuitant who has the plan is supposed to receive their contributed amount plus the designated rate of return. So the the insurance company bears the insurance risk. They take all the risk because they have to pay the investor who's contributed the investment to that stated rate of return. The insurance company also assumes the mortality risk. One of the benefits of an annuity for an annuitant is once you start receiving regular payments from your plan, those payments are supposed to continue for the rest of your life, no matter how long the rest of your life is. So the insurance company takes on the risk that you live longer than expected, and you live to 110, they have to keep paying you that same amount every month for the amount of time that you live. That's mortality risk bared by the insurance company. It's the risk that you live for a long time, they have to make lots of payments. The insurance company also assumes expense risk. Their expenses increase past expected, and the payments will be reduced. The purchaser assumes inflation risk. Anytime you see inflation, you're going to get the same amount of money regardless. Purchasing power risk comes in. When inflation's high, you're going to get that fixed amount of money, and it's not going to go as far. Now let's look at a variable annuity. A variable annuity is a security. Fixed annuity is not. Variable annuity is a security and an insurance product, basically a mutual fund with an insurance wrapper. The variable annuity, they return to the investor the amount that they're going to receive, and the interest rate fluctuates. That's where the word variable comes in. That means there's no guaranteed rate of return on these things. When somebody puts money into their annuity, the variable annuity, the premiums are invested into the insurance company's separate account, which have sub-accounts within them. Within the sub-accounts, you've got mutual fund investments, right? So you'll notice here a variable annuity comes with an investment component. An investor puts money into it, that money goes into the separate account, you're buying shares of an underlying mutual fund. So the performance of the sub-account will help to determine the amount that the annuitant will receive. So the purchaser, the annuitant, bears the investment risk. So if they pick a bunch of lemons as far as their investments within those sub-accounts, then the overall value of their annuity is going to go down. Insurance companies still assumes the mortality expense risk, right? Because once the annuitant starts to see payments, they'll get those payments for the rest of their lives, no matter how long it is. That's mortality risk. And then the same thing with expense risk. There is a lot less inflation purchasing power risk with a variable annuity because the investments within the sub-account can and often do grow along with inflation. So every payment is going to fluctuate depending on the success of those things, whereas a fixed annuity has a fixed amount no matter what. A variable annuity payment can go up with inflation, so it's not as subject to purchasing power risk. All right, other information about a variable annuity, taxation. When you pay premiums, you make payments, contributions into your plan. Those contributions are made with after-tax dollars. There's no tax deduction. What that means is I earned $75,000 this year. I contributed $5,000 to my annuity. This is through a variable and fixed annuities. I contributed $5,000 to my annuity. I still pay taxes on $75,000 of income this year. So I'm still paying taxes on that contributed amount. Now the earnings within the plan are allowed to go tax deferred. You don't pay any tax until you take the money out. If when you take that money out, you take it at a random distribution, you just decide, I need to get the roof replaced on my house. I need to take $20,000 out of my variable annuity. That would be random distribution. It's going to be taxed on a LIFO, last in, first out basis. The earnings are considered to have gone in last. You haven't paid any taxes on the earnings yet. When you take that out, you pay taxes on it. The contributions will come next. You have already paid taxes on the contributions, so when you take that money out, you will not have to pay taxes. So the buildup on earnings will be taxed first, and then the rate of taxation will be the person's ordinary income rate. And the original investment, that contributed amount that you already paid taxes on, won't be taxed when you take it out. So I'll give you an example. So I've got $100,000 in my annuity. $80,000 of that is contributions that I've already paid taxes on. $20,000 is earnings I haven't paid taxes on. Now some major disaster happens, a tree falls through my roof, and I've got to take $30,000 out of my annuity to help cover the cost of repairing my roof. So this is a random distribution. It's going to be taxed on a last in, first out basis. So I'm taking 30,000 out. I've got 20,000 in earnings. That's going to be considered to come out first. The remaining 10,000 is going to be the remaining contribution. So I'd pay tax on the 20% of earnings and ordinary income rates. The 10% of contributions I wouldn't pay taxes on when I take that money out. Now, that's the policy for a random distribution. And test questions are more than likely to ask you about this. But what about if somebody is getting a regular scheduled payment? Once you annuitize the contract, you received a payment from your plan every month. So how is a regularly scheduled payment taxed? So regularly scheduled payment is taxed based on the percentage of earnings and contributions within your account. So the same example I gave you, where 80% of my annuity money is contributions and 20% is earnings, I'm going to get regular monthly payment. I would have to pay taxes on the 20% of the monthly payment. 20% would be considered earning. The remaining 80% I'd not have to pay taxes on. So the random distributions are taxed on LIFO basis. Regularly scheduled distributions after the contracts have been annuitized is basically considered a percentage of contributions, a percentage of earnings are going to help determine how much tax you pay. Somebody takes money out of their annuity before they're 59 and a half, they're typically subject to a 10% penalty, early withdrawal penalty, in addition to the ordinary income tax that they would have to pay. All right, let's look at the different payouts. So somebody annuitizes their contract, right? They've reached retirement age, they decide to annuitize their contract. When they do that, they can pick one of several different sort of payment period types, payment period arrangements. Life annuity is the most basic one. Basically with this, it's the payments will continue until you die. It's a risk for everybody, right? With annuities, the insurance company, the risk that they've done is that you live for a long time. They bear that risk. You live to be 110. They have to keep making these payments to you every month until you're 110 years old, until you die. But you also take on risk because if you die the month after you annuitize your contract, that's it. You get one monthly check and that's it. So with a life annuity, the payment continue until the person dies. The second option you can choose is life annuity with period certain. So this guarantees that a minimum payment period, usually it's 10 years as the period certain, but even if death occurs right after annuitization, so what happens if you live beyond that 10-year period? Well, then it would turn into a life annuity. So for instance, I've got an annuity, I annuitize a contract, and I pick a life with period certain of 10 years. So now 10 years go by, I'm still alive, my annuity will default into a life annuity. That means I don't receive payments for the rest of my life at that point. But I've guaranteed that payments will continue for at least 10 years if I pick annuity with life period certain. Joint with last survivor, this is usually used by a spouse. One spouse died and the payments continue to the remainder of the living spouse's life. Unit refund life annuity. With this one, if the annuitant dies before the investment's been received, the estate will get a refund, right? Because with these other ones, with these other plans, it is possible for the full payment not to be made, right? You've got $1 million within your annuity, and then you start receiving payments. You've got a life annuity, and you die 2 months later. The insurance company gets to keep a whole lot of money because they didn't have to pay out very much of that money. Or with the other ones too, right? At the period certain of 10 years, if you die a couple of years later, it's possible that, usually it's possible you wouldn't have received all the payment by that point. Same with joint and last survivor. You're married to somebody and they die a few months later, then all that money, you won't receive all the money in the annuity. So the one that guarantees that you'll get all the money, some of the money anyways associated with the annuity, you'll get all the money in the annuity, is a unit refund life annuity. All right, so here are some examples. The error is the assumed interest rate that will help determine the amount that each monthly payment is going to be. There's an assumed interest rate, breach of contract, right? If that assumed interest rate, if you bought that, you'd get a higher monthly payment. If they perform below that, you get a lower monthly payment. So it fluctuates. The error is used to determine how much each monthly payment is going to be. So here's hypothetically how this is going to work. So at the start of the investment, the investor had at age 40, they retired at age 65. So their monthly investment was $500 a month. They assumed an interest rate of 5%. So this is basically showing you how the investment will differ. They pick a life annuity. Usually a life annuity comes with the highest monthly payment because you assume that there's going to be fewer total payment periods in a life annuity than with these other ones. A life annuity, so 4,000 hypothetically, life annuity with a 20-year period certain, 3,600 joined by the last survivor. Joint last survivor, we're now spreading it out over a course of payments. The assumption is that it's going to cover a longer period of time between when you and your spouse die, and a unit refund as well. 2,800, you get a little bit less because you get that guarantee. You get that guarantee period over that guaranteed payment because it's going to be paid out. So the illustration here is basically a sub-account growing at the expected rate of return. So the actual payment's going to differ depending on the performance of the benchmark rate. The sub-account does well, returns are higher than the year, then the monthly payment will be higher than it was the previous month. If it deperforms the year, that'll be lower than it was the previous month. Let's look at equity index annuities. This is actually technically a type of fixed index annuity. Fixed annuities gains can vary depending on the performance of an index. Regular fixed annuity, you get that fixed rate of return. With these, the return can fluctuate. So they're basically designed to have a return that tracks the actual rate of return of the index. However, they're subject to participation rate that presets the percentage of up or down index in which the annuitant can participate for just above 0, 100%, 50, 60%, relatively normal with these. So for example, on any policy that's linked to the S&P 500 index, it comes with a participation rate of 50%. The S&P rises by 15%. That means the policy would grow by 7.5. You'd get 50% of that 15% rise in the overall index. So it's a little bit confusing because they are technically a fixed annuity, but their rates of return varies. So it acts kind of like a variable annuity. It's technically a fixed annuity that has elements that would like variable annuity, right? You've got variable different payments depending on that rate of return of that index. Now, in addition to the participation rate, EIAs are also sometimes subject to capped performance, meaning you cannot participate any more than a total percent of gain. For example, 12% being the example here. So if an EIA has a cap, the annuitant cannot receive any amount higher than that cap. So the cap is 12%. ESP goes up 15%. You can't get any more than 12%. That's the highest amount that they can get. Now, an equity index annuity, right? It's a fixed annuity, so it's not a security. They typically come with a rider that guarantees the minimum amount of growth. Even if the index performs poorly, that's a reason that they are considered a fixed annuity, because you get at least that fixed rate of return. Whereas a variable annuity, you don't have any rider that guarantees any specific rate, any minimum rate of return. Now, when we're looking at EIA's performance measures, we're talking about, how much is the investor going to get related to their EIA? How do we measure the index's return? How is that tracked? There are 3 different ways by which the index performance can be measured: the point-to-point method, the high watermark method, and the annual reset method. So the point-to-point method basically compares the contract's ending value to the value that it's purchased on its purchase day. So basically the value at the end of the period is what the person would get applied to their contributions as far as what their rate of growth is going to be. So any value fluctuations between those 2 periods, remember that what that means is in the middle of the time period, the annuity's life, if the value dipped, that wouldn't matter. Just really is where is it at the end compared to where it was at the beginning. High watermark method computes the index value each year over 7 to 10 year contract term, and then use the highest value as the end date value. So the end of year 1, if it was 1, at the end of year 2 it was 3, at the end of year 3 it was 2, at the end of year 4 it was 5, it was, whatever the highest amount is, you take that highest value. So value and fluctuations are relevant because you get the highest value of the contract's life. A drawback to both the point-to-point and high watermark methods: you don't compound the growth every year. You just take the growth at the end, you assess it point to point, where you are at the end, high watermark, it's the high point, and then you would basically take that return percentage and apply it to the contribution amount one time. You don't compound the growth every year. Annual reset method does use compounding growth. So with this one, you compute the index value each year and add the increase in value to the interest earned. So in year one, the index, you're able to participate, put in 5% gains related to the index. You have $100,000 principal. You would now have principal of $105,000. Year two, there's another like 10% gain. You would take 10% of that $105,000. So your compounding interest is growing each year. That high new adjusted principal, the growth rate is going to be applied to that the next year. So that's a benefit of the annual reset method. You get to compound every year, whereas point to point with the high watermark, you just assess the value at the end and apply it to the highest contributed amount. Let's look briefly at life insurance. First off, let's look at fixed life insurance products, and then we'll look at variable life. So fixed life insurance products, three different kinds here. Term life, which is the best type of life insurance, whole life, and then universal life. Whole life and universal life, bad products, but you still have to understand how they work. Term life is basically, if the policyholder dies in term life insurance, the term within the contract of the term, the beneficiary would get the death benefit. The premium increases through the different phases. So if you don't die during the term, you don't get any money back, the beneficiary. Term life insurance is kind of like renting an apartment, right? It's pure insurance. You pay for one thing, you get pure insurance. Once you leave, you don't get any value back. Whole life insurance, most of this is permanent insurance. It doesn't just cover for some designated time period. As long as the premium is made, it comes with a higher premium than term life. They say you're going to fill an investment bucket and an insurance bucket. There's a minimum premium amount and a total premium amount. If you pay above the minimum amount, extra amount is put into the insurance company's general account. It grows at a set rate, kind of like a fixed annuity, but you have to the cash value. It does come with a cash value, grows over time, but you have to pay interest to borrow your own money. It's not a good product. Whole life insurance is not a security. Whole life insurance agents don't have a securities license, so they sell this. If you buy you want to get securities and life insurance separate, term life, and separate your securities, right? Term life's a third of the cost. Go with term life, right? Universal life, they deposit money into the general account, and it offers a fixed rate of return. Flexibility goes along with universal life insurance. You can change the premium amounts and increase the death benefit. The cash value can grow over time. As long as the premium is paid, you can continue the policy. It doesn't come with a fixed designated term, but it is not a security. So none of these are considered securities. Term life, whole life, universal life, none of them are considered securities. Variable life insurance and variable universal life, these are considered securities. Variable life insurance, there's a cash value that grows higher than the death benefit. So basically a variable annuity is like whole life, meaning it grows. There's no term that it ends at, except that the excess premiums are invested in a separate account. With a whole life insurance policies, the whole excess premiums are put in the general account. With a variable annuity is put in the separate account. Within that separate account, you have investments, and the success of those investments will help determine the cash value of the death benefit. Again, as long as the minimum premium amount is paid on the policy remains in effect. What I mean by minimum premium, think about it like when you get a credit card bill, right? With a credit card bill, like here's your total balance this month, and here's the minimum amount. As long as you pay the minimum amount, right, you're fine, right? You don't get penalized or anything. So you pay the minimum amount of your balance. Now, as long as you pay that minimum amount with variable life insurance, the policy continues. If you fail to pay that minimum amount, then it's terminated, the term ends. If you pay over the minimum amount up to a certain threshold, the rest is invested into the separate account. You can borrow some of the money in the account. It would not be a taxable event. It does come with investment options. Variable universal life is basically like term life with a variable annuity. It's flexible. You can vary the payment. You can grow the cash value. You can borrow money, but you have to pay interest to borrow your own money. without paying taxes. It does come with voting rights, and it does come with investment options. Both of these types require the delivery of a prospectus under the Securities Act of 1933 and the Investment Company of 1940, right? So you buy into a variable life insurance, variable universal life. The investor is supposed to be provided with a copy of the prospectus. Derivatives and alternative investments. We're going to look at derivatives, which is options, futures, and forward contracts, and alternative investments. A derivative is an investment which value is derived from the value of something else. For instance, with options contracts, futures, forwards, the contract is tied to some other commodity or security. The value of that other commodity or security is going to help determine the value of the derivative product. That might be an option or a future or forward contract. So let's first look at options. An option is a contract that's traded and regulated, and it gives its holder or buyer the right to buy or sell an underlying asset, security, or commodity at a designated price, which is known as the strike price. So what's going on with the option itself is a security, and then it is also connected to some other asset or security, and the value of that other asset or security or commodity will help determine how much the option itself is worth. So options are available on stocks, indexes, and foreign currencies, among other things. The major focus here in most of your exam questions that have to deal with options are going to be about options on stocks, equity options. So they're tied to some underlying investment, right? Equity securities. Options come with expiration dates, and there are two main types. Call options and put options. Calls and puts, you can either buy them or sell them for essentially four types of options positions. Let's first look at a call option. Pick up the call. It's one that gives the holder the right to purchase the underlying security at the option's strike price. The call option would be exercised when a market price of the underlying security rises above the option strike price. So when that happens, the option holder, if they choose to exercise the contract, would purchase the underlying security from the options seller who's assigned the contract at a price that is lower than the security's current market price. Remember, going long a call option, buying an option is a bullish position. Pick up the call. You pay a premium to own the contract. Andre holds a call option on ABC. The option has a strike price of $20. The price of ABC rises to $27. So Andre chooses to exercise his option. To do so, he purchases the shares from the option seller. When this occurs, he pays $20, the strike price, per share for shares that are currently worth $27. So at that point, he could turn around and sell those shares for $27 a share and make the difference between what he paid, the strike price, $20, and what he sold them for. Or he could continue holding on to the shares that he essentially bought at a discount. Now let's look at a put option. A put option is one that gives the owner its right to sell the underlying security at the strike price. A put option could be exercised if the market price of the underlying security goes below the option strike price. When that occurs, the option holder, if they decide to exercise the option, would purchase the shares of the underlying security at the market price and then sell them to the option seller at the higher strike price. Going long a put is a bearish investment strategy. Put down the phone. When it comes to puts and calls, remember, call up, pick up the call, put down the phone, right? When they think the market price of the underlying security is going up, and put down. They buy a put when they think the price of the underlying security is going down. Put down the phone. Let's look at an example of a put option. Rush purchases a put option on XYZ. The option has a $15 strike price. When the price of XYZ drops to $10, she exercises the option. To do so, she purchases 100 shares of XYZ at the market price of $10 each, and then sells them to the option seller for the strike price of $15 each. So she bought them for 10, she sells them for 15. So she makes money on that exercisement of the put option contracts. To go long a call option, gives an investor the right to buy the underlying securities at the option's strike price. The investor would do this if the price of the underlying security goes above the option strike price. When you go long a put, it gives you as an investor the right to sell the underlying securities at the option strike price. So if the price of the underlying security drops below the option strike price, you're going to buy them in the market at that current market price and then sell them at the higher strike price. Remember, going long an option gives the investor the right to do so. If you want to master options, watch my options masterclass on our channel here. It is the best supplement to learning and mastering options. Remember, what about shorting an option? So for every long investors, there's an option to short the options contract, right? Someone who shorts the option contract, they're in reaction. So the short call options investor takes on the obligation to sell those underlying securities at the strike price. If the option's exercised and they're assigned the contract, that option short has to go and sell those underlying shares at the strike price, but they don't own them yet. They'd have to go and buy those underlying shares at the current market price and then sell them at the lower strike price. What about somebody who's short put options? When you short a put option, you take on the obligation to buy the underlying shares at the strike price. So when the option's exercised, a put option, the option holder would sell the shares to the person who's short the contract and assign the contract at a strike price that's a higher price than the market price. So when you go long any option, it gives you the right to buy or sell at a fixed price. When you short an option, it gives you the obligation to buy or sell if exercised. You also take in the premium for doing that. Options can either be traded, exercised, or allowed to expire. We've already looked at an option being exercised. When a call option is exercised, it means the option holder buys the underlying shares at the strike price from the option seller. When a put option is exercised, it means the option holder sells those underlying shares at the strike price to the option seller. What about trading an option? What does that mean? When you trade an option, you simply close out your position by taking the opposite position. So if you're long an ABC call option and you want to get out of your position, you would short the same option. So when you trade an option, gain or loss is calculated by looking at how much you paid to go long the option and comparing how much you received when you shorted the option. If you see more when you shorted the option than you paid to buy the option, then you have a gain in your investment. If the opposite, you have loss. The third thing is you're allowed to let them expire. For example, you hold a call option, it reaches the expiration date and the price of the underlying stock never rose above the option strike price, it would expire worthless and you'd lose the premium you paid to own the option. If you have a put option, it reaches expiration date and the price of the underlying security never dropped below the strike price, you never exercised the option, then the option would expire worthless and you would lose the premium you paid to own the put. Now, when you exercise an option, there are two different ways they can be exercised, an American style or European style option. American style option can be exercised anytime. This is the original option style. It applies to equity stock options. It allows you to exercise the option at any time prior and up to the expiration date. So stock options are American style. European style options, this is what most index options are, you can only exercise the option on the expiration date. Let's look at some strategies related to options now. So first off, let's look at using options as a speculative investment. Options provide a form of leverage. Leverage is simply the ability to acquire assets at a fraction of the cost. If you think about it, with an option, you're paying the premium. The premium is a much lower amount of money than buying the shares, like stock shares would be. So for instance, you might have an ABC call option with a strike price of $50 a share, and the premium might be $5 per share, right? So purchasing that option gives you the right to profit from the movement of the price of ABC stock and the option. You pay a lot less for the option than you would for the shares. So that gives investors the opportunity, the potential to buy several options instead of just buying one. Oftentimes, investors will buy many in order to multiply their possible gains. Now, if you multiply your possible gains, you also amplify your losses, right? If the price goes in the direction you want it to, you also multiply your potential loss, right? Because if the market goes down or against you, instead of up, then you end up losing money. So if you bought lots of options, you can end up increasing your losses as well. So when you use options for speculative purposes, there is quite a bit of risk. So let's look at speculative options positions. Bullish and bearish investors. So for a bullish investor, we already talked about buying calls, right? If you talk about, buying, if you think the price is going to go up, you could buy call options and then profit if the price does go up above the strike price. Selling puts is also a bullish option position. Why is that? Because you sell an option and you take in the premium. Now, as long as the price of the underlying stock doesn't drop below the option strike price, then the put doesn't get exercised, right? You get to keep the premium received, and the option expires. So selling puts is also a bullish position. You think the market's going to go up, not down. So somebody has no underlying stock position in the stock, could either buy puts, put down, or sell calls. Selling calls, you take in the premium. As long as the price of this underlying security never goes up above the strike price, you get to keep the premium. So selling calls is also a bearish investment position. You wouldn't sell calls if you thought the market was going to go up. So let's look at speculative strategies with options. So a customer buys one ABC January 30 call at 4 when the market value of ABC is $29 a share. So long call is what type of strategy? You buy a call option, pick up the call, right? Call up. So it's a bullish investment strategy. What is this investor's maximum potential gain? Whenever you buy a call option, your maximum potential gain is unlimited. That's because there's no cap on how high the market price of the stock, of the underlying stock, could go. So in theory, it could go up to infinity, and you would simply have to pay the strike price for that. So the maximum potential gain here for the holder of call is unlimited. The maximum potential loss, any long options investor, is the premium paid. The worst case scenario is you buy that option, you hold it to expiration, the price of the underlying security never goes above the strike price, it expires unexercised. You're out the premium you paid. So in this case, it's a $4 per share premium. Each options contract represents 100 shares. So the maximum potential loss would be $400. The break-even points is for a call option is the strike price plus the premium. So the break-even point here would be 30 plus 4. That means when the value of ABC goes up to $34, this investor, if they decided to exercise the option at that point, would break even on their investment. So if you think about it, when they exercise that option, you're paying $30 a share. They already paid $4 in premium, and now they would own the security that's worth $34 when they go and sell it. They'd break even on their investment. Remember, break even for call option is strike price plus the premium. Break even point for a put option, strike price minus the premium. Okay, so let's say that the value of ABC goes to $200. The customer decides to exercise the call and sell the stock in the open market. What is the customer's gain or loss going to be? Okay, so if ABC goes to 200 and you exercise the option, they pay $30 a share. Right? When you exercise the option, you buy 100 shares for $30 a share. You've already paid $4 a share in premiums. So now they paid a total of $34 per share. There's 100 shares in an options contract. So they paid a total of $3,400. They go and sell those shares at their market price of $200 a share. So they get 100 shares times $200 a share. They would get $20,000, but they paid $3,400, so their gain or loss would be $20,000 minus $3,400, so $16,600 would be the gain or loss the investor would have in this case on that transaction. Pretty hefty gain, would you say, on their favor, huh? Let's now change our focus to options as a way to enhance a stock portfolio. So we're looking at here is ways that options can be used to create income and to hedge. Hedge is protection, or the key word for protection. If somebody's long shares of stock, meaning they own shares of that stock, so they've got an open long position in that stock, they could create an income by selling calls. This is known as a covered call. They own the stock, they sell a call against it. So normally when you have a covered call, why would you do this? Well, it's to generate income. You already own shares of the stock. Maybe you think that the price is not going to shift that much in the near future. So you take in that income and the price doesn't go up above the strike price. You get to keep the premium you received. So it's a strategy. You still hold the stock and it generates some income from the stock. Now you could also hedge by using options. So you have the open long stock position. How would you hedge if you're worried about maybe the value of the stock is going to drop, but you want to protect that position? You could buy puts. It allows you to sell the stock at a set price regardless what happens to the price if it drops. If you hold puts, if you're long puts, you can profit in a stock drop. In fact, when you buy puts, you lock in a gain. You could possibly lock in a gain, right? Because the most that you would, when you buy the put, the most you ensure that the lowest price that you'll get for your shares of stock is that strike price, even if the price of the stock drops well below the strike price. So you're holding stock, you're worried the stock's going to drop, you could buy puts, you've hedged the loss of your investment in that case. What if you have an open short position? You've borrowed shares that you've sold, and now you have to return them to buy them back and return them to the broker-dealer at some point. If you have an open short position, you want to create income, you could sell puts. These are known as covered puts. So this is suitable for flat markets. So basically the idea is you short the put. As long as the market price doesn't drop below the strike price, you get to keep the income you received. Now, it says it's very risky. That's because the put position is never exercised. You get to keep that income you received. You still have an open short stock position and the maximum loss associated with that. If the price of the underlying stock goes way up, you've got to close out your position at some point, and you could open yourself up to an unlimited loss. To hedge, if you've got an open short position, you could buy calls. You buy those calls. If the market price goes up above the strike price, you can exercise that call option and pay that strike price, and then you can close out your short position at that point. So that's a way to limit loss in a rising market. So this is how you can use options to hedge and create an income when you have an open position, either long or short. All right, here's a question. Portfolio manager would sell calls against securities in a managed portfolio in order to A, protect the positions against the bear market, B, increase income and cash flow in a stable market, C, increase the diversification of the portfolio, or D, speculate on the direction of the market. Okay, so in this case, you would sell calls in order to increase income. So against the securities in your portfolio, meaning you own your long shares of the securities in the portfolio, you're selling calls against them. We're talking about covered calls here. Covered calls are used when you want to create income in a stable, flat market. We just talked about that one of the previous slides, so A would be the correct answer. All right, let's shift our focus to the second part of derivatives, future contracts. A futures contract is one that gives the owner the obligation to buy some good or commodity at a fixed price in a designated date. So the obligation to buy at a fixed price, which is the contract price later, some designated date, the contract's expiration date. So why would somebody buy a future contract? Well, you could buy it for speculative purposes. That's why most people buy these days. You're speculating about the price, that a blind commodity going up, or you can buy it to hedge an underlying short position. So in the case of a user commodity, somebody who's going to need to buy a commodity at some future date, they want to lock in the price that they're going to pay. So they use a long future contract to lock in their price. So like, let's say for instance, an airline. They're going to have to buy oil for their planes at some future date. So they might go long a futures contract at a given price. So they know that on the date the contract expires, they would buy a certain amount of oil at the contract specified price. Even though the price of oil went up, they would be able to lock in that price. What about on the other side? So selling a futures contract. So if you sell a futures contract, you're obligated to sell that underlying product commodity at a fixed price on a given later date. So you could use it for speculation purposes, speculating about the price going down, or to hedge an underlying long position. You're the producer of a commodity, let's say soybeans, and you want to make sure that you get a certain price. You're a farmer, you farm soybeans, so you long a future contract to lock in a future price, right? So you are your own production company, right? In the airline space, you might sell a futures contract to make sure you lock in that you get that given price. You're going to sell your oil at some designated date. So you short the futures contract. You're guaranteed that you'll get that price for your commodity on that date. Futures and forwards. Forward contracts are very similar to futures contracts. The only difference really is, the main difference is that forwards are not regulated. They're not standardized. They're not traded on an exchange. Standardized basically means that with a futures contract, the terms of the contract, the place, time, and date, quality of the product, delivery terms, they're all standardized, right? They're all the same for that commodity. For forward contract, it's not. Forward contract, they customize terms between the two, the buyer and the seller, the entities involved with the contract. So future contracts are regulated. Forwards are not. Futures contracts are liquid and trade on exchanges. Forwards are not. Future contracts are standardized, meaning the terms of the contracts, place, time, date, quality, delivery are all the same. Forwards are not. They can vary. So why would you use a forward contract? Well, you can customize the terms between the parties, whereas a futures contract, the terms are pretty set in stone. They're the same between them. What about mark to the market? Mark to the market basically means that the day on the value is adjusted depending on the value of that underlying commodity. Futures contract is marked to the market daily. Forward contracts are not. Okay, but basically futures and forwards are doing essentially the same things, except they have some differences between how they're set up. Let's look at a variable life settlement, or a viatical. What a viatical is, somebody purchases somebody else's life insurance policy. So the buyer of a viatical buys the ownership rights to a life insurance policy from the insured individual of the policyholder, who's looking for an immediate cash payment. So basically, you buy somebody's life insurance policy from them. You need to continue paying the premiums on that policy, but then when the original owner dies, then you would receive their death benefit. So the buyer of a viatical buys the ownership rights to that policy. The insured individual is selling their life insurance rights in order to receive cash immediately. So the risk to the buyer is that the buyer is going to have to continue making those premium payments in order to maintain an insurance policy. You have to continue making premium payments. So the person who buys that policy in the viatical settlement needs to continue making those payments. So that would be, if that insured person lives longer than anticipated, when you combine what you pay for the policy rights and then those continued premium payments, the buyer might end up paying more than the death benefit ends up being, depending on how they live. So that's the risk you take on when you purchase a viatical settlement, is that the original insurance or the original insured lives longer than anticipated, and you end up shelling out more money before you get the death benefit, and then you actually receive from the death benefit. Let's look at other alternative investments now. Limited partnerships. A limited partnership is a business structured as at least one limited partner and at least one general partner. So you have a limited partners are basically the investors. They invest most or almost all of the money in the partnership usually. They do not manage the partnership. They have what's known as limited liability, meaning all they can lose is the amount they invest in the partnership. The general partner are the active managers of the business. They oftentimes invest some money in the business, but they are not the primary investors. Their job is to actively manage the business. They do take on unlimited liability, which means if the partnership goes bankrupt, the general partner's assets could be at risk. Limited partners, limited liability. General partners, unlimited liability. An example of a limited partnership would be a real estate limited partnership, a RELP. They're investing in developing real estate. What is the benefit to a limited partnership? There are tax benefits. A limited partners can claim multi income losses on their tax returns. So what happens with an LP, often in the early years while it's being established before money starts coming in, they can offset passive gains that they have from other investments with their losses associated with the partnership. That can be tax benefits, so there might be some tax shelter aspects to a partnership. However, they are not supposed to be primarily attended as tax shelters. Their main intent is still supposed to be to generate income, to generate money for their partners. To simply lose money the partners can use to offset passive gains on other kinds of investments. The risk associated with these, the main risk, is they're illiquid. The limited partners need the general partner's approval to sell. Mostly, these are only for accredited investors or involved in the partnerships. They're more long-term investments. Sometimes it can take years for the partnership to start turning money to their investors. So if you have a shorter term investment time horizon, then a limited partnership is not ideal for you. All right, let's look at hedge funds, another type of alternative investment, another type that's really intended for wealthy investors, institutions. So a hedge fund has similar aspects to a mutual fund in that they basically pool investors' money and use that money to buy securities, backed securities for that fund, but there's major differences between hedge funds and investment companies. Now, hedge funds, investment companies don't have to register with the SEC. And hedge funds usually avoid SEC registration. The way they avoid SEC registration is if either they're only offered to qualified purchasers or to fewer than 100 investors, no more than 100 investors, no more than 135 are not accredited investors. Now, if they have assets under management that go over $150 million, then they would have to register with the SEC. This is after the Dodd-Frank Act of 2012. Since then, that's been ruled also with hedge funds. So if their AUM is higher than the 150 million threshold, they would also have to register with the SEC. Other ways that hedge funds differ from mutual funds, right? Mutual funds have to register with the SEC. Hedge funds typically don't. So they rely on strategies like short selling, investing in derivatives, speculatively increased leverage. Hedge funds, unlike mutual funds, come with a high minimum investment and high fees. An annual management fee of 1% to 2% is common, plus a performance fee of 20% of profits are common. Hedge funds are almost always used by institutions and wealthy individuals. So typical investors, retail investors, sovereign wealth funds, insurance companies, banks, family offices, university endowments. Hedge funds are also, they can be. A hedge fund is illiquid. You have to a mutual fund you can redeem anytime. Hedge funds, they usually have an initial lockup period, which can be a year, sometimes longer, and then even after the lockup period passes, you can only redeem your shares on certain designated days. So they're very illiquid. They really are only suitable for investors who are on a long-term time horizon, don't really need liquidity within their assets. And of course, as we said earlier, either institutions, wealthy individuals sometimes are willing to take on significant risk, but also significant gains. Similar investments, but most other funds, like mutual funds, don't offer this type of tied up money and the broad diversification. Mutual funds are more liquid, but remember, hedge funds are only going to be appropriate for your accredited institutional and sometimes retail investors, wealthy individuals, people with a net worth of $1 million or more, less their primary residence, $250,000 in income, expected to do so, married, filing jointly, $300,000, expected to do so. Very well done. I'm so thrilled that you've made it through part 2 of our Series 65 class. This has been a lot of content, and clearly it's not an easy topic to get this stuff really nailed and rolling, but you're doing fantastic. It's time now that you go over to millionairesintraining.com and do our testing simulations for the Series 65. Chapter 2. Make sure you do each individual subchapter test as well as the chapter final. Reinforce this information. Make sure you're testing until you get 80s, 90s. If you're really after it, 100% are exams. You'll never see the same exam twice. They're concept-based. So you have to work hard in order to understand these concepts to pass our exams. Focus, practice hard, and you will become an investment advisor representative with millionairesintraining.com Development Systems. Thank you so much for watching. I'm Colin Kleck, and I will see you in the next video. Client accounts, client profiles, and portfolio analysis. Let's begin by looking at different types of clients who can open an account at a broker-dealer. First off, individuals and individual accounts. An individual account is one that only has one owner, and that is the individual who can trade in the account. Unless discretionary authority is given to somebody else, then somebody else might be allowed to trade in the account. But with an individual account, the account owner always is able to trade in the account. They might be able to give somebody else trading authorization that allows that other individual to trade within their account. Additionally, you cannot give information related to an individual account related to anybody else except the account holder, unless the individual has gotten written consent for you to provide that information to somebody else. So that means even if a spouse calls up to ask about their spouse's account, you would only be able to give information about it to anybody beside the account holder if that other person had given written consent to do so. To open an individual account, you must be living, mentally competent, and an adult. For somebody else to be able to trade the individual account besides the account holder, they would need to have prior written discretionary authority. That means in advance, the account holder would need to have signed off on that third person trading within their account. There are three types of trading authority: limited, full, and discretionary authority. Limited trading authority allows that third party, that other individual besides the account holder, to trade in the account, but they cannot make withdrawals. So only the account holder can make withdrawals in the account. The designated third party cannot. Full trading authority gives that third party trading authorization and the ability to make withdrawals. Now, limited and full trading authorities are types of authority that are again given to non-securities professionals. Securities professionals can be given discretionary authority. With discretionary authority, the professional or financial advisor has permission to trade in the account without the client confirming each trade in advance. So the client gives the written authorization, then the securities professional can decide which trades to make in the account and make those trades. Usually, discretionary authority does not allow the securities professionals to make withdrawals in the account. The one case in which they could make withdrawals in the account is an investment advisor that has custody over the client funds, and then the investment advisor rep could also make withdrawals in the account in addition to taking money out. But agencies and broker-dealers typically do not have the ability to withdraw money from their clients' accounts. Okay, let's now look at a joint account. A joint account in one in which there is more than one party owner to the account, and each of those parties can access and trade in the account. Now, in order for a joint account to be opened, both parties must be present at the opening of the account. That means you can't have an individual account and then add somebody to it and make it a joint account. Both parties have to be present during signing. With a joint account, the financial information of both owners is combined. So if you're making recommendations on what's suitable for that account, you have to combine the financial credentials and information from both owners to make those suitable recommendations. Both parties are allowed access to the accounts and can make trades. That means if two individuals have an account, it's fine for one of them to call a broker-dealer and tell them to trade in the account without the second one's permission, right? So any checks written to the account need to be made out to both parties, not just one party. Any checks made from the account need to be endorsed by both parties. And finally, the account needs to be closed by both parties. So it needs to be opened by both parties, closed by both parties, and any checks signed in the account and written to the account need to be made out by both parties, need to sign the check, or the check needs to be made out to both parties. When the account is open, one of the parties can decide what to trade and make those trades. There are three main types of joint accounts that you might see reference to on the Series 65 exam. So the accounts being opened, when they're opened, owners need to choose which type of account they're opening. So the first one is joints with tenants in common. Then there's joints with rights or survivorship, and then there's joints by entirety. So let's go through and look at each of these. So a joint tenants and rights and joint tenants in common, or JTIG. One of these, the owner specifies the percentage to split among them. So they split the assets in the account based upon some designated percentage. So then if one of the account owners dies, that owner's percentage is passed on to their estate rather than to the other owners, the living party. For instance, I have a joint and common account with somebody else. 30% of the assets are mine, 70% are theirs. If I were to die, 30% of the assets would pass along to my estate, and the remaining amount they would keep the rest. So you may see a joint tenant account. It may be called tenants in common on the exam. The second type of account is a joint tenants with rights of survivorship, a JTROWS account. So they own this account jointly, so there's not some designated percentage split among them. So if one of them dies, then the other gets to keep the money in the account. So if I have a JTWRS account with somebody else and I were to die, that other person gets to keep the remaining assets in the account. Joint tenants by assets in entirety are similar to joint TWRS accounts, except they're for married couples. So the idea is that the assets are 100% jointly owned. If one of the spouses dies, the other one gets to keep the remainder of the money in the account. All right, let's look at another aspect related to accounts, qualified domestic relations order. So this is basically divorce-related court orders that requires an ERISA-based retirement plan, employer-based, sponsored by or backed by the government, in order to pay all or part of the allocation to a spouse, former spouse, or child that the plan participant. Usually with ERISA-based plans, payments can only be made out to the plan holder. This is the case when divorce happens. Court could order that the former spouse or child receive some of the payments from the retirement plan. Without a QRDO, only the plan owner can receive those payments. Now, the order itself must include specific information such as the name and address of the participant and the alternate pay, the amount or percentage of benefits to be paid to each alternate pay, for example, the spouse, the children, other plan holders. The spouse or ex-spouse receives benefits would be responsible for paying taxes on the benefit if they were the plan participant. For example, the plan participant was going to owe at ordinary income rate at 40% of the withdrawal. The spouse or ex-spouse would be subject to the same tax liability. QRDOs are not needed to divide assets in an IRA because IRAs, individual retirement accounts, are not employer-based plans. They're not subject to ERISA rules. So QRDOs only apply to ERISA-based retirement plans. Now, let's move off of individuals. Before we were talking about individual joint accounts, and QRDOs apply to individual type of accounts. Now let's shift our focus to business entities. They could open accounts at a broker-dealer as well. So what we'll do here is we'll run through some characteristics of each of these entities that could open an account. So first off, a sole proprietorship. So sole proprietorship account opened by a sole proprietorship. The sole proprietorship is basically businesses created when an individual simply goes into business for themselves or doing business as. So why would somebody use a sole proprietorship? So it's easy, very little paperwork required to open it up. It's not taxable as a separate entity. The profits are directly passed through to the business owners. A general partnership is a second type of business entity here. It's like a sole proprietorship, but it has more than one owner. All the partners in a general partnership have unlimited liability. Unlimited liability means that their assets could be at risk. Same is true for sole proprietorship, by the way. Sole proprietorship, if the business goes bankrupt, some legal matter associated with the business, they become sued, the sole proprietor's assets could be at risk. Same deal with the general partnership. Whereas limited partners, their assets are not at risk, right? Limited partnerships is one that has at least one limited partner and one general partner. The limited partners are the investors. They can only lose the amount they invested. Sometimes up to 99%. They don't manage the partnership or make decisions related to it. They have limited liability. So the thing about being a limited partner is the most you can use is the assets you invested, the money you've invested. The general partner, these are the people individuals who's managed the business. They do invest some money like limited partners up to 99%. They may the general partners invest some money, have unlimited liability. If the corporation goes bankrupt, the general partner's assets could be at risk. Limited partners have limited liability. General partners have unlimited liability. So what's the biggest concern to a limited partnership is it's not liquid. It's not easy to transfer ownership. The limited partners would need to be general partner to approve the transfer of their shares in a partnership. All right, let's look at corporations now. Two types of corporations on limited liability. Companies can be associated with corporations. They can operate similar ways. So basic corporation, a C corporation, S corporation. A C corporation, these are the larger corporations. If you buy shares of stock in a corporation on exchange as a C Corp, the stock you're going to be buying, the number of investors is unlimited. There's no limit on how many shareholders a C Corp can have. And they can issue different types of securities. They can issue common stock, different classes of preferred stock, convertible bonds. The same company can issue each of those type of securities. What about taxation purposes? So a C corporation is a taxable entity, meaning it's taxed at the corporate level, and then if any dividends are passed through the shareholders, the dividends and shareholders would also have to pay taxes on the dividends. It's called double taxation. It's seen as a disadvantage because the corporation pays tax and the shareholders pay tax. However, there's lots of advantages that go along with C corporations. The fact that they go along and can issue different types of securities to an unlimited type of investor. It doesn't matter where the investors are from. It doesn't matter if they're corporations, usually venture capitalists, geared towards C corporations. Ease of transferability, yes, you could trade your C corporation shares to somebody else, no problem. S corporations are smaller. Maximum total number of investors is 100. Other corporations cannot invest in an S corporation, and only US residents can invest in them. They can only issue one type of security, so it's very limited in what they can issue. For taxation purposes, there's some advantages to being an S corporation. They're not a taxable entity, meaning their proceeds are not taxed at the corporate level. Instead, they are all passed through to shareholders, and then the shareholders would pay taxes on a dividends received or ordinary income rate. Ease of transferability, yes, you can trade your S Corp shares to somebody else very easily. LLC, limited liability company, unlimited number of investors. They can choose to either be a taxable entity or not. Taxable entity means they will be taxed at the corporate level, pay corporate taxes, or they can choose to simply pay, have their assets directly pass through to their shareholders, investors. And there is ease of transferability, meaning you can transfer your ownership interest to somebody else. Okay, let's now look at ways to evaluate performance or portfolio evaluation. The capital asset pricing model is used to calculate the expected return on an investment, a series of investments, considering the amount of systematic risk associated with this. Systematic risk is basically risk that affects the entire securities market. So we're talking about the CAPM. It's a way to predict expected rate of return on the investment, talking about it in the context of the risk that all securities in the market are subject to. So the CAPM states that the expected rate of return is the sum of the risk-free return. The risk-free return is the return on the investment, searching the risk. Usually that 3-month T-bill rate is it has the risk-free return. So the sum of that plus the risk premium. The risk premium is basically the difference between what the market overall is returning on average right now and the risk-free return, what the market return minus the risk-free return times the securities beta. That's what the risk premium evaluates. Remember, the CAPM is a combination of the risk-free return plus the risk premium. So we know what the risk-free return is. It's the return on investment with essentially no risk. Typically a 3-month T-bill rate. The market return is typically the market is returning on average right now. So what is the securities beta? What does that mean? So beta is a measure of how the stock moves in relation to the market, kind of a coefficient. So beta is used to measure what you expect the securities price to do given a certain movement up or down in the overall market. So beta is centered around the number 1. A beta of 1 means the security moves exactly as the market moves. The market is up 5%. Securities of beta are 1, you would expect the price to be up 5%. If the beta is greater than 1, it means the security moves in the same direction as the market, just more. So the security has a beta of 1.5, then the market moves 5%, it's up 5%. You would expect that securities beta to go up 1.5% of 5. So 1.5 times 5 would be 7.5 times 5%. So 7.5% when the market moves 5%. If it's less than 1, it means it moves in the same direction as the market, which is not as much. So if the beta is 0.5, the market moves 5%, you would expect the securities price to go up 2.5%, half of that 5%. Note that a negative beta means that it moves in the opposite direction. So if the security is a beta of -1 and the market's up 5%, you would expect the market price to be down 5%. So if you're given beta and the normal market return, and you're trying to figure out how much the security would move, you basically just multiply the beta by the market return. So if it has a beta of 2 and the market's up 5%, you would expect it to be up 10%. 2 times 5 is 10%. It's got a beta of 0.5 and the market's up 5%. You would expect it to be up 2.5%. 0.5 times 5 is 2.5%. Higher than 1, remember, it's a multiplier. Beta now is a measure that goes within the CAPM formula here, but this is just the general definition of what beta is. So speaking of the CAPM formula, the capital assets pricing model formula, here it is. So again, what we're doing with CAPM is this is a way to calculate expected return. All right, so expected return equals risk-free return plus, now within these brackets in parentheses, we have beta times, and then your inner parentheses, we're going to bracket expected market return minus risk-free returns. So the risk premium is basically what you have within the brackets here. Beta times expected market return times expected risk-free return. If you're ever doing this CAPM formula, if you're asked to calculate based on given numbers, remember to use the brackets. Do the inner brackets first, expected market return minus risk-free return, and then multiply that by beta and add whatever that number is to the risk-free return. And that's how you would get the answer choice. If you don't have the brackets, you just go straight through. The numbers don't play out right. So remember the brackets. Now alpha, another measure that is important and might be testable on the exam, it might be presented in context with the CAPM formula, is basically the difference between a security's actual return and its expected return. So alpha as an equation equals actual return minus expected return. Now the alpha is greater than 0. That means that the investment is performing well. That means that its actual return is higher than what its expected return. So that might reflect well on a portfolio manager, for instance. We have this in conjunction with the CAPN formula, because typically you would calculate expected return using the CAPN formula model, and then you can use that in some cases for some exam questions to calculate what the alpha is if you already know the actual return. All right, here's a question. What is the expected rate of return on a stock with a beta of 1.5 when the market is expected to return 9% and a rate on treasury bills is 3%? So let's look at this question and break it down. So you're basically going to use the CAPN formula to calculate expected return here. So remember, the CAPN formula is, take your time, expected return equals risk-free plus, and then within parentheses you have your beta, times market minus risk-free. Then we're going to close the bracket there. Remember, we're going to do our inner brackets first. So the market is expected to return 9%. So your market average return is 9%. Your risk-free is the treasury bill rate of 3. So now within parentheses, we get 9 minus 3. Your beta, it tells you, is 1.5. So that's within the bracket. We're doing the inside brackets first. 9 minus 3 is 6 times 1.5, the beta. So within the brackets, our answer choice is going to be 9. 1.5 times 6 is 9. We're going to then add that to the risk-free return, which is 3. So our risk-free return using the CAPM formula is 12. 9 plus 3. That's how you'd go about answering that answer choice. The answer choice would be 12. Again, what we're doing is we're taking the formula risk-free plus, and then within the brackets, beta times inner brackets, market times risk-free. You take that 9 minus 3 inside, you get 6. You multiply that by the beta of 1.5, you get 9, and we add that to the risk-free return of 3, and we get our answer choice, which is 12. Remember the inner and outer brackets. If you don't use the brackets, the math will end up wrong. Here's another question. Mr. Jones owns shares of ABC Company, which has an alpha of 2%. The market is expected to return 4%. The beta of ABC's stock is 0.5, and the T-bill rate is 5%, or 2%. What is the actual return on ABC? Number one, we have the components that we need to use the CAPM equation to solve for expected return. Number two, we know the alpha, and the question's asking us for the actual return. So remember, the alpha equation is alpha equals actual return minus expected return. We know what the alpha is. It tells us it has an alpha of 2. The question is asking you, what is the actual return? So what we have to do here, we have to use the CAPM equation to calculate expected return and then plug that in here. And then we would basically have actual return x minus whatever we get for expected return. That would give us the answer. So remember that CAPM equation. I'll write it down again here. Expected equals risk-free return plus beta times market minus risk-free return. All right, let's do some math here. All right, the market is expected to return 4%, so that's our market return of 4. The T-bill rate is 2 for our risk-free return, so risk-free return is 2. The beta here is 0.5. The beta of ABC stock is 0.5, so 4 minus 2 is 2. 2 times 0.5 is 1. So within our brackets, we get 1 for the answer. We're going to add that to the risk-free return now. The T-bill rate is 2, so that's 2. So now we have an expected return of 3. We're going to plug this number here, right? That's what you're solving for, is expected return. So alpha's 2. Alpha's actual return minus expected return. We know what the expected return is now, so x return is x. 2 equals x minus 3. So what is x going to be? It's going to be 5. 5 minus 3 is 2. So you just solved, used the alpha calculation, use the CAPM equation to figure out the actual return on that for that question. And that is how you would go about doing that there. So now these formulas, the alpha formula, it's not that complicated. The CAPM formula, I have to remember the brackets. It's somewhat complicated. You might have to use on the exam. You might have to calculate 2 questions related to it. So that is an equation that I would try to remember. So do several practice questions on these. It's important to remember what you're using it for and what it represents. Let's shift our focus now away from some of this math and look at some of the efficient market theory. So efficient market theory, the general idea here is that people subscribe to this, believe that the market is efficient in pricing investments. So people who have a strong belief in the efficient market theory, call it efficient market hypothesis, believe that using analysis, fundamental and tactical analysis, is pointless. They basically just try and track the market. So buying things like ETFs, exchange traded funds, index funds, passive investing strategy is the way to go. That's people who strongly believe in the efficient market theory. There are different theorists and different grades of belief here. So the weak form, the people that have the weak form and belief in the efficient market theory, basically those individuals believe, so what could be used to find undervalued investments? Information not reflected in price, right? So all public information. Somebody who subscribes to the weak form in efficient market theory does believe that there is things that you can use to determine what are good individual investments to make. Fundamental analysis, looking at the financial fundamentals of companies, some of those metrics that go along with that. They would believe that technical analysis is not useful. So they subscribe somewhat to the efficient market theory. We saw a weak connection to it. They believe that past price patterns of technical analysis can't really help you predict future results, right, and which investments to make. But public information, sometimes news, is fundamental analysis can. Right, so somebody believes in the semi-strong form with the efficient market theory. They think that regular information is available to the public is not helpful because all the information has already gone into determining the price has already been done. Past price patterns are not helpful. They believe that's already reflected in the price. However, inside information, things that you shouldn't be trading on anyways, could, however, help you determine good investments to make. Now, the people who have the strongest form, strong form, right, they believe that these are the individuals who just try and track the market. Believe in old school methods, dollar cost averaging, discipline, and diversification. There's nothing that can be determined to figure out the underlying investment cost. Everything that's already gone into determining the price has already gone into the price, right? So they believe in the strong form. It doesn't really pay to go out there looking for the individual investments to make because everything's already been factored into the price. So they believe that you just basically track the market, stick with it with discipline, and everything's already factored in, just buy index funds. All right, here's a question related to this. So which form of efficient market theory would be used by those who believe that all public information can be used to find a good investment? So weak form, semi-weak form, semi-strong form, or strong form. So this would be the weak form. They do believe that public information, fundamental analysis can be used to find good investments. They don't believe that past price patterns could be used, but they do believe that public information, fundamental analysis could be used. So A is the correct answer. Seeking news. Let's look at some portfolio construction strategies now. So when we're working with an investment advisor, going about putting a portfolio together, a couple major strategies you could follow, one or the other. Strategic asset allocation. Basically with this, you and a client would work together with a financial advisor to choose a target percentage of asset classes based on the client's suitability information. Okay, and then set a percentage of assets within the portfolio to follow and maintain these designated percentages. So for instance, a balanced fund, one that contains equities, and index securities, for somebody who's in their mid-40s, a good asset allocation might be 60% equities, 40% bonds, income funds, right? Typically, 100 minus the age convention is used often to try to determine what percentage of equities they should have in their account. In this case, if they're in their 40s, they should have about 60% in equities. So we're initially setting up, this is about hypothetical large portion, but we're initially setting up this person's portfolio. They have 60% in equities, they have 40% in bonds and fixed income. Now at some point, it's entirely possible that the equities grow at a faster rate than the bonds. And so even though it was originally set at 60-40, the equities could be 70% of the total assets and the bond might have dropped to 30. So at some point you agree to balance, and you would, that example, you'd sell off some of the equities, you'd rebalance and use the extra money to buy some bonds and bring your percentages back to the 60-40. 60 equities, 40% bonds. That's a strategic asset allocation. Tactical asset allocation is a little bit different. So with tactical, basically the manager tries to time the market and move in and out of asset classes as they see fit. They like to take advantage of pricing anomalies of different sectors that might be on the rise. For example, maybe the cannabis industry, that move on from one to the other. So they'd have to rebalance one percentage of assets to different categories to take advantage of different pricing anomalies and different market sectors. So with a manager, typically with a tactical asset allocation, they might have a range of a certain percentage that they might want to fluctuate within that range, a percentage of securities. So for example, you might originally have, let's say the portfolio, the minimum percentage of equities might be 40, the minimum would be 40, the max 60, and then it fluctuate within those ranges. So maybe at sometimes you have 70% equity investments and like 30% debt, and then it fluctuates and shifts, but always trying to stay within those ranges. But the idea with a tactical asset allocation is the manager is actively buying and selling, looking to take advantages. For example, if stock starts to drop, they might want to sell off, and if something else is on the rise, they might want to get your money into something else. Whereas with strategic asset allocation, you try and buy and set different percentages of asset allocation and keep them the same. All right, other strategies or ways to select investment styles: active management, passive management. So active management, basically the manager tries to use analysis to find undervalued securities, trying to beat some designated benchmark like the S&P 500 index. Active management does come with higher costs and higher fees. The more trades you make, if you're actively trading, the more commissions and the customer. If you're getting in and out of securities quickly, you're driving up short-term capital gains. If you buy and sell within a year, same security, you'd be taxed at the short-term rate, which is higher than the long-term rate. Passive management with these investment advisor selects a set of investment to kind of track an index and then sets it and forgets it. They're not actively buying and selling. It's why it's called passive. There's less cost, fewer commissions, less trades, more long-term capital gains. You're typically holding for the long term. Passive management strategy. So that's also a potential advantage of a passive fund anyway. Right here on the right hand, capital appreciation and income. So income goal and strategies, they're looking for investments that make payments while you hold them. So like while you hold the security, it makes some payment to you. It's like some example here, CDs, interest being bonds, semi-annual interest payments on these bonds, dividends paying stocks, quarterly payments on the dividends or preferred stock, for instance. Again, income investor is somebody who's interested in receiving those income payments while they hold the securities, probably to a greater extent than they are seeing their market prices rise. Tax implications with an income strategy, right? You have to pay taxes. Unless the investments are held in a tax advantage account like a retirement plan, every year you're going to have to report those bond interests, those stock dividend payments on your tax form, and pay usually anyways at your ordinary income tax rate. So for higher income investors, this means more reported income, which is a possible negative. Capital appreciation strategy. Basically, somebody with this is interested in seeing the value of the securities rise over time. They don't care so much as seeing future income payments while they hold those securities. So investments include non-dividend paying stocks, have large growth potential. This is typically more of a long-term strategy. The large risk is market risk. This is a market risk is that if the market goes down, all investments or their value go down, right? So if your securities have been growing in value over time and you haven't been receiving dividend payments, the market tanks and you still hold that security, the value of that security has gone down. If you sell out, you won't make as much money. So if you sell the security now, you're not going to make as much money as you could have when the market was up. A benefit, though, is lower tax implications. We're talking about securities that don't make dividend payments. We don't have to report income from them at the end of the year. And usually if you're holding the securities for more than a year, you're subject to the long-term capital gains treatment, which is 15% for most investors, lower than somebody's ordinary income rate. All right, let's look at growth versus value investing. Growth investing is basically investing in companies that have a degree of expectation of growing earnings over time, over the long term. Growth stocks. Growth stocks not known to pay dividends. The expectation is for them to be able to grow significantly in the market price over the long term. Growth stocks are known to have IPE ratios, price to earning ratios. The idea is that the investors are willing to pay more now for the stock and the expectation that its earnings are going to go up along with the price. Value investing is a little bit different. So value investing is basically investing in companies whose market prices used to be higher and now they're down for whatever reason and hoping to buy on a dip. The market's on sale, right? So we buy in on a dip. Value stocks usually have a lower PE ratio. Their market prices are down. Their earnings may be up, not down. Their earnings might be not up as much. So with value stocks, often value stocks still do pay dividends. Usually it's established companies whose market price is temporarily down, but the stock does still pay dividends. The idea with a value invest is they buy at a low price, hoping for a turnaround, turnaround of that price to go back up to where it was or new higher highs in the future. Here's a question. A value investor looks for a stock where the A share price does not reflect a positive outlook for a company. The share price has been increasing on an ever trading volume. C, quality of the company's earnings, balance sheet management, and market position are underperforming. High, D, company's earnings are growing at a rapid rate, supporting ever higher stock prices. So established company, the market price of the company is down. So the market price does not reflect a positive outlook for the company, right? The market is down on the company. That's why the share price has dropped. So A is actually the correct answer here. Oftentimes with a value stock, a portfolio manager will look at the financial fundamentals and, it looks like the company really isn't in bad shape. So it might be a good stock to invest in while the market price is down. But the one thing that's uniform and correct with all of these answers is that with a value stock, the share price is dropping. So it doesn't reflect a positive outlook for the company. So A would be the correct answer to this one. All right, other portfolio management techniques, diversification. So this is a good way to sort of protect against risk. Seeking a portfolio investments that are uncorrelated assets. Uncorrelated means there's no relationship. So asset A's value might be up. It's not correlated to asset B. It's not a way you can't really predict what's going to happen to asset B's price. It might be up, it might be down. They don't have any real relationship to each other. So the intuitive notion that you shouldn't put all your eggs into one basket, right? So the main goal of diversification is to reduce risk and correlate assets and for terms that don't use together. For example, a travel industry stock and a healthcare industry stock usually would be uncorrelated just because they're traveling and most likely has no impact on whether or not they're buying healthcare products or pharmaceuticals, right? So a mix of uncorrelated assets within some of these portfolios, because one of them is down doesn't mean that they're all going to be down. All right, other investing techniques, buy and hold. Basically buy and hold, holding securities for the long term, my favorite type, not actively trading, kind of goes along with involving an index. Let me know what your favorite type of trading is in the comments below. So low cost fees and taxes associated with this. You're not making any trades. You're not making many trades. You're not incurring many commissions. When you are taxed, you're taxed you're not taxed the short-term capital gains rate, usually long-term. This goes rebalancing that goes along with strategic asset allocation when assets are down to rebalance back to the original target percentage, rebalancing debt and equity. Sector rotating, the manager tries to concentrate on the sectors and focus on growth, and then sell when the expected sector is expected to drop. So shifting to a separate sector when it looks like another sector is going to take off, and selling on another sector that's not performing well as well. So one sector to another based on broad market cycles and other expectations expected to go along with the market. So here's a question. Which of the following is a passive investment? A, making investments in an individual retirement account. B, making investments in a 401k. C, investing in 100 shares, each with 10 different companies. Or D, investing in shares on the S&P 500 index fund. So tracking an index is a common passive investment strategy. So D is the answer choice. You track an index, a bunch of securities are selected that are meant to follow the index, and then you kind of just keep your investments the same and hope that the index goes up and hope that your portfolio goes up along with it. All right, dollar cost averaging. This is a strategy and technique that investors often follow. So what is it? So the investor sets a certain fixed dollar amount periodically that they'll invest. So they set and invest that no matter what the market rate. So for example, the market might, they'll decide that every month they're going to invest $500. They're going to invest $500 for the mutual fund shares or a certain company's stock, or maybe they split it $500 between 3 different companies, when they're buying equal percentages in different companies. Why would you use this? It allows the purchaser to purchase more shares and minimize time years, the average cost per share being less than the average price per share, right? This market goes up and down. You're buying at lower costs and higher costs. It results in the average cost per share being less than the average price per share. You don't spend a lot of money on the security, and the security drops shortly after. Dollar cost averaging helps to reduce this risk of buying at improper high and low prices. So let's look at an example here, given a question or example here. Somebody who invests $500 per month in ABC stock at fallen prices. Month one, so they're investing they're investing $500 a month regardless of what happens to price. So month one is trading at $10 a share. Month two, it's trading at $5 a share. Month three, it's trading at $20 a share. So the average price that the individual paid is $11.67 per share. So you take the $35 total, 10 plus 5 plus 20 divided by 3 months. So the average price they got was $11.67. But what is the investor's average cost per share? The DCA, this is where it comes in here. To calculate that, you would take the total dollar amount invested, $1,500, $500 for 3 months, divided by the number of shares that they're going to have at the end of those months. So at the end of month one, they got 500 shares. It was $10 a share. They put $500 in. They got 50 shares. In month two, they got 100 shares. They invested 500 at $5 per share. That's 100 shares. In month three, they got 25 shares. They invested 500 at $20 a share. So 500 divided by 20 is 25. So that means they got a total of 175 shares. So they paid $1,500 for a combined total of 175 shares they received. So that means their average cost per share is $8.57 per share. So the average price paid is $11.67, but the average cost per share is $8.57. So the result here of using the DCA, dollar cost averaging, is in a volatile market where market prices are rapidly shifting, your average cost per share is lower than your average price per share of the stock, so it's advantageous for the investor. Tax considerations and retirement plans. Let's first look at taxation. There are two main ways for somebody to profit from their investments: investment income and capital gains. Investment income is money that the investor earns while they own the investment. So for instance, dividends from stocks, mutual funds, REITs had interest in bonds or bond funds. So remember, if you see income associated with investments, money the investor receives while they still own the investment. When it comes to bond interest, it would be taxed at the investor's ordinary income rate, unless it's from a municipal bond. Remember, municipal bonds, mostly anyways, are not taxed at the federal level and then often at the state level. The regular corporate bonds, taxed at the investor's ordinary income rate. Dividends received are going to be taxed either at the investor's ordinary income rate or the qualified dividend rate. The difference here, you would get the qualified dividend rate depending on the stock. So first off, in order to qualify for that qualified dividends rate, stock needs to be issued by a U.S. corporation or a qualified foreign corporation, the foreign corporation listed on a U.S. exchange. And you would have had to held the stock for at least 60 days before the dividend is paid. If those things are true, it's a qualified corporation or U.S. corporation, and the investor held the stock for at least 60 days before the dividend was paid, they would get the qualified dividends rate, which is 15% for most investors. Those things are not true, then the dividend would be taxed at the investor's ordinary income rate, their tax bracket. The second way somebody can make money and profit from an investment is capital gains. Capital appreciation, right? Capital gains between the difference between the price you paid for a security and what you sell it for. So money earned from selling a security for a higher price than the price at which you paid for it. So if you bought shares of stock for $1,000 and then a little while later you sell those shares for $2,000, you would have made $1,000 capital gain. So capital gains are taxed either at the investor's ordinary income rate or the long-term capital gains rate, depending on how long they hold the investment. So if they hold the investment for more than a year, they get the long-term capital gains rate, which is basically the same rate as the qualified dividends rate, 15% for most investors. If they hold it for a year or less, they get their ordinary tax bracket on the capital gain. All right, let's look a little more in detail at investment income. All right, remember, this is one way that you can make money from securities. So corporate bonds, the interest payments are taxed at the investor's ordinary income rate, and this is true no matter how long you've held the bond. Right, those semi-annual payments, you report them on your tax form at the end of the year. You pay tax at your ordinary income rate. Qualified dividends. All right, so again, a qualified dividend, you would get the qualified dividend rate if it's a cash dividend that's paid by a U.S. corporation or a foreign corporation listed on a U.S. exchange, and you've held the dividend for at least 60 days. The rate is typically 15%. It's 15% for most investors, 20% for wealthier investors. Either way, it's lower than some of these ordinary income tax brackets would be. So the tax bracket, if it's not qualified, either it's not paid by a qualified corporation or you didn't hold the stock for at least 60 days, you'll still get the dividend. You just won't have to pay taxes on it at your ordinary income rate. You'll just have to pay the ordinary income rate. So say the ABC is paying a $1 per share dividend. All who hold the stock are going to receive $1 per share. An investor who holds the stock for more than 60 days, let's assume that ABC is a qualified corporation, and the investor held the stock for more than 60 days, they would pay taxes on that $1 per share at the qualified dividends rate. If somebody just bought the stock like 2 weeks ago and they haven't owned it for 60 days, the tax they're going to pay is their ordinary income rate, which is obviously going to be higher than the qualified dividend rate. Now, for a corporate investor, corporations investing in another corporation, for instance. So ABC Corporation is investing in XYZ Corporation stock. So any dividend that the corporation receives, 50% of that dividend amount is excluded from taxation. So that's a big tax benefit that the corporations have. This is why corporations oftentimes are the main investors in preferred stock known to pay dividends regularly. Corporations are the big time investors in preferred stock because of this 50% exclusion from taxation for dividends. So note that non-cash dividends, things like stock dividends, when a company issues additional shares of stock, issues stock instead of cash, are not taxed. Only cash dividends are taxed in the year in which the dividend is paid. Let's look a little bit about capital gains now. Capital gains, remember, capital gains tax applies when you sell securities buy securities at one price and then sell it for a higher price. You have a capital gain, and you will pay capital gains tax on that. Now, the way that you'll determine how much your capital gain is and then how much you're going to have to pay taxes related to it is by looking at the cost basis and the sale proceeds. So the equation to calculate the capital gains is sale proceeds minus cost basis equals capital gains. So let's look at what these things mean here. So cost basis is basically the amount that you invested. So the total amount that you paid out to purchase a security or securities is the capital gains. Now, if you paid a commission, broker-dealer affected the transaction for you and charged a commission, you would add that to the purchase price. So for instance, if you bought 1,000 shares of ABC at $49 a share and then paid a $1 per share commission, your cost basis is going to be $50,000, $49,000 total for the purchase, and then $1,000 total for the commissions. That's your cost basis. So one way to think about cost basis, the total amount of money you pay out of your pocket when you bought the securities. So the sale price plus the commissions you paid. Now, sale proceeds, basically the amount you take home from the sale. When you sell that security you already own, the amount of money you take home from the sale. So sale proceeds, if you pay a commission, you would have to subtract that from the sale, the total sale value. We talked about sale proceeds. Remember, the total amount that you take home. You're not taking home that commission that you paid because you're leaving that with the broker-dealer who you paid it to. For instance, you sold 1,000 shares of ABC at $60 a share and then pay another $1 per share commission. Your sale proceeds are going to be $59,000. The $60,000 you paid out for that sale minus the $1,000 you paid in commissions, the $1 times 1,000 shares. So for example, an investor that has a cost basis of $50,000, any sale proceeds of $59,000, their capital gains is going to be $9,000. Sale proceeds minus capital gains is $50,000 minus $59,000 minus $50,000 equals $9,000. If this individual held ABC shares for 1 year or less, 365 days or less, they will pay the short-term capital gains rate, which is their ordinary income rate. It's defined as a short-term capital gain if you hold it for 1 year or less. If they held the securities for more than a year, so 366 days or more, then they're going to pay the long-term capital gains rate, which is going to be 15% for most investors, 20% if they're like a corporate investor or like a wealthy investor. But again, in either case, it's going to be lower than their ordinary income bracket. So that's why oftentimes holding securities for a longer period of time is better for tax purposes than selling them in the short term, because the long-term capital gains is lower taxation percentage than ordinary income bracket. Now, in order to have capital gains tax, you have to actually sell the securities. An unrealized capital gain does not result in taxation. So if you bought the shares for $50,000 and now they're selling for $60,000, you still own them, you've got an unrealized capital gain and you won't pay taxes on that. The minute you sell them and lock in that capital gain, now you're going to have to report the capital gain on your tax form. All right, other tax incentives and capital losses. So we've looked at the positives on the last slide, making money from buying and selling securities, but that doesn't always happen. Sometimes you buy the securities at a higher price than you sell them for, and in that case, you would have a capital loss. Any realized losses, meaning you actually sold the security in a capital loss results, you can offset your capital gains with your capital losses on your tax form. So you can fully deduct capital losses against capital gains. So say, for instance, at the end of the year, you have $6,000 in capital gains. You have $10,000 in total capital losses. You can offset all of your gains and have $4,000 in loss left over. So you report to that net happening at a loss at $4,000. So with that $4,000 loss you still have left over, you can deduct $3,000 of it from your ordinary income. So if, for instance, you made $75,000 this past year and you have $4,000 in capital loss after you're done offsetting these gains and losses, you could subtract $3,000 from your $75,000 income. So now you would only have to pay taxes on $72,000 worth of income. But $3,000 is the maximum that you would be able to deduct. Even if your capital loss is offsetting like $100,000, the most you can offset your income is $3,000. Now the rest of that, if you have anything left over after you use that $3,000 to offset your income, you can carry over to the next tax year. So in this hypothetical, you'd have $1,000 left over after you use $3,000 of your $4,000 capital loss. You could carry that $1,000 over to the next year and use it to deduct any capital gains. And you could carry it beyond that. If the next year you don't use that money to offset anything, you could carry it over to the next year beyond that as well. Let's look at bond interest taxation. So for different types of bonds, which levels are they taxable? Federal level, state level, local level. Corporate bonds taxable at all three levels. You buy ABC Corporation's bond, the interest payment you're receiving from it is going to be taxable at the federal level, the state level, and at the local level. What about U.S. government treasury bonds? Treasury bonds are taxable, so the interest you receive from like a T-bond or T-note, for instance, taxable at the federal level, so the interest you receive is taxable at the federal level, but not at the state or local level when it comes to Treasury. What about municipal bonds? So municipal bonds, there are a couple of exceptions to this, but just in all cases, municipal bonds the interest is free from federal taxes. So a big benefit of owning a municipal bond is, especially for high income tax bracket investors. What about the state and local level? If the muni bond that you own was issued by a municipality in the state in which you live, then you would not pay state taxes. Okay, if it was issued in a different state, right, you live in state A and the muni bond was issued in state B, then you would owe state taxes on the interest you receive. But if you live in state A and the muni bond was issued in state A, then you would not owe state taxes. And also the locality you live in is going to determine whether you pay local taxes. So when the bond is issued at the municipality, if it's issued to the municipality you live in, you wouldn't pay taxes on the interest. If it's issued in a different municipality than you live in, then you would pay local taxes. Muni bonds are sometimes called triple tax-free bonds because they can potentially be exempt for taxation at the federal, state, and local level. What about government agency bonds? Bonds issued by agencies that are backed either directly or implicitly by the federal government itself. These are taxable at the federal and state local level. So if you have like a Ginnie Mae or Fannie Mae bond, the taxation will be triple taxed. State, local, and federal level, you pay taxes on the interest. All right, taxation, municipal bonds. Said a little bit to the last slide, but municipal bond interest is almost always tax-free at the federal level. There's a couple exceptions to this, private activity bonds, some Build America bonds, for instance, a couple of examples of muni bonds that might be taxed at the federal level. For the most part, if you just hear about a question, a general municipal bond, assume that it's tax-free at the federal level. It would also be taxed at the state or local level if you live in the state and municipality in which the bond is issued. So if I live in state A and it's issued in state A, I would not pay state tax on the interest received. If I'm in the municipality and it was issued in if it was issued in municipality A and you live in municipality A, you would not pay taxes either. But if it's municipality B, you may, right? So if it's issued in another state, you're always going to pay taxes. Investors also want to compare corporate bonds to municipal bonds. Compare what is the better take-home income for them. What we're talking about here is often an investor will look at a corporate bond and what its interest payment is and a muni bond is and what an interest payment is there, and then look at taxation. So after I pay all the taxes, how much money am I going to take home, and how much is that going to compare to the bond I would receive versus a corporate versus municipal bond. So there's a couple ways that you can do this. One is to take the after-tax rate on the corporate bond, the after-tax yield. So you get that after-tax yield, so basically the yield that you have left over after you have conquered the taxes that you're not paying on the muni bond. And if that number is higher than the coupon rate on the muni bond, then the corporate bond is a better investment. If that after-tax yield number is lower than what the muni bond is paying, then the muni bond is a better investment. The way that you calculate the after-tax yield, the equation for this, is the coupon rate on the corporate bond, so the percentage coupon rate times 1 minus the tax rate. So what is the tax rate? The tax rate, the taxes that the investor would not pay if they bought a given municipal bond that they would pay with the corporate bond. So we're talking about, you're comparing a muni bond to a corporate bond. What is the tax rate? Taxes you would pay if you bought a corporate bond that you would not pay if you bought a muni bond, right? So that, again, you would get some decimal there, and then you would multiply that decimal by the coupon rate of the corporate bond, and that tells you the after-tax yield of the corporate bond. You take that number, you compare it to what the interest rate is on the muni bond, and whichever is higher is the better investment for the investor. Okay, you can also, when you're comparing corporate and municipal bonds, look at what's known as the corporate equivalent yield, also called the tax equivalent yield of a municipal bond. So what does this do? This will tell you how high of a rate, an interest rate, you would have to get on a corporate bond to be as good as an investment as a municipal bond that you're looking at. So basically what you do here is you take the municipal bond's interest rate, right? There's a muni bond in the question we're looking at, and divide it by 1 minus the tax rate. Again, the tax rate is going to be the taxes the investor would pay on a corporate bond that they would not pay on the given municipal bond they were looking at. So with this number, it's going to tell you is you need to find a corporate bond with at least this high of an interest rate to be worthwhile buying instead of the muni bond. So for example, an investor from Maine wants to buy a municipal bond issued in Massachusetts. It has a 5% interest rate. The investor's federal tax rate is 25%, and their state tax rate is 5%. So what we're going to do here is we're going to figure out the corporate equivalent yield, which is going to tell us how high the corporate bond that they're looking at would have to pay an interest to be as good of an investment as that in municipal bond that they're looking at. So in this case, you would take the municipal bond's interest payment, which is 5%, so 0.05, and then you're going to divide that by 1 minus the tax rate. So what is the tax rate going to be? So you're going to subtract their federal tax rate because they would pay federal taxes on a corporate bond and they would not on a muni bond. What about their state tax rate? All right, so remember, you would subtract the state tax rate if the bond, the muni bond they're looking at, is issued in the state in which they live, because in that case, they would not be paying taxes on it, on the muni bond, and they would be paying state taxes on the corporate bond. So again, the tax rate is the investor pays for the corporate bond that they do not pay on the given municipal bond. So in this case, because the muni bond is issued in a different state than which the investor lives, they will pay state taxes on it. So you would not subtract that number from 1 because they're going to pay state tax whether they buy the corporate bond or this given muni bond because it's issued in a different state than they reside. So that means the denominator is going to be 0.75. You're subtracting the federal tax but not the state tax. So 0.05 divided by 0.75 gives you 0.0666. So you would have to find a corporate bond that pays at least 666% or 667% to be as good of an investment as the muni bond. So if you find a corporate bond that has a higher interest rate than 0.67, then the corporate bond would be a better investment than this given municipal bond. If the given corporate bonds are looking at a lower interest rate than 0.67, then the muni bond is likely the investment that you would go with, right? So that's what we're doing here is we're looking at the corporate equivalent or tax equivalent yield. Okay, so now let's look at taxation as it relates to the state accounts. An estate account is an account that's created in the account of somebody's death. The idea is the assets in the estate account are eventually going to be passed along to some beneficiaries, but in the meantime, they're going through probate and they're held within that account, right? So somebody can't own anything if they're dead. A fiduciary who oversees the estate account on the behalf of the beneficiary is the executor. They are usually appointed in the cease of will, final testament. All deceased assets are supposed to pass through an estate account. There are a few exceptions to this. Assets that cannot pass through a estate account. Assets are held in an irrevocable trust. Transfer on death account assets. The idea behind a transfer on death account is an individual account where you name a beneficiary, and when the account holder dies, the assets pass to the beneficiary without probate, a monthly estate, or looking at estate. Joint with rights or survivorship, JTRWOS account. So the assets in that, when the account holder dies, would pass through, to the other account holder without having to go to an estate account. So the last two do not avoid estate taxes, which are owed within 9 months of death. So whatever any estate taxes are due, they're owed within 9 months of that. So how do we determine whether an estate tax is going to be assessed to somebody's estate account? So basically the way you would do that is you take the current market value of the assets on the date of death or 6 months after if they've dropped in value. So like, what does that mean? Say the assets on the date of death were 10 million. 6 months later, they've dropped to 9 million. So 9 million would be the value that you'd apply when you're trying to figure out what the estate taxes due would be. If you have to pay, it's at the time of death of the deceased, right? So most estates do not owe estate tax. We're going to see in a second here, but usually the estate is worth less than $12.92 million. Estate taxes are not always owed, so most states don't have to pay estate tax. So trust accounts, these are other types of accounts that can be opened to manage somebody's assets. They're going to be passed on to somebody else. They need to have a trust document, name a trustee. The trustee is the one who receives the trust account. The will names the executor. If someone dies without a will, it's called an estate. And what happens to the assets is up to the state. The court will decide what happens to the assets, and you might not be happy with it, so it's important to have a will. If there's not an executor appointed in a will, then the state will decide what happens. The court will decide what happens to your assets. Let's look at more information associated with the state accounts, and then we'll move on to something else here. The gift tax exemption. So individuals are allowed to give up to $17,000 in gifts per person per year. Without going over the gift tax exemption amount. Now, this is unlimited between spouses, meaning that if the gifts you make are to your spouses, it doesn't matter the total value. Spouses can also combine their gift tax exemption, so $34,000 per year gifts between them. The inheritance tax exemption, so this applies to an estate's value, total of $12.92 million per year, unlimited between spouses. You can pass your inheritance tax exemption to your spouse and they can use it for state tax purposes. So basically what this is used for is when somebody dies or is valuing their estate, they're trying to determine whether they owe estate taxes or their estate taxes are owed on their estate. If the total value on the estate after you make deductions from it, like charitable deductions, funeral or administrative costs, is higher than $12.92 million, then you would have to pay state taxes on the difference. So if your estate is valued at $13.92 million, then you would basically be paying a state tax of $1 million, the difference between 13.92 and 12.92. Now, one spouse can pass along their inheritance tax to another spouse, and then the combined values are 12.92 times 2. This would apply to these estates. So if the estate is valued over the amount, you'd owe taxes on it. If it's under the amount, you would not. Another thing to keep in mind is if somebody goes over their annual gift tax exemption amount, that amount will be subtracted from their inheritance tax. So say that over the course of somebody's life, they went over their annual gift tax exemption by combined $1 million throughout their life. Your inheritance tax exemption, you would subtract $1 million from that. So in that case, their inheritance tax exemption would be $11.92 million. Let's look at cost basis in the case that securities is passed on from one person to another. What is the person who received the securities, what is their cost basis going to be? Because remember, this is important when you're trying to calculate capital gains if you sell the security. All right, so again, this rule applies to stocks, bonds, funded real estate, the rules we're going to be talking about here. So if somebody inherits securities, right, one person owns them, they die, transfer on death, leave them to somebody else. The heir, the person who inherits the securities, their cost basis is going to be the value of that security or asset on the date of the original donor died. So this is sometimes known as a step-up cost basis, assuming that they bought it at one price and it went up in value. It seems to be beneficial to the person who receives the security. In addition to that, the person who inherited the security, if they turn around and sell it, it doesn't matter how long they hold it for, they're going to get the long-term capital gains treatment. If somebody receives securities as a gift, one living person gives securities as a gift to another living person, the person who received the gift, their cost basis is going to be the lower of the original purchase price or the value of the securities on the date that the gift was made. And then their holding period is going to go along with whichever cost basis they get. If they get the original cost basis, their holding period would start the date that the original purchase was made. If they get the value on the date of the gift was made, their holding period would start at that point. Okay, so now let's look at examples. Say that in 1952, Grandpa buys a South Beach condo. He pays $50,000. Almost 50 years later, in 2025, it's worth $10 million. So what's the recipient's cost basis going to be? He's going to give it to somebody else either as a gift or somebody else inherits it. Okay, so say he gives it to somebody as a gift. Grandpa's still alive. He gives it to a gift to his grandson. The cost basis is going to be lower of the two values. The price that he bought it at, whatever the value is, and that means the grandson's cost basis is going to be $50,000. Now, if the grandson turns around and sells it right away, he will have a $9.95 million capital gain, right? He sells it for the market price of $10 million, and his cost basis is $50,000. He'll be paying taxes at the capital gains taxes on the long-term rate because his cost basis starts on the date that his grandpa bought it. What about if he inherits it? So if grandpa passes and the grandson inherits him, he leaves it in the will, the step-up cost basis, so the value on the date of death. That means that the cost basis for the grandson is going to be $10 million. Now, if he turns around and sells it, he's gonna have no capital gain. His cost basis is $10 million. He sells it for the market price of $10 million. He has no capital gain. He would have got the automatic long-term capital gains distribution if he did have a capital gain, but he didn't in this case because his value was the same as the value of the property. There was no capital gain, so there's no difference in value. He sold it at the market price, so he has no capital gain. All right, let's now shift our focus to retirement plans. When it comes to retirement plans, ERISA, the Employee Retirement Income Securities Act, is important. Basically, it regulates many corporate retirement plans. Now, ERISA rules do not cover, ERISA requirements do not apply to government retirement plans, like state and local governments, for instance, the FBI, New York Teachers Union pension. And the reason for this is the governments don't have laws to regulate these. That's why ERISA requirements do not apply to those plans. Now, when we're talking about ERISA plans, these are also known as qualified plans, and they come in two main varieties. But the defined contribution plan and a defined benefit plan also. The pension plan is the basic idea behind a defined benefit plan. So in a defined contribution plan, what we have here is a certain amount, usually a percentage of salary, is contributed as a legal obligation. The employee contributes a certain amount. They get to decide what percentage they need to contribute, and then the employer often matches up to a percentage of that. So the employee might contribute 10% of their salary. The employer might have to match up to 3% of that. A defined benefit plan. So with this, the benefit to be paid out is a defined known amount. So a certain amount of money will be paid during retirement as a legal obligation. The contributions, meaning the employee contributions, can be zero. Defined benefit plan, typically the way it works, some period of the person's employment career, the salary they received over that period, the average salary, they're promised some percentage of that, something like 60% of the last 10 years, 60% of the last 10-year salary they received annually or something, Defined contribution plan, you got investments in the plan. So certain percentages contributed each period is put into investments. So the overall value of the plan is going to be dependent on the success of those underlying investments within the plan. That's why the benefit is not defined, because it's going to fluctuate depending on how well the investments within the plan do. Defined benefit plan, the defined benefit to be paid out is a defined amount. So all corporate plans under ERISA are qualified plans. You might see tax qualified or qualified. The main idea behind a qualified plan is that contributions made to the plan are made tax-free. You don't have to pay taxes on the contributed amount on the year in which the contribution is made. All right, ERISA Rule 404C. This applies to 401k plans, which is a major type of defined contribution plan. So these plans, you're right, you're putting money into the plan and they're also investments. The idea is that if you put enough money into investments within the plan, as part of one of these plans, the plan is required under this rule to offer participants at least 3 investments alternatives, right? They choose the investments within the plan, but the plan now sponsor has to offer them at least 3 investment alternatives, and those alternatives need to be diversified, have materially different risk and characteristics when combined with each other, minimize risk through diversification. In addition to this is part of 404C. The plan participant needs to have the ability to diversify their accounts sufficiently to avoid huge losses and also to change their investments with the frequencies appropriate to the volatility of the investments, so they'd be able to change their investments with the frequency depending on how volatile the investments are, right? The frequency. So the sponsor, the company providing the plan, can offer its own stock as an asset class. If that company has issued a shared class of stock, they can offer it as an asset class as long as the stock is publicly traded and the participant will still get voting rights. We know when we get common shares in a company, you get voting rights. That goes along with that. And the rule released the fiduciary that's administering, overseeing the plan, liability for bad choices made by plan participants. But the participants is still liable for offering poor investment options. So as long as they follow the rules here, they are not liable if the plan participant makes bad investment decisions. But if they offer poor investment options within the plan, then the fiduciary could be liable. All right, let's look at a little more specifically at these types of qualified plans. First off, a defined benefit plan. But defined benefit plan is one in which the employer promises to pay the employees a specific benefit for life starting at retirement, so some specific amount of money. So these are managed by the employer, meaning it's the responsibility of the employer to make sure that the money that they owe employees is there when the employees retire. So if there are any investments within the plan, it's the employer that's making those investment decisions and funding them. At the end of the day, though, they are supposed to give their employees the amount of money that they're promised, no matter how well or poorly those investments are managed and how they do. So employees are entitled to the rest of the group benefits. That basically means that the amount that they own within the plan, if they leave a company before they retire, they still have access and rights to those benefits in the plan. The benefits are frozen and held in a trust for the employee until retirement age or unless they move the assets. At that point, they're supposed to start receiving those benefits, and they're usually paid out as a lifetime annuity, meaning they'll be paid out monthly for the rest of the person's life. Any withdrawals, any payments from the plan are taxed at the ordinary income rate. This is going to be true for all qualified plans. Any payments or withdrawals from the plan are going to be taxed at the entire amount of the withdrawal. Is going to be taxed at the person's ordinary income rate. So the pension plan is the best known defined benefit plan. All right, let's look at defined contribution plans now. Defined contribution plan, again, one in which the percentage of the salary contributed to the plan is set to some defined amount, and then the money goes into investments and the overall value of the investments fluctuate depending on what happens with the investment. A profit-sharing plan, a 401k, a 403b, a 403b, a 457, and a deferred compensation plan. Some of these are qualified, some of these are not. We're just going to run through each of them here. So a profit-sharing plan, with one of these, what happens, the employer contributes some fixed percentage of salary based upon a benchmark. Okay, so what does that mean? Under the terms of the plan, there's oftentimes like a formula with benchmarks. If the company's profits are above a certain level or at a certain level, the employer contributes X amount of salary. So if, for instance, just hypothetically, the plan says if our profits are $10 million this year, we will pay each employee 5% of salary. If they're 20 million, we'll pay each employee 7% of salary. If they're 30 million, we'll pay each employee 9% of salary. So that's the investment idea. But if every employee has the same percentage of salary contributed per year, so, and then the money within the plan that they use to invest, different investment options. So this is a qualified plan. 401k. So this is basically a salary reduction. Voluntary. So what does that mean? So basically the 401k plan, you select some percentage of your salary that you want to contribute to the plan. You could decide to contribute nothing. That's why it said it's voluntary. The employer matches up to a certain amount. So oftentimes the employer will match up to like 3%, or if the person doesn't make any contribution, the employer will put like 2% of salary into the plan. Again, the money within the plan goes to purchase different investments within the fund, mutual funds. Often this is a qualified plan, meaning they're employees. A 403b plan is also qualified. It basically works the same thing as a 401k. A 401k is basically for corporate employees, and a 403b is for employees of nonprofits like schools, churches, things like charitable organizations, for instance. A 403b plan is basically a qualified tax sheltered annuity. So tax sheltered in that you make pre-tax contributions, you don't pay taxes on the contributions you made to the plan. The investments that you made to a 403b plan are mutual funds and annuities. Those are the only investments allowed in the plan. So this is an example of an annuity sort of plan that is qualified. You make pre-tax contributions because most annuities we're talking about, like variable annuities, the contributions you make are after-tax contributions. You pay taxes in the year they're made. The 403b plan, you've got pre-tax contributions. All right, a 457 plan, again, this works as essentially the same way as a 401k. You contribute some percentage of salary to the employer matches up to a certain percentage. You have investment in the plans. The difference here is it's only for government employees. 401k corporate employees, 403b nonprofit employees, 457 government employees. Now, we talked a little bit earlier about how government plans are not ERISA-based plans. So ERISA can't regulate them. So 457 is not an ERISA-based plan. So one of the characteristics that applies to ERISA-based plans is every employee in these plans has to be treated the same way. They have to be offered the same thing, the same percentage contributions, same investment options within the plan. 457 plans are not ERISA-based plans, so they aren't subject to the same rules. So one of the things that goes along with that, they can be discriminatory in their nature, meaning they can offer one employee in their nature, one employee one thing and then another employee something different. A benefit to these plans is they don't have a penalty for early withdrawals. With other types of plans, we're talking about the ERISA-based plans. If somebody makes a withdrawal before they're 59 and a half, they'll be subject to that 10% penalty. Typically, with a few exceptions, they'd have to pay a 10% early withdrawal penalty, but that does not apply to 457 plans. The last one here, deferred compensation plan, basically with this is a non-qualified plan. So the company basically offers to top-level employees only. Basically, the idea there is that they defer their compensation till later on when they retire. They give them some of their compensation at that point. Usually, they're in a lower tax bracket, so there are tax benefits that go along with a deferred compensation plan. This is the only one that offers bankruptcy protection. All the other ones, like the 457 plan as well, they don't. If the business or the company is going through trouble, is bankrupt, the assets within the retirement plan are kept separate from the company's other assets. So if they have to liquidate, sell off their assets in a bankruptcy proceeding, the retirement plan assets are not at risk. It would not be sold hands off of that. With a deferred compensation plan, though, you would not have that protection. All right, let's now shift our focus to individual retirement accounts. Everything that we've looked at has basically been employer-based retirement plans. Now let's look at an IRAs and traditional and Roth IRAs. So an IRA, an individual retirement account, anybody can open one as long as you have earned income, because only earned income can be contributed to one of these plans. You don't have to work for any specific company to open that company's retirement plan, right? So there's two basic type of IRAs we're going to deal with here: a traditional IRA and a Roth IRA. So let's look at the basics behind these. Traditional IRA, contributions are made typically with pre-tax dollars. Now, if somebody's got an employer-based plan, a traditional Roth IRA, then their contributions might be made with after-tax dollars, but a traditional IRA is the only retirement plan they have where contributions would be pre-tax dollars, meaning you aren't taxed on those contributions on the way in, on the year you make them, right? They're taxed on the way out on a traditional IRA. Any contributions need to be made from earned income, right? Money you earn from your job, right? So something that's not earned at your job, like money you would make from your investments, portfolio income, dividends, income, capital gains, cannot be used to fund a traditional or a Roth IRA. The money you can contribute has to be earned income. So that's a traditional IRA. A Roth IRA, contributions are always made after tax, meaning you pay taxes on the contributions in the years made. What about withdrawals? So you start taking money out of your traditional Roth IRA. If you're not yet 59 and a half years old, with a traditional IRA, you're subject to a 10% penalty on the early withdrawal amount. You'd have to pay whatever taxes you owe on it, plus a 10% penalty. There are a few exceptions to this rule, like if the money is used and withdrawn to qualified medical expense, or up to $10,000 for a first-time home purchase. If it's made to death or disability, those are a few examples for death or disability, a few examples, but most withdrawals would be taxed at 10% before 59 and a half. Required minimum distributions, just about all retirement plans, you have to start taking the money out at a specified date. RMDs start at the year after they turn 73. So if you turn 73 this year, the latest you can start making withdrawals is April 1st of your next birthday. So with a Roth IRA, if there's a Roth IRA, there's a 10% penalty if withdrawals are made before 59 and a half. Same things that the traditional IRA had. There are no RMDs. Roth IRAs are the one major type of retirement plan does not have required minimum distribution made. There's no date by which you have to start taking withdrawals. What about the taxations of those withdrawals? So with a traditional IRA, assuming that it was a pre-tax contribution, whenever you take the money out, the entire withdrawal is going to be taxed at your ordinary income rate, the principal plus any earnings. If you made the contribution after tax, then you already paid the tax on the contribution. You would have to pay taxes when you take it out, but the earnings on the withdrawal would still be taxed. With a Roth IRA, you've already been taxed on that principal, so it's tax-free. Now, the earnings on a Roth IRA, if you've had the account for at least 5 years and are at least 59 and a half years old, your earnings are tax-free. That's the benefit of a Roth IRA. You don't owe any money to Uncle Sam. Most people, that by the time they start taking money out of their retirement plans, they've had the account for 5 years and they're over 59 and a half years old. And if that's the case, you don't pay any taxes. Any withdrawal will come out tax-free. You pay tax on the way in. So the contribution limit, this is the annual contribution limit. This is $6,500 for both. If you're over 60, you can contribute an extra $1,000, or over 50. If you have a traditional and a Roth, if you contribute $4,000 to a traditional, the most you could contribute to a Roth is $2,500. So it's combined, right? The earnings are allowed to go tax-free if you take the money out with a traditional Roth. You've had the money in the account for at least 5 years. You're 59 and a half. The money wouldn't be taxed at all. Let's look at some more retirement plan taxation. Now we're going to look at the qualified, non-qualified Roth. We already looked at that a little bit. We'll say this stuff again. With a qualified plan, you made pre-tax contributions, right? That means that you don't pay taxes in the year that they're made. So if you made $75,000 this year and you contributed $5,000 to your qualified retirement plan, you would only pay taxes on the $70,000 this year. You would not pay taxes on the contributed amount in the year you made it. The contributed amount is tax deferred, so you don't have to pay until you take taxes out or take money out. So any withdrawals are going to be 100% taxable at your ordinary income rate, not the capital gains rate. It doesn't matter how long the money's been in the retirement plan when you take it out, it's taxed at your ordinary income rate. What about a non-qualified plan, like a variable annuity is a good example of this. So any contribution with a non-qualified plan, that means after tax, you still pay taxes on it on the year in which it's made. The growth in income is tax deferred, so whenever you make withdrawals, it's partially taxable. Earnings is taxed. The contributions are not taxed because you already paid taxes on those contributions. A Roth IRA, we talked about this, but let's look at it again. Contributions are asked after tax. Roth IRAs are not available for high earners. You don't need to know the phase-out requirements, but if you're in the $200,000, $250,000 plus income category, typically you won't apply and get to the benefits of contributing to an IRA. Growth in income is tax-free, and then the distributions would be 100% tax-free as long as you've had the money in the account for at least 5 years and you're 59 and a half. The contributions are always tax-free when you take them out, no matter how long you've had the money in the account, because you've already paid taxes on them up front with the earnings. As long as the account's been open for 5 years and you're at least 59 and a half, then the earnings would also come out tax-free. Now let's look at other types of accounts, kiddie accounts. So what we're going to look at here, 529 plans and Coverdell EHAs, basically education savings accounts. We'll look at other types of custodial accounts as well. So they die behind educational savings account. You open the account, you put money in the account, you have investments in the account. As long as the money from the investments is used to cover a qualified educational expense, you can withdraw it free of tax. If you use the money for something other than a qualified educational expense, then you would typically have to pay 10% penalty and have to pay federal tax on that, the amount withdrawn to pay for something else. All right, let's look at the two different educational savings plans, 529s and Coverdells. So with both of these, the contributions are made after tax. So that means that you still pay taxes on the contribution in the year in which it's made. So a Coverdell is not available to high earners. It's a phase out to these. If you're over a certain income limit, you can't contribute and participate to these. 529 plans, anybody can contribute. What's the annual contribution limit? A 529 plan, these are issued by different states, so each state has its own limits, but they're usually pretty high. They can be in the hundreds of thousands of dollars per year. For Coverdell, they're pretty low. $2,000 maximum per recipient per year. The growth in income, tax deferred, meaning you don't pay any taxes on it until you take the money out. What about the distribution? How is that taxed? Meaning when you take money out of the plan, how is that taxation going to go per year? All right, so the 529 plan, any withdrawals would be tax-free as long as you use the money to use a qualified educational expense. So what is a qualified educational expense? All right, so it's a little bit different depending on what level of education we're talking about, because college or grad school level, most expenses associated with those levels are qualified. Tuition, books, room and board fees. Use the money to cover those. College, school, grad level, you don't have to pay taxes. For primary and secondary school, like a private middle school, private elementary school, private high school, up to $10,000 in tuition per year, but nothing else. Up to $10,000 in tuition per year would be qualified educational expense, but things like books, room, board would not at those levels. All right, for Coverdell, most expenses related to education across the board, no matter the level. It can be used for all level of education. Also with the Coverdell, you have to use it by the time the beneficiary, the young person associated with the plan, equals 30 years old. If they're over 30, then the tax benefits are not applied and you'd have to pay federal taxes. And usually 10% penalty as well, and that applies to 529 plans too. If you use the money to cover something that's not a qualified educational expense, the drawback to that is you pay a 10% penalty and you still pay federal taxes. If you use the money to cover a qualified educational expense, you don't pay taxes. Flexibility, you open the plan for a beneficiary. What happens if that kid doesn't want to go to college or go to school? You can transfer it to somebody else, right? As long as it's a relative. 529s and Coverdells. Let's look at custodian plans now on the right. So a custodian plan, the most basic type here, the one that you're most likely to be tested on, is an UGMA or UTMA account, Uniform Gifts to Minors Act, or Uniform Transfer to Minors Act. The idea here is that an adult opens an account. There's one adult and there's one minor with the account. The adult manages the account. They're the fiduciary within the account. They make the investment decisions. Any money contributed to one of these accounts is after tax, meaning you can't deduct it from your income. There's no limit. as far as contributions go, the gift tax rule does apply. If you put more than 17,000 in a year within one of these accounts, you would exceed the gift tax limitation. What about the taxation here when you take money out, growth and income? So 100% is taxable at the parent's income bracket after the first 2,500 in earnings. So if this year we took $10,000 out of Little Ray's UGMA account, the first 2,500 would be tax-free. The remaining 7,500 would be taxed at Big Ray's tax bracket, the parent, right? So the minor in the account, when the account is open, you might see a question that asks whose identification goes on it. The minor's social security number goes on the account. The assets in the account are basically considered the assets of the minor. They officially become the assets of the minor with an UGMA account. When the minor becomes an adult with an UGMA account, some other date that's named, it can't be later than 25. So it has to be between when they become 18 and 25, transferred officially to the possession of the beneficiary on the 25th birthday, right? So any gifts made into one of these accounts is irrevocable. It cannot be taken back. Once you put the money into the account, you can't take it back, can't take it out of the account. So let's look at Social Security. So Social Security having to do with retirement and money somebody can get on when they retire. So Social Security is basically federal retirement benefit system. It's funded by both the employee and the employer contributions. So every year you look at your paycheck when you get it, there are Social Security contributions that go in there. They take it out of your paycheck, but the employer is also contributing. So Social Security, in order to receive it, you have to have worked for some minimum amount of time, available to individuals who have worked for a minimum amount of years. They're also available to non-working spouses. A non-working spouse can receive up to 50% of their working spouse's Social Security's benefit. So what that means is that if your benefit's going to be like $2,000 and you got a non-working spouse and they qualify, the other spouse would get $1,000. You get $2,000, they get $1,000. So you'd be able to combine to get $3,000 total. In order to be eligible for Social Security, you need to work for at least 10 years, 40 calendar quarters. The earliest stage at which you can begin taking these benefits is age 62. Now, if you started at that earlier stage, the benefits are going to be partial. So if you choose to start at 62, the amount you get per month is going to be less than if you waited till you're 70, right? The full benefit starts at 67. So if you wait until you're 67, start receiving the benefits, you'd receive the full benefits. If you wait till you're 70, then the amount you would receive would be increased. Now, what about for a divorced individual? So say that you're married to somebody that worked for a long time, but now you're divorced from them. Would you be able to claim any of their benefit? Yes, as long as you were married to that individual, you're now divorced from them for at least 10 years. If you're 62 and have not remarried, and at that point, you would be able to receive that 50% of that benefit. So we talked about earlier, a non-working spouse who's still married. In this case, we're talking about when you're divorced, as long as you were married to them for at least 10 years and are 62 and not remarried, then you can receive up to 50% of that working spouse's benefit separately, meaning if their benefit's $2,000, they get $2,000 and you get $1,000 in that case. Trading securities and performance measures. So here we're going to look at securities trading in the secondary market. The secondary market is when securities traded from one investor to another investor. This is opposed to the primary market, which is the initial period in which securities are sold from the issuer's security to the investor. So primary market, securities sold from the issuing company, typically with the assistance of an underwriter to investors. The issuing company, the underwriter is taking the proceeds. The secondary market, securities traded from one investor to another investor, typically with the broker-dealer. You're serving as a go-between or selling out of its own inventory. That's the secondary market. So when it comes to trading on the secondary market, let's look at some important terminology. Okay, an exchange. An exchange is either the physical location or electronic system on which listed securities are traded. So an exchange-listed security, say it's listed on the NYSE or the NASDAQ, and it trades on that exchange. So exchange trading can be auction-based, meaning any physical location on a trading floor like the New York Stock Exchange or other regional stock exchanges. With an auction-driven market, you're called either a specialist or a designated market maker, setting the bid and ask prices, the buy and sell prices for that security, and then selling out of its own inventory and then buying for its own inventory. That's an auction-based exchange. Or exchange trading could be electronic. The NASDAQ, automatic quotations, a primary exchange, right? So in which orders are matched electronically, and there are multiple market makers setting the bid and ask prices on those securities. In order to sell a security on an exchange, it has to be listed on that exchange, and there are requirements to go along with the issuing company that they need to be able to meet in order to have their securities listed and sold on exchange. So to be listed on an exchange like the NYSE, New York Stock Exchange, or NASDAQ, a stock needs to meet the requirements. So for your exam, the specific listing requirements are not really something that you need to know, but there are a couple things that you might want to know related to this. For instance, on NASDAQ, each stock that lists on NASDAQ has to have at least 3 market makers. The market makers are basically the dealers who are selling, buying from, into, and selling out of their own inventory and setting the bid and ask prices, basically setting the market, making the market in that security. So having at least 3 market makers ensures liquidity. It also prevents some sort of competition. You know, it kind of can do with price fluctuations, right? So market makers on NASDAQ are basically agreeing to offer a bid and ask. The bid price is the price that they'd pay you to buy securities from you. The ask price is the price in which ask prices which they'd sell you securities for. So the bid and ask, they make a markup and markdown, right? So when it comes to trading hours, it's 9 a.m. to 4 p.m. Eastern on the NYSE and NASDAQ. These are the major exchanges on which securities are traded in the United States. Okay, other terminology related to securities trading on the secondary market: over-the-counter, OTC, over-the-counter. This is a fragment of a market where broker-dealers, market makers, and others trade securities. So now we're talking about securities being traded away from exchanges, over-the-counter, right? We talk about the auction market or other electronic-based exchanges, listed securities traded on their exchanges, over-the-counter. We're talking about securities being traded off of exchanges. All right, so what's traded OTC? Stocks, bonds, currencies, derivatives. OTC markets are less regulated than exchanges. There's not listing requirements for securities to be traded over the counter. That's a big part of this. And that means that this is typically a more volatile security and less transparent than exchange-traded securities. There are basically 4 different ways that securities can be traded on the secondary market. So we say there are 4 kinds of market going over the secondary market. So let's run through each of those here. The auction market, also known as the first market, this is where listed securities are traded on a physical exchange floor. This is where you have a designated market maker that sets the bid and the ask prices for each of the securities listed on that exchange. The New York Stock Exchange is a primary example of an auction order-driven market. There's other regional markets as well, like the Boston, Chicago auction markets, but we're talking about a physical location. The second market is a type of negotiated market. There are 2 components to the second market. The NASDAQ, basically electronic exchange where you buy and sell orders are matched electronically. You've got multiple market makers setting the market prices. Only listed securities can be traded there. And the second component of the second market is the over-the-counter market with unlisted securities. So securities that are not listed on exchange being traded over the counter. So again, 2 components to the second market: NASDAQ and the OTC market with unlisted securities being traded. The third market is another type of negotiated market. On the third market, you have institutional investors and broker-dealers trading listed securities over the counter. So these securities are listed on some exchange, but like the New York Stock Exchange or the NASDAQ, but they're being traded off of those exchanges over the counter. Now, only institutional investors can trade on the third market. So regular retail investor, if you want to buy a NASDAQ listed security and you're a retail investor, you've got to buy it on the NASDAQ. If you're an institutional investor, however, you could choose to buy it either on the exchange or over the counter. So the third market basically provides competition for the exchanges, right? The fourth market is another type of negotiated market. Now we say that these are negotiated markets. the second, third, and fourth market. But the reason they're negotiated markets is because you have multiple market makers setting the bid and ask prices. So in theory, an investor can negotiate a different price. Okay, they don't like one market maker's price, they could look at another market maker's price. Whereas with the auction order driven market, you have one designated market maker setting the bid and ask prices for each securities listed, no negotiation going on to the first market. I'll go on back to the fourth market. This is another type of negotiated market. On the fourth market, it's direct anonymous trading between institutions. You have listed and unlisted securities traded by institutional investors, and you don't need a broker-dealer to broker the transaction for them. So what does that mean? So typically, when a trade is made on the secondary market, an investor is buying the securities and they need a broker-dealer to effect the transaction for them. It's either one investor selling to another investor with the broker-dealer brokering the trade, or one investor buying the security from the broker-dealer. But in either case, you need the broker-dealer involved. On the fourth market, you don't. The fourth market, Corporation A could sell their securities directly to Corporation B without a broker-dealer serving as the go-between. Direct anonymous trading between institutions. It's also called the ECN, Electronic Communications Network market. This is where securities are listed and traded there on the ECN. In the dark pools, the component of the fourth market, basically where you have large institutional investors trading large blocks of stock, 10,000 shares or more anonymously. So who's trading them is not known with a dark pool transaction. Let's look at some other important terminology when it comes to trading securities in the secondary market. Bid prices and ask prices in the bid-ask spread. The bid price is the highest price that a buyer, in this case we're talking about a market maker or dealer who is selling securities from their inventory. The highest price they're willing to pay. That is the bid price. The ask price, sometimes also known as the offer price, is the lowest price that a seller, again, we're talking about a market maker or dealer who has the security in their inventory, he's willing to sell for. So you go into a gold bullion dealer and buy gold from them, right? The ask price, the lowest price they're willing to charge you to buy that from them, right? So the bid-ask spread is the difference between the bid and the ask prices. So something that's important to know about the bid-ask spread, it's narrower for high volume securities. So if there's lots of trades taking place in that security, the bid-ask spread will typically be a narrower spread than if there are fewer trades taking place in this security. So it's higher for them to be traded less liquid securities. So why is that? Let's think about that for a second. How would a market maker make money? They're buying securities and selling securities at a different price. They make money by charging a markup or a markdown, paying less money to buy the security than when they sell the security. So the bid price is lower than the ask price. Now if they're making lots of trades in the security, they can have a narrow bid-ask spread because they can pay one amount and then charge just slightly more, because if they're making lots of trades, they can drive their profits up. If they're not making lots of trades in that security, they have to have wider spreads, a bigger spread between the price that they paid for it and the price that they sell it for in order to make money. That's a large reason anyways why premiums or bid and ask spreads go up and down, right? They get narrow on a high volume and wider when you have low volume. Here's an example. ABC stock has a bid-ask spread of 50-55.75. That means the market maker is willing to sell the stock to the investor for no less than 55.75, the ask price, and buy from the investor than no more than 55.50. So again, bid price, highest price they're willing to buy at, ask price, lowest price they're willing to sell at. All right, so let's look at some order types that might be entered in the secondary market. First off, a market order. A market order is an order to buy or sell a security at its current market price. Okay, so you like the price the security is trading at, you want to buy it, you want to do a market order. You like the price it's at and you own the security, you want to sell it, you would enter a market order to sell. So a market order to buy is filled at the lowest asked price. A market order to sell is filled at the highest bid price. Market orders usually fill quickly, they usually filled right away. If you're talking about a security that's listed on an exchange, it has a trading market and volume, the market order is almost always filled right away. Now the market order is only good for the day in which it's entered unless it's marked good till canceled, right? But it's possible that an OTC order has a wide bid-ask spread. There's not a lot of people that are trading it. It's possible that your market order doesn't execute. by the end of the trading day, but the market order is only good for the trading day. If you see a question on the test, which of the following order is most likely to be filled, and market order is one of the answers, that's the answer you go with. A limit order, that's the second type of order. So this is the type of order to buy at a maximum price or sell at a minimum price. So the best you're willing to take. So that means the buyer or seller basically sets a limit. The buyer is willing to pay no more than X. The seller is willing to accept no less than X, the limit price. All right, so the limit price for a buy order is placed at or below the current ask price, bliss below, slobs above, bliss below. So buy orders are typically used when the investor wants to buy at a lower price than the market price. So they're waiting for the market to come down to that limit price, but they don't want to pay any more than that limit price. Okay, so for instance, the security is trading at $50 and you want to buy it, but you don't want to buy it unless the price drops to 49. You'd place a buy limit, bliss below. The price drops down to 49, and then you would buy it, right? As long as the order is executed, you get $49 or less. If it's above 49, it won't be elected, right? You buy it with the buy limit order. The limit price for a sell order is placed at or above the order price, slobs above. Typically used when an investor wants to sell above the market price. So you're waiting for the market price to come up above the limit price. So in this case, you hold a security, you already own the security. You're willing to sell it if its price goes up to a certain point. So I own the security, it's trading at 50, and I say, well, I'll sell it if it goes up to 51 or higher. So I set a limit at 51. If the price goes up to 51 or higher, the order would become a market order and only execute if it's executed at that specified price or better. If that limit order price is hit and you can get the security at that limit price or better. So for example, a buy limit order, you could get it that market price or lower. In the case you could get it that a sell order, you could get it the limit price or higher. So a stop order, also known as a stop loss order, this is an order to buy or sell a security once it hits a specific price. Once that price, known as the stock price, is hit, then that order turns into a market order and is filled at the next available market price. There's no limit. So a sell stop is basically used to prevent losses or protect profits. Limit losses or protect profits. So a sell stop order is when you already own the security and you're worried that its price is going to drop. So you want to set a limit. If it drops to this level, I want to sell it. For example, Marge owns a stock trading at 35, but she's worried it's overpriced and its price may soon drop. So to protect the gain she's made at the stop on the stock, she set a stop order at 40. That means if it hits 30, it will be sold, no matter what price the market is. Once the stop price is hit, it's like a trigger. Stops are triggers. It turns into a market order and executes at the next available market price, right? Stops are just a trigger. So if it's in free fall and the price hits 30 and before you can execute and the market price is down to like 29, she's going to get her order filled at 29. So there's no or better. It's the next available market price is what she's going to get. In contrast to a limit order, remember that limit price is the absolute best you're willing to take. In the case of a best in the buy limit, the absolute highest price you're willing to pay, and a sell order, the absolute lowest you're willing to sell it for. With a stop order, once the stop price is hit, it's just a trigger, turns into a market order, and executes at the next available market price. A buy stop, at whatever that is. A buy stop is ordered at a price above the current market price. It's used when you have an open short position. You shorted shares of securities, you borrowed them from your broken dealer, you sold them to somebody else, and at some point you're gonna have to buy them back and return them to your broker. When you got an open short position, you want the price to drop so you could buy the securities back for a lower price. You might be worried that the price is going to go up, so you might set a buy stop order above the current market price, and then if the price does go up and hit that stop price, the order will turn into a market order and execute, covering your short stock position. Last type here is a stop limited order. It combines a stop order and a limit order. So you get two prices in it, a stop price and a limit price. So remember, with a regular stop order, once it hits that stock price, it turns into a market order, stops or triggers. With a stop limit order, once it hits that stop price, it turns into a limit order. It will only execute at that limit price or better. So if the price of the security passes the stop price, then the order becomes a limit order. So a sell stop limit order is used when an investor wants to protect against a downward trend in a long position. They want to put a limit on how low of a price they're willing to sell their stock at. They might be worried that the market is volatile and their price is going up and down rapidly. So if it hits a lower price, they want to sell it, but they're worried the price is going to plunge too much and then come back up again. So they set a limit. The stock might be trading at 30 and they set a stop at 29 and a limit at 28.75. So if the stock price drops quickly and hits that stock price of 29 before it can execute, it's below 28.75, it's below that price, the order would not be filled at that point. The investor would still own the security. A buy stop order is used to protect short selling gains and also protect the investor from purchasing the stock at too high of a price if there's a sharp increase. So you'd set a stop price with a buy stop order. A stop price is above the current market price, and then that limit price is somewhere above that. So it might be trading at 30, you might set the stop price at 31 and the limit price at 31.50. So if the price hits 31, the order will turn into a limit order, but before it can execute the order, that has to have gone above 31.50, would not be filled unless it's gone over that 31.50 limit. So let's look at slobs above and bliss below. Slobs, plus, right? These are different, this is an analogy you can use to help remember where market orders are priced and set with the security. So for orders placed over the market price, remember slobs. Sell limit and buy stop. That means that you would place, when you enter these orders here, a sell limit, it's above the current market price, or a buy stop would also be entered above the current market price. So remember, a sell limit order is one that is always placed. You own the security, you want to sell it, but you only want to sell it if it goes up to a certain price. You set that price above the current market price. A buy stop, you got an open short position. You want to sell the shares if the price goes too high. So you set the price over the current market price. Bliss, right? Place below, right? Bliss below. BL, buy limit. SS for sell stop. So buy limit, remember, you're looking to buy that security, but you're waiting for its price to drop. You've been watching it. It's dropped lower and lower and lower. You believe it's going to hit this certain amount. And you set that price, that buy limit price, underneath the current market price. When it drops to that price or lower, the order would be executed. A sell stop, when you already own the security and you're worried its price is going to drop too low, so you set a sell stop below the current market price, right? So you might see a question on the test that says something like, which of the following orders would be set above the current market price? And right, so they'll give you, you look for a buy limit above, over, slobs above. So if it's over, SL, BS, right, it would be sell limits or buy stops, and look for a bliss below, right? Let's look at some measures of return related to securities, performance measures. First off, let's look at annualized return. So annualized return is basically an investment's gain or loss measured in terms of a year. So the way you go about calculating annualized return is by taking the holding period return and dividing it by an annualized period of time. The holding period return is basically taken by any appreciation in value plus any income on the security while you hold it. Divide it by your original purchase price. So for instance, your security gained $500 in value and you got $100 in dividend while you hold it, holding $600 total. You paid $1,000 for it. 600 divided by 1,000, that would be 60% gain. That would be your holding period return. Now, once you have that holding period return, you would annualize it to get the annual life term. So how would you annualize that holding period return? So the annualized based on a monthly amount of time, right? If you're given a number of months that the investor held the security, you would divide the number of months by 12 and put the resulting decimal in the denominator. So for example, the investor held the investment for 9 months. You would basically divide 9 by 12, 0.75, and then you put that number in the denominator. So if their total holding period return was 50% and they held it for 9 months, 50% divided by 0.75, that would give you your annualized return. Now, if they give you the amount of time based upon a daily amount, you held it for X amount of days, how would you annualize that in your numbers to put in the denominator? you divide the number of days by 365, right? There's 365 days in a year. So for instance, the investor held the investment for 200 days. 200 divided by 365.53. You put that in the denominator and then divide that number into the holding period return to get your annualized return. So again, annualized return, you take your holding period return and divide it by some annualized period of time. Let's look at some comparative returns now. First, the real rate of return, also known as the inflation rate of return, adjusted rate of return. This is calculated by taking total return and subtracting the inflation rate as a measure by the CPI, the Consumer Price Index. So remember, the total return is any appreciation or depreciation in a security's value plus any income, dividend or interest received divided by the original purchase price. That's how you calculate total return. So once you have that percentage, you would subtract the inflation rate from it. So if the total return on an investment was 6% and the inflation rate is 2%, your real rate of return would be 4%. The after-tax return basically takes that total return and multiplies it by 1 minus the tax rate. So the tax rate is like the investor's tax bracket. So basically it removes the tax that the investor will pay before it considers the return. So say that the total return is 5%, the investor's tax rate is 25%, it would be 5 times 0.75 would be the investor's after-tax return. That's how you calculate it. The current dividend yield basically takes the annual dividend somebody receives or expects to receive from holding the stock and divides it by the purchase price. So this is basically based on projected dividend payments, which might not always be accurate. It also doesn't take into account the growth in share price. It's simply looking at the expected annual dividend and dividing it by the price that somebody paid for the security. Okay, standard deviation is a way to measure variability in an investment, how much its value fluctuates. So if a security's return fluctuates a lot, then it has a high level of standard deviation, a high SD. To investors, more volatility means higher risk. So investors require compensation for taking on a higher level of risk. So securities with high standard deviations tend to have higher expected yields than securities without them. It's important to remember a point for the test. If two securities have the same return and are returning the same percent with different standard deviations, the security with the lower standard deviation is the better investment. You're getting the same return for taking on a lower level of risk. In that case, so that would be the better of the two investments. Let's look at some central tendencies relating to this return. The mean is the average rate over time, so it's taking the average return. The geometric mean is the average return including compounding, like compounding interest. So for example, if an individual invested $1 in year 1, the investment gained 20%. In year 2, it lost 10%. And in year 3, it gained 20%. Let's look at how that would play out and compound the interest. So in the first year, the investor gained 20%. So their adjusted principal is $1.20. In the second year, they lose 10%. So that means their overall principal would be 90% of that 120. They lost 10% off of that 120. So now they've got $1.08. In the third year, their $1.08 grows by $1.08. So now their adjusted principal is going to be $1.30, 1.296 rounded up to $1.30. The median is basically the center of returns given with an incentive number. So if, for example, if you have 5 values and 5 numbers in your returns, 10, 9, 6, 5, and 3, the median is going to be the middle. You just range them from in order. And the middle value is 6, that's your median. The mode, the most frequent. The order, the number that occurs the most frequently is the mode. So if you got 5 different returns and you got 1, 1, 1, 2, and 3, 1 occurs the most frequently, so that'd be the mode. And the range is the difference between a high and a low. So if you have values ranging from 10 to 3, your value would be 3, high minus low. Or high to low. Standard deviation, we basically talked about, is the volatility on returns. So basically you measure the variability of returns to the relationship of that investment. So you look at the standard deviation compared to the overall returns between different investments. All right, the Sharpe ratio. This is another measure to look at, and this is basically a measure of risk-adjusted return. The formula for the Sharpe ratio is the mean or actual return minus the riskless rate, usually the rate on a risk-free or low-risk investment like Treasury bills, divided by the standard deviation. So again, mean or actual return minus the riskless rate divided by the standard deviation. So a high Sharpe ratio suggests a high performance investment that comes with low risk. Standard deviation is the denominator, helps measure the risk associated. So a high Sharpe ratio usually would be a lower standard deviation. A lower Sharpe ratio would adjust a performance for taking on a higher risk. You get a higher number in the denominator. The standard deviation is higher. The Sharpe ratio is lower. So the Sharpe ratio is often used to determine whether to add an investment to a portfolio or not, right? So given the return, given the risk, is this an investment worth adding to an investor's portfolio? All right, a few questions. Total return is an appropriate measure of performance for 1 common stocks, 2 preferred stocks, 3 bonds. A1 only, B1 and 2, C2 and 3, D1, 2, and 3, all the above. So remember, total return evaluates appreciation or depreciation investment plus any income received while you held it divided by the original purchase price. So this can be used for all 3 of these investments: common stocks, preferred stocks, and bonds. So even if an investment doesn't have any income associated with it, sometimes common stocks don't pay dividends, so they don't have income associated with it, but still, you'd still have appreciation or depreciation in value. So the correct answer here is D, 1, 2, and 3. Okay, here's a little longer question. An individual age 42 who is laid off from their job at a major corporation has decided to work for themselves as to purchase a Dunkin' Donut franchise for $200,000. After 1 year, they receive an excellent job offer from another company and decide to return to the corporate workforce. They put their franchise up for sale and receive an offer for $210,000. Over the time frame that they own the franchise, the inflation rate is measured by the CPI increased by 2%. If they sell the franchise, their real rate of return will be 0, 2%, 3%, or 5%. Okay, so in order to do this, basically we're calculating the real rate of return. The real rate of return, I'll put the equation on the board here. I'll put the RRR, real rate of return, equals total return minus inflation rate. So now we're going to have to solve for total return. We know the inflation rate is 2. Inflation increased by 2%, so we need to basically figure out what the total return is. The total return, how you calculate it, appreciation / depreciation in value plus income divided by purchase price. All right, we're not given any income here. All we're told is the franchise went up for $200,000 and they sold it for $210,000. So basically, we aren't going to take that $10,000 appreciation. We're going to divide it by the $200 purchase price. 10,000 divided by 200,000 is 0.05, 5%. So that's the number, the total return. 5 minus the 2% inflation rate gives us a real rate of return of 3, and that is the answer. Answer C to this question. So that's how you do it. Remember, real rate of return, total return, minus the inflation rate. Now let's shift our focus to duration. So what is duration? Duration applies to bond investments. Basically, the duration is the length of time that it takes an investor to get back their original investment, basically including the annual interest payments. So you buy a bond for X amount of money over the next several years. You know, you're receiving those interest payments semi-annually. The amount of time that the interest payments add up to what your purchase price was, that's essentially what the duration is measuring. So I can buy a bond that has a 7-year duration, a 30-year bond with a 7-year duration. It has a 30-year maturity. That means on the maturity, you get the par value. It has a 7-year duration. That means that it takes 7 years before you receive your total purchase price, the original cost of the bond. Now, why is duration important? Well, it's a good way to measure the volatility, that the fluctuation of the bonds market price So the longer the duration, the higher the volatility, the more market risk that goes along with that bond. So for instance, you have a 30-year ABC bond fund that has a 7-year duration and a 30-year XYZ bond with a 5-year duration. The higher the duration, the more volatile. So the bond with the 7-year duration is going to see its market price fluctuate more when interest rates move than the bond with a smaller duration. So the duration number, you can use that duration number to figure out how much you can expect the bond's market price to move with interest rate movements. So basically the bond's duration represents the percent of price change that you can expect to see with a 1% change in interest rates. So if interest rates go up by 1%, you would expect the bond's market price to go down by the percentage. That's the number of their duration. So an ABC 5% bond has a duration of 10 and XYZ 7% bond has a duration of 8. If interest rates rise by 1%, you would expect ABC's market price, the bond's market price drop by 10% because duration of 10. You would get to see you would expect XYZ's market price to drop by 8%. 1% change in interest rate movements, the duration tells you the percentage of the bond's market price, the price percentage you'd expect to fluctuate. Fantastic job. You've completed Chapter 3 of the educational lecture for the Series 65, Client Profiles, Recommendations, and Analysis. This is hard material, and you're doing so well sticking through this and working on becoming an investment advisor representative. Now it's time you go over to millionairesintraining.com and take the Chapter 3 subchapter finals and the chapter final. Really practice this information until you can get high scores, 80s, 90s, and if you're real serious, 100% are exams on Millionaires in Training. Each subchapter test and then the chapter final. Moving on to the finals and combination of midterm, Chapter 1 and 2, and then Chapter 3 and 4 combination exams. Do all of these in sequence and don't skip out on any of them. You're preparing for a test, and we've structured this exactly what you need to know for each chapter to test you thoroughly on the video lectures you're learning. So test on millionairesintraining.com, and we will see you in the next lecture. Let's look at the State and Federal Securities Act and the regulation of securities professionals. Securities are regulated at both the state level and the federal level. The Uniform Securities Act, or USA, covers many of the specifics that go along with state registration. The USA requires the registration of broker-dealers, agents, investment advisors, and investment advisor representatives. So all these entities that are part of the securities industry. Federal law also covers some aspects related to securities regulation. There are some few important federal laws that you'll want to know about. The Securities Act of 1933 deals with the registrations of securities and their initial sale in the primary market. It's the first act, new issues in the primary market. The Securities Exchange Act of 1934, the second act coming after 33, deals with the secondary market. Deals with things with the registration of broker-dealers and registration of exchanges, entities involved with trading of securities from one investor to another. The 34 Act also involved the creation of the SEC, the Securities Exchange Commission, which is the government regulatory body that oversees the securities industry. A third federal law is the Investment Advisors Act of 1940, which deals with the registration of investment advisors. Much of this chapter deals with the registration of securities professionals. Different professionals like broker-dealers, investment advisors, agents, and investment advisor reps. And when those entities need to register at the state level or federal level and how they go about registering at the state and federal level. It's also important to understand the definition of each of these entities. So we'll start out by dealing with a broker-dealer. So let's look at the definition of a broker-dealer and then look at some of the information related to the registration of broker-dealers. So what is a broker-dealer? So under the Uniform Securities Act, a broker-dealer is a person who effects transactions in securities for others or for its own account. It can be a natural person, being a living, breathing human being, but it's usually a firm. It's usually a legal entity. There are cases where you got sole proprietorship broker-dealers, which is just one individual serving as a broker-dealer, but far more often than not, it's often a firm that employs individuals and affects securities transactions for its own account or others. Now, a broker-dealer on a given transaction can act either in a broker capacity or a dealer capacity, never both at the same time. But what do these mean? So when a firm acts in a broker capacity, it means that it is affecting trades for the account of others. So it makes money by charging a commission. So basically think of it as if they set up a trade between two parties, but they are not trading for their own inventory. So they help to affect the transaction and receive a commission or for affecting that transaction between two parties, kind of like a middleman takes a commission. On the other hand, when the firm acts as a dealer capacity, it means that it's selling securities that it owns out of its own inventory or buying securities for its own inventory into its own account. So when the firm acts as a dealer capacity, they make money by charging a mark up or mark down. You may see broker transactions also referred to as agency transactions. Dealer transactions are referred to as principal transactions. Who are broker-dealers? So we looked at what a broker-dealer does. They affect securities transactions either for their own accounts or they help set up a trade between other parties, and they receive compensation for affecting those trades. Who would not be a broker-dealer? Who or what is excluded from the definition of a broker-dealer under the Uniform Securities Act? All right, so BAITs. B-A-I-T-S is the mnemonic to remember here. So banks, deposit-taking institutions, not considered broker-dealers. Agents are the people who work on behalf of a broker-dealer and affect transactions. But they don't have to register as broker-dealers, they have to register as agents, also known as registered representatives in the FINRA world. Issuers are companies, rather entities, that issue their own securities and then sell them in the primary market. They do not need to register as broker-dealers. Trust companies and saving institutions, other types of depository institutions or financial institutions, they do not have to register as broker-dealers. So remember, do not take the BAITs, B-A-I-T-S. All right, so now we know what a broker-dealer is and which entities are excluded from the definition of a broker-dealer. Let's look at state registration requirements for a broker-dealer. So provided that the entity is a broker-dealer, when would it need to have to register in a given state? All right, so if a firm is a broker-dealer in a state, then it needs to register in that state if it has an office in that state, or they affect transactions with even one retail customer, meaning non-institutional client, within the state. Okay, so remember, if they have an office in the state, they have to register no matter who they are, right? Or who they affect transactions for. If they don't have an office in the state, but they affect transactions for any retail customers in that state, they would also need to register in the state. A retail customer is a non-institutional customer. An institutional investor, right? An institutional customer is a company that's in the business of investing. So usually larger financial institutions that are in the business of issuing or investing in securities are considered institutional investors. It'll never be a retail investor. So an individual, right? A living, breathing human being is never considered an institutional investor. They'd always be considered a retail investor. A little bit further on, what are institutional clients? So state law is designed to protect the average investor, i.e. the new investor, living, breathing individuals, walk and talk, right? Maybe want to trade securities. State laws are primarily concerned with protecting the little guy. It's not true to say that state laws do not protect institutional investors at all, but the majority of the laws are designed to protect the retail clients and retail investors. The assumption is that institutional investors, usually larger institutions, can watch out for themselves a little bit better. They know what they're doing. They have enough money to withstand some of these financial losses, and they don't need as much protection under state law. So who and what are these institutional investors who can fend for themselves for the most part? Banks, savings and loans and trust companies, large monetary organizations, insurance companies, investment companies, like mutual funds, closed-end funds, pension and profit-sharing plans, as long as they have 1 million or more in assets under management. And then anyone else also designated by the state securities administrator. So if an entity is not within this grouping, but the administrator determines them to be an institutional investor, they would be an institutional investor. So as long as a broker-dealer or investment advisor, we haven't gotten to investment advisors yet, but they're not physically located in the state, and the only client they have in that state are institutional clients, they would not need to register in that state, right? So no office, no retail, no register. Remember that analogy. If their only clients are institutional clients and they don't have an office in the state, then they don't need to register in that state. All right, so now let's look at, again, a little bit more about when would a broker-dealer need to register in a given state. All right, so here's a little bit of flow chart here. One way to go about when you see questions like this on the exam, you know, ABC broker-dealer has an office in state A, it has no office in state B, but it has retail clients there, it has no office in state C, but it has institutional clients there. Which states does it need to register in? That's an exam type question that you may see. So one way to go about answering this type of question is there's basically two questions that you ask yourself. If the answer to either of them is yes, then the broker would need to register in that state. The first question is, do they have an office in that state? Do they have a place of business in that state? If the answer is yes, then they need to register in that state. If the answer is no, now you ask the second question. The second question is, do they have any non-institutional clients in that state, meaning retail clients in that state? If the answer is yes, they need to register. If the answer is no, they do not need to register. So an exam question might say, ABC broker-dealers have an office in state A. They have no office in state B, but 20 retail clients there, and they have no office in state C, and their only clients there are insurance companies. Which states do they need to register in? So we'll go through this question asking process. Do they have an office in state A? In state A, we said they had an office. The answer is yes, they have to register in state B because they have more. They don't have an office in state B. Its answer is no to the first question, but do they have any non-institutional clients? They said they had 20 retail clients, so that means yes, they have non-institutional clients in the state. They need to register in state B. So far we have states A and B. State C, they didn't have an office, so the answer to the first question is no. We said their only clients there are insurance companies, which are an institutional client, so they don't need to register in state C, at least in that hypothetical. So yes in state A because they have an office, yes because in state B because they have retail clients, and no to state C because they have no office and no institution, or only institutional clients in state C. So no office, no retail, no register. All right, so exemption from registration. A little bit more here, meaning a broker-dealer doesn't have to register in the state if it's exemption, right? As long as it has no office in the state, and as long as it only conducts business there with existing clients or that they are temporarily. This is the snowbird rule. So ABC broker-dealer is registered in state A. They have no office in state B, and their only client there is on vacation in state B. They would not need to register in state B if the client's living there for 6 months or less. If they're living there in state B, you know, they're a snowbird, they go to Florida for the winter. Now, if the client was permanently living in that state and the broker-dealer wants to continue doing business with that client, then the broker-dealer would need to register in that state. So same example, ABC, is it registered in state A? If they're not registered in state B, but now when if their client moves to state B and they want to continue working with that client, they would need to register in state B. All right, here's a question. A broker-dealer receives critical information about a corporation in which one of their customers has invested. The customer's vacation in a state in which the broker-dealer is not licensed. Which statement is true? A, the broker-dealer must be registered in the state to contact anyone in that state. B, the customer may be contacted only if the information received is going to affect the corporation's securities negatively. C, the customer may be contacted only if the information received is going to affect the corporation's securities positively. Or D, the customer may be contacted while on vacation in the other state, regardless whether the broker-dealer is registered in that state or not. So the correct here is D, right? The customer is on vacation in that state. The broker-dealer can continue to do securities transactions and business with that customer while the customer is vacationing in that state. So D would be the correct answer in this one. All right, let's look at rules for Canadian broker-dealers. These also apply to Canadian agents, which are people who work on behalf of the broker-dealers who effect securities transactions for them. So when does a Canadian broker-dealer need to register with a U.S. state? So a Canadian broker-dealer or agent would need to register in an American state if that broker-dealer or agent had an office in that state, had a physical address, meaning they could hang a chandelier, a location, right? They could show up and go to work, right? No matter who their customers are, if they have an office in the state, they need to register there. In some cases, a Canadian broker-dealer agent can obtain what's known as limited registration and work with clients in the state without going for the full registration process. As long as they have no place of business in this state, they're already registered properly in Canada, and any of the following applies. So their clients in that state are institutional clients, their clients in the state are temporarily in the state, or all transactions for those clients take place within the Canadian self-directed tax advantage retirement plan based on the Canadian version of an IRA. So if the broker-dealer or agent is not registered in the state and any of those apply, their clients are all institutional clients, or their clients are temporarily in the state, all the transactions take place within that retirement plan that's specifically designed for Canadian accounts, then the broker-dealer agent would not need to go through a full state securities registration. They could obtain this limited registration and continue working with the client. All right. Let's look a little bit more about broker-dealer registration. If a broker-dealer wants to do any interstate transactions, meaning transactions that have aspects in different states, you're involved with customers or issuing companies. Intrastate would be in the state. Interstate would be multiple states, right? So basically all broker-dealers do, they have some business in other states. They cross the state lines. Then they need to register with the SEC. And FINRA and the SEC's, any self-regulatory organization, FINRA and broker-dealer, is the SRO, broker-dealer registration. This is part of the Securities Exchange Act of 1934, registration of broker-dealers, right? Deals with the registration of broker-dealers, People Places Act, right? One exception to registration for really, really small broker-dealers who only engage in trust businesses. They don't have customers in any more states than one. It's only intrastate, right? They don't engage with issuers or broker or any other customers from other states. These are very limited scope broker-dealers. Most broker-dealers register with the SEC. But they also register in at least one state, right? A state in which they have an office, but sometimes they register in other states as well. It also says here that they're registering with FINRA. So most broker-dealers, the firms, are registering with at least 3 regulatory states: the SEC, FINRA, and the states that they do business in. 3 regulatory entities, right? So when we're talking about SEC registration, that is done via Form BD, the broker-dealer form, right, through FINRA's gateway system. That's how they submit that form. FINRA, the form is NMA, New Member Application Form, also through the gateway system of FINRA. And then via that gateway system, they would need to submit U4 forms, the registration forms for their registered employees, like their agents, registered representatives, or they're working for broker-dealers, and any U5, the U5 is the termination form. So they have to submit all the registration forms for the agents, and then any subsequently, and then when the agents are terminated, they would have to submit U5 forms via the gateway system. And broker-dealers almost always have to join the Securities Investor Protection Corporation, SIPC, which basically backs up customer deposits and funds in the case that the broker-dealer goes bankrupt. So we think about this. Broker-dealers are almost always registering with 4 different entities, registering or joining: the SEC, FINRA, states, and local, in which they have office or do business with retail clients, and they're also joining SIPC, typically. That's all part of a broker-dealer's registration process. All right, let's now shift our focus to an agent of a broker-dealer. An agent is basically the individual who works on behalf of the broker-dealer and affects transactions. It's NASA's version of a registered representative. So FINRA would be registered representative, NASA would be agent. So it's a person who represents an issuer, or sometimes agents work for securities issuers, and we'll look at that in a minute. It says that RR in parentheses because the FINRA term, and the one that's probably more prominent in the industry, is registered representatives. But we're taking a NASA exam. The NASA exams, like the 65 and 63, are referred to as an agent. That's why we use the word agent here, because that's the word you can expect to see on your 63, 65, and 66 exams. So agents of a broker-dealers are independent contractors of broker-dealers who affect securities transactions for compensation. They need to be registration, and this registration rule needs to be the same as what it was for broker-dealers in any state in which they have an office, do business with, or non-institutional clients. So if they have an office in the state, they have to register. If they have even one non-institutional client in that state, they'll also have to register in that state. If they don't have an office in that state and their only clients are institutional clients, that would be a case in which the agent does not need to register in the state. Officers and directors of broker-dealers. are automatically registered as agents when the broker-dealer application is filed with the state if they perform the duties of an agent. So an officer, director, partner of broker-dealer would be registered as an agent, would be required to register as an agent if they perform the duties of an agent, meaning if they effect securities transactions on behalf of customers. However, if that officer, director, or partner is if all they're doing is supervising and they're not affecting securities transaction, then they would not need to register as an agent. If they're just supervising individuals, right? So the same two questions, the flow chart here, does the agent of a broker-dealer need to register? So the exact same thing as we looked at broker-dealers, in effect, is the broker-dealer or broker-dealer agent, same reference. The first question, do they have a place of business in the state? Yeah, if the answer is yes, they need to register. You can move on to the next state at that point. The question is giving you 3 or 4 different states and asking you about registration processes in each state. If they have an office in one of those states, the answer is yes, they need to register there. If the answer is no, you ask that second question, do they have any non-institutional clients, meaning retail clients? If the answer is yes, they need to register. If it's no, then both of those questions, the answer is no, then they would not need to register in the state. If you can remember the state registration requirement for a broker-dealer, you can remember it for an agent. One thing worth saying here is that just because the broker-dealer that employs the agent is registered in the state doesn't mean that the agent needs to register there, right? It's entirely possible for a broker-dealer to have offices in 7 different states and retail clients in 10 additional states or so. So that broker-dealer has to register in 17 states, but the agent only has clients in 1 or 2 states. So the agent would only have to register in the states in which they have clients in that case. The broker-dealer needs to register in all of the states where they have office or clients, but it's entirely possible that the agent that works for the broker-dealers has more limited scope over where they're going to have clients, so they would only need to register in those specific clients in which, or specific states in which they have clients in. So when it comes to state registration of an agent, who would not be considered an agent, who would not need to register as one, there are employees of broker-dealers who don't need to register as agents. Employees of issuers as well. We'll also look at issuers in agent registration requirements. If they're strictly clerical, right? If they're clerical customers type rules, strictly, then they would not need to register as an agent. They're not performing the duties of an agent. They would not need to register as one. So if they don't solicit or accept orders, then of course they don't affect transactions for individuals. But in addition to that, if they don't give investment advice or accept orders, then they don't need to register as an agent. It doesn't say it on here, but additionally, IT professionals who work for broker-dealers, as long as they're not affecting customer transactions or taking orders, would also not need to register as an agent. We already said that officers, directors, and partners, broker-dealers, of issuers don't have to register as an agent as long as they don't perform the duties of an agent. Here's a question. A broker-dealer uses some summary returns when answering the telephone and gives stock quotes and takes messages for clients. The summer interns A, are not required to be registered in the state of agents because of their temporary status. B, are not required to be registered as agents in the state because they are performing clerical functions. C, must be registered in the state because they are transacting securities business with the public. Or D, must be registered in the state because they are working for a broker-dealer. All right. So these individuals are basically performing clerical functions. They're answering the phone, giving codes, and taking messages, right? They're not performing duties of an agent here. The answer is B here. They're not required to be registered of the state because they're performing clerical functions. Remember, not all individuals who work for broker-dealers need to register as agents. All right, so who would not be considered an agent in a state? Who else? Who, in addition to clerical employees we just talked about? They don't have to register in the state if they don't have to have a place of business in the state. Existing clients are on vacation in the state. Similar to the broker-dealer rule here, that individual must have been a client with the firm for at least 30 days before going on vacation in the other state, provided that's true. It's not a brand new client. They've been a client for at least 30 days before they go on vacation in the state. The agent doesn't have to register in the state where the vacation client is. So, for example, Peter is an agent with ABC Broker Dealer. He's registered in Iowa. He has a client named Marianne who's in vacation in California. She's been a client of Peter's for the past year. Today, Marianne calls Peter and asks him to buy 1,000 shares of stock A. Because she was a client of his for more than 30 days, and she's temporarily on vacation in California, Peter doesn't need to register there to make the transaction for her. Note, however, that if that client were to move permanently to that state, right, they'd move to that state, then the agent would need to register in that state if they wanted to continue working with the clients. The same rule basically apply as to the broker-dealers with vacationing clients and clients who move to that state. So now let's look at the cases on which people who work for issuers of securities might have to register as agents. So what do we mean here? So we're talking about here is when a company issues securities, stock, or bonds and sells it to the public investors, right? A government agency issues bonds and sells it to investors. Sometimes people who work on behalf of those issuers and sell the securities are considered agents under the Uniform Securities Act and would need to register in that state, but not always. There are exemptions. So somebody works on behalf of the issuer, sells that issuer's securities. They're sometimes considered an agent and sometimes not. So let's look at when they would be exempt from the definition of an agent. So if the representing issuer and selling exempt securities on behalf of the issuer, securities that don't need to be registered before they're sold, under the USA, they would not be defined as an agent. They would not need to register as such. So for example, an individual who conducts a sale of a new issue general obligation bond for a municipality, that is an exempt security. Right? Municipal bonds are exempt from having to register. That individual will not need to file as an agent. They're selling exempt securities on behalf of the issuer. Or if the issuer or agent is only conducting exempt transactions to sell the issuer's security. That's another exemption. They would not be defined as an agent. For instance, things like state-level private placements, federal-level private placements, Regulation A, securities transactions that are exempt from federal registration. So in that case, they would also not be defined as an agent. It would not need to register. Another exemption from the definition of an agent is when an individual works on behalf of the issuer and processes transaction in that issuer's securities for employees, fellow employees of the issuer, but is not compensated specifically for doing that. But the best example of this is when companies issue stock options to their employees, the employee can affect the stock option and buy shares of the company's stock, and say somebody who works in human resources in that company, they help the fellow employee affect the transaction to buy the stock, but they're just paid their hourly wage. They're not given any extra money for affecting the transaction. That human resources person, they would also be exempt from the definition of an agent and would not need to register as such. Now, if they were compensated, say they get like $10 for every, securities sale that the fellow employees that they make, then they would have to register as an agent, provided that they're not compensated. They would not have to be. These are examples of people who work on behalf of the issuer and sell the issuer's securities or help people buy the issuer's securities. They're exempt from the definition of an agent, but if somebody works on behalf of an issuer and sells non-exempt securities or engages in non-exempt transactions, right? Somebody works on behalf of ABC Corporation and sells their non-exempt securities, meaning they need to be registered, so those securities need to be registered, then that individual would be defined as an agent. It would need to register as an agent under the Uniform Securities Act. All right, here's a question. Which of the following individuals is defined as an agent under the Uniform Securities Act? 1, an individual who represents a broker-dealer selling exempt securities to the public. 2, an individual who represents a broker-dealer selling securities that's on a national stock exchange. 3, an individual who represents an issuer or a transaction. 4, an individual who represents an issuer in a transactions with existing employees without accepting a commission. So A, 1 and 2 only, B, 2 and 3 only, C, 1, 2, and 4, D, 1, 2, 3, and 4. So if you represent a broker-dealer and sell any securities, you're an agent. It's only if you represent an issuer and sell exempt securities or engage in exempt transactions or sell those securities to fellow employees and don't receive a commission for it that you're exempt from the definition of an agent. So 1 and 2 would be agents here. So they work for broker-dealers and affect transactions. 3 and 4 would not. They work on behalf of an issuer in an exempt transaction, or they are selling those securities to fellow employees and not receiving compensation for an issuer and not accepting any commissions for that. So 3 and 4 are a correct answer choice. So choice B would be the correct answer to this question. Let's now shift our focus to investment advisors. But first, let's look at what an investment advisor is, and then we'll look at the registration requirements for them. So an investment advisor is a person, meaning it's usually a firm, that provides advice for securities given directly or indirectly issued in analysis reports, or provided in financial planning business. So the idea here is that they're providing advice about securities in one of these forms. They do this as part of their regular business, and they're paid for it. Receives compensation. So ABC, advice, business, compensation. Advice, regular business, and receives compensation for it. If they do each of these things, then they would be considered an investment advisor and would need to register as such under the Uniform Securities Act, right? So there are entities that are exempt from the definition of an investment advisor. Let's look at those. Investment advisor reps, these are the living, breathing individuals who actually offer the investment advice on behalf of the investment advisory firm. They need to register as an investment advisor reps. They need to pass the Series 65 and register as investment advisor reps, but they do not register as investment advisors. Sticking with securities professionals entity in the industry, broker-dealers are also exempt from the definition of investment advisors as long as they are not compensated specifically for giving the investment advice, meaning charging a fee. If they're compensated for effecting transactions or via markups or markdowns, if they're selling out of their own principal inventory, then they would not need to register as an investment advisor. Even if they are giving investment advice, broker-dealers and their employees often do, they make suitability recommendation determinations and offer investments based upon that and offer investment advice to clients. But as long as they're not specifically paid a fee for giving that advice, they're exempt from the definition of investment advisor, right? Broker-dealers get paid on commissions. The LATE exemption, lawyers, accountants, teachers, engineers who give advice that's incidental to their practice. So you're working with accountants doing your taxes, and maybe they mention to you that maybe this year it might be a good idea to buy treasury securities or talk to this investment advisor about buying a mutual fund. You know, they're not charging a fee specifically for giving you the investment advice. It's incidental to their business. Banks, savings and loan trust companies, they're regulated under federal state banking laws. They all also don't have to register as investment advisors. Publishers of newsletters, magazines. So you could use Plate, all right, publishers, you know, they don't give investment advice specifically on investment information, but they publish an article on stocks that say the stock ABC are maybe a good consideration to buy, but they're not considering anybody's specific investment characteristics, suitability information in making that recommendation. They would not need to register. And also anybody whose advice is solely about U.S. government securities. So the only advice that the entity offers is about treasury securities, government agencies securities, for instance. They are also exempt from the definition of investment advisor. Another entity that is exempt from the definition of an investment advisor is a federal covered advisor, an FCA. Now, a federal covered advisor, it's a little bit confusing because they do the exact same things that investment advisors do. They provide investment advice. It's part of their regular business. They receive compensation for it. The difference between a federal covered advisor and an investment advisor is who they register with. Federal covered advisors register with the SEC. They register federally with the federal government, not with any states in which they do business. So important point to remember is for federally covered, right, you don't have to register with the state. A federal covered advisor, sometimes it's called a state registered investment advisor. A state registered investment advisor registered at the state level, but not the SEC. A federal covered advisor is registered with the SEC, but not any states in which they do business, right? So who or what would be a federal covered investment advisor? Larger advisors with more assets under management, right? So if their assets under management are over $110 million, they are required to register with the SEC instead of the states. Or if they're, and there's a floor, it goes down to 90, right? They bounce back up to 110, right? Or if they're an advisor manager, if they advise pension plans with over 200 million in AUM, or they're a fund managing agency, right? In any of those cases, they would have 110 plus AUM, advisor to an investment company, advisor pension plan with over 200 million AUM, they would need to register with the SEC, not at state level. Now, there's other cases in which an investment advisor can choose whether to register with the SEC or with the state. If they do business in 15 or more states, they've got clients or locations in 15 or more states, they can choose to register with either the SEC or the states. If they're an internet advisor, meaning basically all their advice is provided online, they can have no more than 15 non-institutional clients per year. They could choose to register with the SEC or states. Or they reasonably believe that they'll be eligible for federal registration within the next 120 days. So they're registered in 14 states and they reasonably believe that they're going to get registered in 15 states and they're going to, then they can choose to register with the SEC. So in addition to this, if the investment advisor has AUM of between 100 million and 110 million, they can choose which they want to register with the SEC or the states. Again, with that floor being at 90. So once they hit 100 million, they can choose. I don't know who anybody who was 100 million plus wouldn't choose to register with the SEC. But going forward, even though a federal covered advisor does not need to register in any states in which they're going to do business, there still are certain things that they need to do before they can work in the state. So if a federal covered advisor has a place of business in the state or had more than 5 non-institutional clients in the state during the past 12 months, he needs to report on his Form ADV, which is his registration form, advisor form, Form ADV, and then the SEC will basically send a copy of the ADV to each of the states marked on it. So each of those states that have been notified, right, noted that on Form ADV, the SEC will send them a copy of the ADV. So it'll basically let them know that the investment advisor is doing business in their state. And then they will typically be required to pay a filing fee to the state administrator or do a fee share, and then also send copies of the registration forms for each of the registered employees, Form U4, who work in the realm of the state, right? This is known as notice filing. So federal covered advisors, before they work in any state, they don't need to register there, but they do need to notice file. What's on the slide that describes right here between the notice filing. Remember, notice filing is not the same thing as state registration. So any questions that asks you one way or another, a federal covered advisor or registering in the state, they do not register in the state, they register with the SEC but do a notice filing. So this is different from broker-dealers. Broker-dealers almost always register with the SEC and the states. An advisor either registers with the SEC if they're federal covered advisor or with the state if they're a regular state registered investment advisor, never both. You won't register at both the state and federal level. Let's shift our focus now to state registered advisors, basically state advisors that are required to register at the state level, usually smaller firms is what we're talking about here. Most advisors with less than 110 million in AUM register at the state level. So that means they don't register with the SEC and they're not subject to SEC regulation. They're only regulated by the administrators of the states in which they do business, right? You have an office or retail clients. So state registered investment advisors only deal with institutions. Their only clients are institutional clients, which we described a little bit earlier. So a firm is considered an IA in the state, but it's only required to register in that state. So we're talking about if it's a state registered advisor. It isn't required to register in the state if it has no office there and it only deals with institutions in the state. So if it has an office in the state, it would need to register there, provided we're talking about state registered, non-federal covered advisor. But if it doesn't have an office and its only clients are institutional clients, it would not need to register. No office, no retail, no register. So state registered investment advisors that are dealing with retail customers, so what is the rule for registration here? So an IA is exempt from registration in the state as long as it has no place of business in the state. So it's an out-of-state firm and it does business with no more than 5 retail clients. You could also see it listed as fewer than 6 over a 12-month period. In a specific state, this is the de minimis exemption, basically Latin for so few that it doesn't matter, no more than 5 than a 12-month period, provided they don't have an office. If they have an office in the state, then they need to register there. If they don't have an office in the state, they can have up to 5 retail clients in the state before they would need to register. De minimis doesn't apply to broker-dealers. It's important to reinforce this. The de minimis exemption only applies to an investment advisor. Remember, if a broker-dealer or agent has any retail clients in the state, they need to register, even one. An investment advisor without an office in the state can have up to 5 retail clients over a 12-month period, reaching the de minimis. Once they get that 6th, they would need to register in the state. All right, so here is our full chart and our questions for a non-federal covered advisors, meaning state covered advisors, and when they would need to register at the state level. First question, do they have an office in the state? If the answer is yes, they need to register in the state. If the answer is no, you ask the second question, have they had more than 5 retail or non-institutional clients in the state in the past 12 months? If the answer is yes, then they would need to register. If the answer is no, they would not need to. And again, this question process, when you see exam questions that ask you about, they give you a hypothetical example, like several states involving an investment advisor for each state, asks the 2 questions. If they have an office, the answer is yes, you can move on to the next state. If the answer is no, you ask that second question about de minimis. Here's a question. An investment advisor with 120 million in assets under management has a main office in New York and a branch office in Connecticut. Which statement is true? A, the investment advisor must register in the state of New York only. B, the investment advisor must register in both the state of New York and the state of Connecticut. C, the investment advisor must register with the SEC only. D, the investment advisor must register in both the state of New York and the state of Connecticut and must register with the SEC. So remember, once that investment advisor's AUM gets above 110 million, they are federal, SEC only, federal covered advisors. So this one has 120 million, doesn't matter which states they do business in, they're going to be federal. They don't have to register in any of them because they're registering with the SEC only. So choice C is the correct answer to this question. Second question here. Which statements are true about an investment advisor with an office in state A? 1, if the investment advisor's only clients are investment companies, the investment advisor must register with the SEC. 2, if the investment advisor's only clients are insurance companies, the investment advisor must register in the state. 3, if the investment advisor's only clients are insurance companies, the investment advisor must register with the SEC. 4, if the investment advisor's only clients are insurance companies, the investment advisor must register in the state. 1 and 3, 1 and 4, 2 and 3, 2 and 4. Okay, so remember here, if an investment advisor has investment companies or investment companies as a client, it would need to register with the SEC in every case. It doesn't matter what their AUM is. They have an insurance, an investment company as a client, they need to register with the SEC. So 1 would be correct here. Roman numeral 1 would be correct here. Now, insurance companies are institutional clients, but having an insurance company as a client does not require SEC registration. So if your only clients are insurance companies, we don't know what the AUM is here, so we're not going to deal with that. Their only clients are insurance companies, they're registering at the state level, not with the SEC. So that would be choice 4. So choices 1 and 4. So B is the correct answer to this question. Now let's deal with investment advisor representatives, IARs. So who or what is an IAR? Let's stress the who here, because an investment advisor rep is a person, a living, breathing human being, a person, right? So, well, there's more than one definition of a person, right? It's an employee. They're employed by as an investment advisor or a federal covered advisor. So when we're talking about IARs, they're employed by an advisory at either the state level or a federal covered investment advisor, who basically gives securities advice, makes recommendation, or gives advice about securities, manages accounts and portfolios for clients, solicits, offers, or negotiates the sale of advisory services. So somebody who works for an investment advisor and solicits clients on the behalf of that, the investment advisor or IR would also be considered, right? So supervises employees or to perform any of these functions would also need to register as an IAR. So when we talked about broker-dealers and whether officers, directors, or partners need to be registered as agents, if all the broker-dealer officer or director did was supervise somebody else, but they didn't affect some securities transactions, they did not need to be registered as an agent. It's different for investment advisors. So if somebody works as an officer or director at an investment advisor and they supervise people who give investment advice, they would need to register as an investment advisor representative. So note specifically excluded are individuals who only perform clerical, ministerial, that's the term the exam might use. We don't really use it that often, but ministerial means clerical function. Ministerial means clerical functions. If that's all they do on the behalf of the IR is offer investment advice, they don't offer investment advisor services and they just do clerical work, they would not need to register as an investment advisor. IAR. All IARs are state registered investment advisors. They must register in any state in which they have business or more than 5 non-institutional clients within the past 12 months. Same rules that applies for the employing firm. So remember, state registered non-FCA advisor has to register in any state in which it has offices or 5 non-institutional clients in the past 12 months. The rule is the same for the employee, right? The employee and the employer. Right, it's a little bit different for IARs who work for federal covered advisors. So the IAR works for a federal covered advisor. They only register in the states in which they have business. If they don't have a place of business in the state, they don't register there no matter who their clients are. So for example, Jessica is an IAR who works for Big Time Advisors, a federal covered advisor. So her firm registers with the SEC. It's a federal covered advisor. So she has an office in state A. She also has 10 retail clients in each states B, C, and D. She would need to register in state A because she has an office there. She would not need to register in states B, C, and D because she doesn't have her office there. It doesn't say she has an office in those states. She works for a federal covered advisor, only the states in which she has an office. It doesn't matter whether her clients, how many clients are in that state, how many office or retail clients in that state, she doesn't need to register there. If the IAR works for a state registered advisor there, then it would matter how many retail clients they happen to have in that state and the company has the office. So it's also important to remember, so even though her firm doesn't register at the state level, the individual who works on the behalf of the firm is subject to state securities registration. All right, and going along with that, individuals do not register with the SEC. Agents, investment advisor reps, don't register with the SEC. Even if their employing firm is registering with the SEC, the individual does not. They register with the state at the state level. Now, broker-dealer agents are also registering with FINRA. Investment advisors, investment advisor reps do not register with FINRA, but the individual does not register with the SEC. So going along with that, investment advisor reps do not register with the SEC. So federal covered advisors are required to register with the SEC and only give notice in each state, notice filing in which they do business, but there's no SEC registration for investment advisor reps or agents. Those individuals don't have to register with the SEC. The investment advisor reps in both state registered and federal covered advisors need to be registered in the state. Remember, for state registered, any state in which they have office or 5 retail clients, fewer, right? Any retail or any state in which they have an office or federal covered advisors, right? So let's look at another question here. All of the following are required to be registered in state A except A, an IAR with 75 million in assets under management located in state A. B, an IAR located in state A associated with an investment advisor located in state A with 75 million in assets under management. C, an investment advisor with 175 million in assets under management located in state A, or D, an IAR located in state A associated with an investment advisor in state A with 175 million in assets under management. Okay, so an investment advisor with over 110 million AUM doesn't need to register in any state, so choice C. An investment advisor with 175 million, remember, when it comes to choice D, IARs work on behalf of those federal covered advisors if they have an office in the state, need to register there, and that's what state B is dealing with. And then the other ones, choice A, investment advisors in the state advisors because there are 75 million AUM, and then choice B, the IRR works for that state covered advisor. They have an office in state A, they have to register. C, it's asking which they don't have to register, right? Which example they would not have to register in. So C is the correct answer here. Okay, let's look at general registration procedures for broker-dealers, agents, and investment advisor reps. So for each of these entities, when they are registering at the state level, they need to provide what is known as a consent to service of process with their initial application. What is a consent to service of process? It's basically an agreement that allows the administrator to receive documents or lawsuits against you, right? Documents, or if somebody wants to sue the administrator has served that, takes a look at it, and sends a notice to the registrant. So this is an ongoing thing, but once the consent to service of process is filed, it does need to need to be renewed every year. But once the consent to service of process is filed, as long as that registration remains in effect, the broker-dealer, investment advisor rec would not need to resubmit it, but it allows the administrator to receive documents on your behalf. Let's look at general registration procedures for broker-dealers. They need to file Form BD for broker-dealer information. On that includes the type of businesses it is, the corporation, the proprietorship, their address, the names, qualification, fingerprints, offers of officers, directors, and partners. Note that all officers, directors, and partners are automatically registered as agent unless they don't perform the duties of an agent to help the public. Also on Form BD, officers, financial condition, and employment history, and then any injunctions or administrative orders, convictions for misdemeanors that are related to securities, business, banking, theft, embezzlement, fraud, or any felony. It doesn't matter what the felony is related to, if it involves securities-related business or not. If the misdemeanor involves securities business or banking, money laundering, or any kind of thing like that, it would need to be put on Form BD, and any felony would need to be put on there as well. Okay, there are certain things that are included on the form, and we're talking here broker-dealers, investment advisors, agents of investment advisor, reps, if they're on the registration form, can lead to the administrator denying in their application. So the conviction of any felony in the past 10 years can result in a registration denial. Conviction of a misdemeanor of all securities of either money or theft in the past 10 years can result in the registration denial as well. If you've been disbarred by another securities regulatory agency, that's something else that could potentially lead to a registration denial. If you have provided false information, your application could be denied. So fingerprints are required in most states unless they can do a match against the ID database for search of criminals. And if any information changes or is found to be inaccurate on your registration form, it must be corrected immediately, promptly, is the word you'll probably see on the exam. So let's look at registration for agents and investment advisor reps. The important forms here are the Form U form, that's the registration form. The U5 is the termination form. It basically ends your employment at a broker-dealer. So the U4 is basically the application form. It's completed and signed by the individual who's registering. So agents of broker-dealers register with the FINRA Gateway system. Investment advisor reps register via the Investment Advisor Registration Depository, IAR. That's where they file, depository, right? That's where they file the form. So the registration expires, and this is true not just for agents, IARs, but also of broker-dealers who have investment advisors. The registration is an annual thing. It expires at the end of each year unless it's renewed. And the renewing it involves paying a renewal fee, right? So let's say even the agent starts working on October 1st and they filed their initial registration, they would need to renew that registration no later than December 31st of that year. And no matter what point of the year they initially register, again, this is true for both agents, IARs, and both broker-dealers and investment advisors, you pay for the full year. Even if you're registering in November, you're still paying for the full year. Your yearly fee, you still have to renew by the end of December. So let's look at terminations, U5 form. It's the terminating U5 form. U4 is the hiring form. U5 is the firing form. It's filed by the ex-employer. So when an individual is terminated, either they decide on their own to stop their employment, or if the firm fires them, the U5 needs to be filed within 30 days of termination. The former employer is responsible for filing the form U5 on the individual who's ceased to be employed at the company. So again, the U4, it's filed on behalf of the individual, but it's the firm's responsibility to file it. So it's the employing firm's responsibility to file Form U4 on behalf of the individual. Here's a question. A registered investment advisor is formed and registers in the state on October 15th. The RIA would be required to re-register in the state on A, December 31st of the year of registration, B, January 1st of the year following the registration, C, April 1st of the year following registration, D, January 1st of the second year following your registration. All right, December 31st, no matter when in the year you file, you have to renew by December 31st. A is the correct answer to this, right? So let's move forward here. Continuing with registration here. So register, broker-dealers, investment advisor, the firms, I need three things. One, they need to meet certain net worth requirements. So the broker-dealers needs to meet a minimum net capital standard. Minimum net worth, there are net capital standards for broker-dealers, while investment advisors need to meet a minimum net worth requirement. So net worth, assets minus liabilities, minus tangibles, things like trademarks, copyrights. If the advisor or individual of all their personal property would be deducted, the advisor is a partnership or corporation, the items used in the business are included or not deducted. So note that once registered, so there are standards that you need to meet before you register. And then after that, there's a minimum net capital requirement that you need to maintain at all times. If the financials fall below that requirement, then you would need to first notify the administrator the next business day and file a formal financial report after that. So today is Monday, and the investment advisor's net capital has fallen below their minimum net worth standard. They would need to notify the administrator the next business day, Tuesday, and then by the end of Wednesday, would they need to file a formal financial report related to that. So second thing that firms needs is short bond coverage, surety bond coverage. So it's basically an insurance policy held by the state, which the state can use to meet legal claims against a broker-dealer or investment advisor. So basically, they give this bond that represents some amount of money that the administrator can use. If there's legal claims against the broker-dealer, it can use it to cover those against the firm. The minimum coverage is $10,000 for broker-dealers. For broker-dealers that or investment advisors that exercise discretion, they can decide which trades to exercise the account. It's $35,000 for investment advisors who take custody. Taking custody, it means you're directly taking access of client funds and securities. Not all investment advisors have it, but if you're taking custody, they have a higher T-bond requirement. So the state can make this requirement, but in the USA, it's a qualifying exam. So officers named in the Form BD and ADV need to pass whichever exams qualify for that type of registration. If they're dealing for public or supervised people and deal with the public, right? So an investment advisors are going to have to pass the exam in order to be an investment advisor rep. If they work for a broker-dealer, they have to register as an agent, or often they're going to be working in a principal capacity. They would also have to register as a principal capacity and pass that exam. That has to do with that Series 26. All right, so what about for individuals? For agents and IARs. An agent needs two things, an IAR needs one thing. IARs need to post a surety bond and pass an exam. It's not always required. In some states require agents to post a surety bond. AARs do not need to post surety bonds, but they do need to pass qualifying exams with the Series 65 or 66, for instance. So the surety bond requires to broker advisors, agents and broker-dealers. Investment advisor representatives doesn't apply. So the effective date of registration, the day you submit your registration into the system, into the ADV or U4, the registration becomes effective within 30 days or sooner if you don't hear anything. The general rule is that the state has 30 days to deal with the registration, the application, or withdraws. Registering initially, or you're already registered and you know what's going on. So assume if you haven't heard anything in 30 days, you're approved, right? Typically the administrator can decide to make it sooner than that, but the typical amount of days is 30 days after submission. So note that registration for any person is effective no later than 12 p.m. of the 40th day after it was filed. So you filed for state registration. The latest your registration can take effect is 12 p.m. on the 30th day. Now, if the administrator can deny this, if there's something wrong with the registration, they discover you've committed a felony in the past year or two and they want to deny your registration, they can do that. But they're not going to deny it 30 days for it to take effect. A little bit more of registration rules for broker-dealers and agents. So typically, an agent can only work for one firm at the same time. There are cases in which new registration, meaning registration with two different broker-dealers, is allowed. If that is the case, then it needs to be disclosed in the registration form. Typically, it might be allowed in some states if the broker-dealer or the two different broker-dealers are affiliated. Somebody who's not an agent, unless they're associated with the broker-dealer. So the broker-dealer needs to sponsor you, submit the U4 for you, and then you have to pass your exams. If an agent ceases employment, both the agent and the broker-dealer need to notify the state. The rule is different for investment advisors and investment advisor reps, right? But the employing firm files the form U5 via the gateway system. And both the agent and the broker-dealer have a responsibility to submit a notification of the termination to the state securities administrator. So what about registration rules for investment advisors and investment advisor reps? Remember, federal covered advisors do not register at state level. They typically would need a notice file, though, if they have an office of more than 5 retail clients and they need to pay filing fees. There are no federal registration requirements for IARs, only for investment advisors. So the IARs who are federal covered advisors need to register in the state in which they have an office. Federal covered advisors, just the states in which they have an office, even though the firm doesn't need to. When an investment advisor rep ceases employment with their firm, if we're talking about a state level investment advisor, then the firm, the employer, needs to notify the state. So remember, for broker-dealer, it was the broker-dealer and the agent. For investment advisor rep, who works for a state-registered investment advisor, the firm notifies the state. Now, what if the IAR works for a federal covered advisor? So in this case, the IAR notifies the state. right? The IAR is the only one who's registered in the state, so they are the one who needs to notify the administrator. Again, when it comes to investment advisors, ending their employment at a firm, if it's a state-registered advisor, the investment advisor notifies the state. If it's a federal covered advisor, the investment advisor rep notifies the state. A little bit more with registration requirements. Remember, the FINRA gateway system is used to register broker-dealer agents listed on Form ADV. BD is used for broker-dealer. Form U4 is for new registration. Broker-dealer files on behalf of the agent. The investment advisor depository is used to register investment advisors in IAR. Form ADV is filed for investment advisors. U4 for IARs registration needs to be renewed no more than December 31st of each year in the state in which they do business. Last thing, there's no reductions for the year's fee if they're entering, what time of the year they're entering. Doesn't matter what point in the year you enter, you have to pay the full fee at registration. However, if a firm is sold during the new year, the new firm can take over the paid fee during the new year. The IARD is used for both federal and state registrations for federal and state investment advisors. Federal covered advisors registered with the SEC, the IAR filed by filing Form ADV. FCAs also file in each state they do business, knowing the IARD. State registered advisors file Form ADV, and IAs who are both federal covered and state registered advisors registered in the states they do business with Form ADV. So in addition to paying your annual renewal fee at the end of the year, investment advisors and federal covered advisors are required to amend the information in their Form ADV of each year. So every year they have to file an amendment to their Form ADV within 90 days of the end of the calendar year. So additionally, if there are any material changes in information during the year, they have to file an other year amendment to amend their ADV. So federal covered advisors, other year amendment would have to be filed promptly right after the change takes place. If it's a state registered advisor, they need to file that within that year amendment within the 30 days of change information from when that time happens to file the amendment. Let's look at cases in which a registration could be denied, revoked, or suspended. So registration has been submitted. These are reasons the administrator can deny it, or if the registration has already taken effect and it's after the fact, the administrator must suspend or revoke registration when it reasons to this happening. So when the person who registration applies to files incomplete or inaccurate registration or application, has been convicted of willfully violating the acts, has been enjoined by the courts from engaging in the securities business, had the registration suspended or revoked by the administrator or any other regulator, been convicted of a misdemeanor within the last 10 years, if that misdemeanor involves money, securities, death, etc. Other misdemeanors that don't involve those things are okay. Or any felony, it doesn't matter what the felony is for, that could be a reason for having your registration either denied or revoked, suspended. We're going to continue. There are more cases in which this could happen. If the person has willfully broken a securities law within the past 10 years, willfully violated the securities or banking laws within a foreign jurisdiction, been subject to an order by a foreign regulator denying, suspending, or revoking the right to be in the securities industry over the past 5 years, have engaged in unethical or dishonest business practices at any time, have failed to file any and all fees, they've failed to properly supervise employees, they've gone out of business, can't be located, or is adjudicated by being mentally incompetent, or been deemed unqualified by the state administrator based on lack of experience, training, or knowledge. It's important to note that this alone cannot disqualify you. So lack of education or experience cannot disqualify you alone, but each of these cases are a case in which registration can be denied or suspended after it has already taken effect. These are all provisions under the Uniform Securities Act. Regulations of securities and issuers and the powers of the administrator. The state securities administrator is the office that has jurisdiction over securities regulation within the state. There are certain things that an administrator is allowed to do, and there's other things that an administrator is not allowed to do. So let's look at administrative powers first off. So each state administrator has the power to initiate investigations in potential securities violations regarding state residents or securities issued in the state, collect evidence related to those investigations, issue subpoenas, requiring people to testify under oath. Now, the administrator needs proper cause. They can do it in their state or out of state. For instance, if there is a case in which they're investigating fraudulent activity that took place in their state that involved broker-dealer from out of state, they could issue subpoenas related to that out of state. It also requests courts and law enforcement to pursue action against violators. So in the case that the administrator has a limitation, there are things that they can and can't do. They can ask for law enforcement to carry something further than they can go. They don't have a badge and a gun, so they can't throw you in jail. Other things that an administrator can do is rescind the registration of a person, either a firm or individual, if it's in the public interest. For instance, if that firm or individual has committed violations related to the Uniform Securities Act, and the administrator thinks that they should no longer be registered in the state. Conduct investigations and issue related orders. Orders to suspend, deny, or revoke licenses with the opportunity for a hearing. So they must be offered a hearing. If they're going to suspend, deny, or revoke somebody's registration, a serious type of action, they need to offer that individual or firm a hearing within 15 days in the case before they actually make their final decision. Publishing violations about violations. So subpoena persons and records. They can compel testimonies under oath and issue cease and desist orders without a hearing. A cease and desist order is a temporary stoppage, a stop order, right? It's a stoppage of a firm's ability to engage in the securities business. So it can be issued without a hearing. An order to suspend, deny, or revoke has to come with a hearing, but a cease and desist order is something that the administrator can do on its own without conducting a hearing in advance. Let's look at things that the administrator cannot do. An administrator cannot issue injunctions. An injunction is a permanent ban from state registration. The administrator can ask the court of law to do this. The administrator can also not send somebody to prison for levy fines. The court of law enforcement, could do those things. The administrator also does not hold trials and hearings in a case to suspend, revoke, or deny registration of licenses, right? So they don't hold court trials. The state legislator is required for writing laws, including securities laws. The administrator does not amend those laws. The administrator can help enforce those laws. Think COP. It does not amend state laws, though. Only elected officials, the state legislator, can do that. So let's continue a little bit further with the administrative procedures now. So the administrator has the power to deny or revoke the registration of any person, broker-dealer, agent, investment advisor, or investment advisor representative if such action is in the public interest and a violation has occurred. Now, in order to move forward with the proceeding, to deny, revoke, also to suspend a person's license, the administrator needs to give prior written notice and offer a hearing. The hearing needs to be granted within 15 days of request. So if, for instance, the administrator is making a motion to deny or revoke a representative's license registration, he would have to let that representative know that this order is going to go forward and then offer a hearing to them so that the rep could then state their case in the hearing. And if the rep decides they want the hearing with the administrator, the hearing would have to be scheduled within 15 days of request. At the end of that hearing, the administrator would issue their final decision. If the administrator provides the registration of a broker-dealer or investment advisor firm that employs individuals, then the registrations of their agents or IARs are also revoked. An agent or investment advisor rep, their registration is only good if they're actually working for a registered firm, an active broker-dealer or investment advisor. So once that broker-dealer or investment advisor's registration or licenses have been revoked, then those individuals would no longer be working for an active firm, and so their licenses and registration would also be revoked unless they find new employment. The opposite occurs if the registration of if the opposite occurs if the administrator revokes the registration of one of the individuals who works for the firms, right? If an individual revoked the representatives licenses, that does not affect the broker-dealer or investment advisor of the firms. So here's a question. What can the state securities administrator do during an investigation? 1, subpoena individuals. 2, request documents and records. 3, issue a warrant for an individual's arrest. 4, compel testimony of an individual. So A, 2 only. B, 1 and 3 only. C, 2 and 4 only. Or D, 1, 2, and 4. So the administrator can subpoena individuals. They can request documents and records. And they can compel testimony from an individual. They cannot issue a warrant for an individual's arrest. The court of law or law enforcement could do that. The administrator cannot. So 1, 2, and 4. Choice D is the correct answer to this question. Okay, in the case of a civil violation related to the Uniform Securities Act takes place. Now, a civil violation is one that is not done willfully. So the act is violated, but it's not intentionally violated, not deliberately. So it's a less serious violation than a criminal violation. So let's look at, first off, some examples of civil violations and how their information related to these. So examples of civil violations that the administrator could have jurisdiction over: failing to properly register as an agent or broker-dealer, selling unregistered securities in a non-exempt transaction, so selling securities that should have been registered but are not registered, failing to give a customer prospectus when required, so initial public offerings, right, IPOs. In a period after an IPO, you're supposed to receive a copy of the prospectus when they purchase those securities. Or when you buy mutual fund shares, you're always supposed to receive a copy of the prospectus. And so when that isn't given during the time frame when it's supposed to be, that's a violation. Failing to file sales literature or advertising with the administrator if required. So the administrator is allowed to require sales literature and advertising to be filed with its office. So if it requests, it files, and if filing isn't done, that's a violation. Making unintentional false statements or omitting facts. So if you intentionally say false statements or knowingly omit material facts, things that impact a customer's investment decision, that is a violation. So if a violation takes place, somebody wants to sue sue over the violation, they need to be brought within 3 years after the date of the transaction, or 2 years after the date of discovery. So 535, right? So we'll look at this here in a second. So 5-year statute of limitation, right? So civil provisions under the civil liabilities. A customer has the right to recover their money from their investments that was due to improper advice. So somebody, for instance, say that an agent of a broker-dealer recommends that a customer buy a security. The security turns out to have not been properly registered. The customer bought the security, and then after the fact, they bring a civil suit related to that activity, right? They were told to buy something that wasn't properly registered. That's a violation of the Uniform Securities Act. And now so they sue to recover the money related to their investment. That's what they're allowed to sue for. So in a civil lawsuit, the purchaser can recover the cost of the advice. So whatever, if it was a commission that they paid for the transaction, that was affected. If it was an investment advisory fee, they can sue to recover that money. Any losses resulted from the investment advice, so they bought the security, the lost value while they held it. Any money that they lost. Interest costs from the payment date, it's usually 6% of the payment amount in interest. Attorney's fees, and then you would subtract any income received made by. So say that, for instance, you bought a security for $5,000, it wasn't properly registered, and then it dropped to $4,000 before you sold it, so you lost $1,000 in capital losses, but you received $100 in dividends while you held it. So a $1,000 loss, you'd subtract the $100 in dividends minus the income received from the advice. So that's basically what that means. So what's this saying? What this is saying is, in a civil lawsuit, any violations taking place, this is what the person who violated basically can sue to receive. Here's a question. After an unintentional illegal sale, the customer who bought the issue can do all of the following except A, sue under civil liability, B, sue under criminal liability, C, recover the cost of the securities plus 6% interest, or D, recover attorney's fees. So B looks like our correct answer here. It's an unintentional illegal sale. In order for it to be a criminal violation, it has to be willful or intentional. Unintentional would be civil liability. So B would be the correct answer here. Because you could sue for civil liability. Part of what you can get is the cost plus the 6% interest and also attorney's fees. That's something you could sue for. So B is the correct answer here. It's the one thing that would not apply here, is criminal. All right, so let's just look briefly at civil versus criminal. So a civil liability is set for somebody who's violated the act without willfully doing so, unintentionally they made a mistake. So anyone who lost money related to that civil violation, what can they get back? Basically the cost of the advice, any money they lost, 6% interest, and attorney's fees. So we're talking about money lost in total, lost minus any income that they received. So what about a criminal violation? So a criminal liability takes place when somebody intentionally violates the act, the Uniform Securities Act, right? So this could be something that's a felony, so something more serious type of violation. So when a criminal violation takes place, the administrator doesn't have jurisdiction over criminal liabilities, the court of law would. But criminal liabilities and penalties apply. So as part of that, right, if a criminal suit goes forward and the person who was found to have violated the act, it's criminal violation, they would need to make restitution. So basically pay back any money lost, price of the advice, attorney's fees, and then they could also face more penalties on top of that. A fine of up to $5,000 per violation and potential imprisonment of 3 years per violation. So if it's a really serious matter, they could face prison time. The statute of limitations for criminal violations is 5 years, a little bit longer than the statute of limitations for civil violations. All right, an offer of rescission. An offer of rescission is not something that the administrator does. Instead, it's when another party, like a broker, dealer, investment advisor, or issuer of securities, has sold securities in violation of the acts, unintentionally does so, and then they discover after the fact that they have committed a violation, and they want to avoid, any action being taken against them by the administrator. So they can offer what is known as the right of rescission, right, in order to try and avoid having a suit brought against them. So the offer of rescission is basically, right, a make-good offer. We made a mistake, we committed a violation under the Uniform Securities Act unintentionally, and we want to make good. So we want to reimburse you for any losses that you may have endured. Buy back the securities if you still own them, and thereby, in doing that, avoid having the administrator take any action. So we were supposed to blue sky, we didn't properly blue sky, the customer bought them. We can do all those, or they can just keep the securities. So prior to the suit, if securities have been illegally offered in the state, offer of rescission, offer to rescind that contract, offer of rescission can be made. So when an offer of rescission would entail basically telling the customer what happened, sending the customer a statement of how the error occurred, if there was a misstatement of material fact or correcting that information, and then basically offering to buy back the securities if this customer still owns the securities, plus the 6% interest, less any income received. So for instance, if the customer still owns the securities that they bought, they weren't supposed to be sold to them and they paid $6,000 for them, but they've received $200 in dividends while they've held them, right? You'd do the $600 minus the $200 dividends, and then you also take the 6% interest on that as well. Now, if the customer has already bought and sold the securities, then any money lost in that transaction between the purchase and sale price minus any income received, plus the 6% interest on that as well. So when an offer of rescission is made, basically the customer can either accept it or refuse it. If they accept the offer, right, then they sell the securities back to the entity that's offering the rescission, and then they're reimbursed. If they accept the offer of rescission, right, they get money paid to them, but they no longer have the right to sue over the matter, so they can't bring a suit against the violator. If they accept their offer of rescission. If they reject the offer of rescission, they don't receive the compensation, they're not reciprocated, but they still maintain the right to sue over the matter. So again, offer of rescission, person who violated the act unintentionally wants to try and make good and avoid having a lawsuit brought against them. All right, let's look at offered sales in the administrator's jurisdiction. So basically, briefly, an offer is basically a proposal to sell a security to somebody. It could be something, it could be an advertisement, it could be a sales call, it could be securities that involve paying money for other securities. Now, when an offer takes place in an administrator's state, the administrator often has jurisdiction over it if there's any fraudulent activity related to that offer. Like, for instance, a broker-dealer calls a customer and offers to sell a security that's not registered, and it's supposed to be registered and it's not registered. In that case, they violated, a violation has taken place, the administrator could have jurisdiction over that. So when would an administrator have jurisdiction over an offer? When a fraudulent activity, how many administrators can have jurisdiction? So the maximum number of administrators that can have jurisdiction over an offer is 2. So who would those administrators be? The administrator in the state where the offer originated, the broker-dealer that's offering to sell securities, where they're located when they make the offer. So where the offer originates, they always have jurisdiction. Now, where the offer was directed to, so if it's directed to somebody in a different state, if it's directed to and received in that state, then that administrator would have jurisdiction. However, if it's only directed to and not received, meaning they didn't accept the order. So what's an example of this? Say that a broker-dealer in state A calls a customer who's located in state B to offer securities fraudulently. Now, the customer is not at home he's in a different state. So they direct their call to a customer who resides in state B, but he's actually in state C when he receives the offer. Okay, so the only administrator in that case that would have jurisdiction is state A, where the offer originates, because it was not directed to and received in the same state, right? So if they call the investor when he's at home in state B, then the offer is directed to and received in the same state, state B. In that case, state B would also have jurisdiction in the administrative state, state B, in addition to state A. But the offer has to be directed to and received in the same state for that second administrator to have jurisdiction. What about sales? So sales basically a transaction that involves exchange of money, exchange of securities. So when a sale takes place, 3 administrators, potentially anyway, could have jurisdiction over it. So the administrator is the state where the trade originated, would always have jurisdiction. The administrator in the state where the trade is directed would also have jurisdiction. And then the state, if the sale was processed in a different state than the state to which it was directed, then that administrator would also have jurisdiction. So for instance, we'll use the same similar example. A broker-dealer in state A calls a customer in state B and offers to sell securities, right? Sell them fraudulently, we're assuming. So now they call the investors of state B. The investors travel to state C before they decide that they want to buy the securities and enter an order to buy them while they're in state C. So the administrator of state A, where the offer originated, state B, where the trade was directed to, and then state C, he said, oh, well, I'm actually up in this state, I'll take the order. All 3 administrators would have the jurisdiction in that case. All right, so here's a question related to that. A broker-dealer located in state A makes an offer to securities of principal residences in state B. The customer has temporarily moved to state C and has asked the post office in state B to forward the mail to customer's address in state C. So which administrator or administrators would have jurisdiction over this offer? A, state only, A only, B, state A and state E only, B only, C and B only, or D, state C and state B only. So this is an offer, no sale has taken place. So remember, when an offer takes place, the administrator in the state where it originates always has jurisdiction, so state A. So in this case, the investor's residence is in state B, but he's in state C. So the offer is directed towards state B, but the mail is forwarded to state C, so he receives it in state C. So an offer takes place, it has to be directed to and received in the same state, and that doesn't happen here. So the only state administrator that has jurisdiction here is state A. So A is the correct answer. Ethical practices and fiduciary obligations. Communication with clients and prospective clients is part of an investment advisor's duty when working with clients. They're supposed to offer certain disclosure to those clients at the time or before an investment advisory contract is signed. This is known as the brochure rule. This requirement to provide that disclosure, the requirement to provide this disclosure. Under the brochure rule, investment advisors need to provide clients and prospective clients with a written disclosure statement that contains certain information. The services the firm provides, its fee structures, any potential conflicts of interest, any material disciplinary actions that have been taken against the firm or its registered associates, and also the educational and business backgrounds of its registered persons. This information appears on parts 2A and 2B of Form ADV, the registration form for an investment advisor. But the firm can put it on a separate brochure, and they often do, and hand that brochure to clients. However, they give it to the client, whether it's part of the Form ADV or on that separate brochure. The requirement is that the firm needs to provide the information to the client before the client signs their investment advisor client contracts. So that's the requirement. If the firm does not provide that brochure to the client by the time the contract is signed, it has committed a violation. Additionally, if the brochure is not delivered at least 48 hours before the client signs the contract, the client would have 5 business days to terminate without penalty. Typically, it's part of an investment advisory contract. If you terminate the contract before the term is up, you would have to pay some sort of fee, but if the brochure is not delivered at least 48 hours before the contract is signed, then the client would have a 5 business day period if they want to decide to get out of the contract without having to pay the fee. So if, for instance, I signed my contract with my investment advisor on a Thursday, and they gave me the brochure on Wednesday, 24 hours prior to my signing the contract, they will not have committed a violation because they gave me the brochure with that disclosure information before I signed the contract. However, because they only gave it to me 24 hours before I signed the contract, I would have 5 business days to get out of my contract if I decided to do so without incurring a penalty. Prospectus delivery. There are requirements that go along with delivering a prospectus to investors in the case that prospectus delivery is required. So first off, what is a prospectus? A prospectus is a detailed description of a securities issue that for a new issue needs to be provided for each interested investor. So when securities are registered with the SEC, part of the whole registration process is that they need to put together this prospectus. It has lots of information, financial and otherwise, about the issuer or the securities in the offering. And they need to give that prospectus to people who are buying the securities during the IPO and shortly thereafter. So when prospectus delivery is required, the broker-dealer needs to make sure that they can make copies of the preliminary prospectus and any amendments that's going to solicit orders, and then make copies of the final prospectus to any agent who is going to solicit the orders. Typically before the registration statement takes effect, the preliminary prospectus, once the registration takes effect, Now the securities can be sold in the final issue, the final prospectus, and that's the document at that point that needs to be delivered to investors. A prospectus does not always need to be delivered to somebody who's buying a security. When is delivery of a prospectus required? So, a copy of a final prospectus for new issues must be delivered for the following. So if the security is going to be listed on an exchange, and we're talking about its IPO, the first time shares are sold to the public for 25 days after the IPO closes, the free look period, right? So we're looking at this here. If there's a follow-on offering on exchange listed security, follow-on offering is if the issuing company wants to sell more shares at a later date, then only at the time of the following offering would the prospectus need to be delivered. So say for instance, ABC company is having its IPO, ABC stock is going to be listed on the NASDAQ. Somebody buys the shares 20 days after the IPO closed, they would need to have a copy of the prospectus. However, if they bought the shares 30 days after the IPO closed, the prospectus delivery would not be required in that case because more than 25 days have gone by. Okay, so for OTC IPOs, OTC meaning over the counter, meaning not listed on an exchange, is traded over the counter. It's a little bit longer of a time period that delivery is required, 90 days. So for 90 days after the IPO, delivery would need to be made of the prospectus. For follow-on offerings, for non-listed securities trading over the counter, 40 days offering the follow-on offering closes. So these are in the initial periods. Once these initial periods go by, we get beyond the 25-day or 90-day or 40-day requirement, the prospectus no longer would need to be delivered to an investor who buys the shares. Now, somebody who's buying mutual fund shares, each share of a mutual fund share is considered a new issue. Prospectus delivery is always required in that case. So each of the above cases, prospectus delivery must be made no later than when the customer's trade confirmation is delivered, which is typically by the settlement date, 2 business days after the trade date. If prospectus delivery is required and the prospectus is not delivered by the time the trade confirmation is delivered, a violation has occurred and taken place. Let's look at some more information related to prohibited activities, performance guarantees, and client instructions. So performance guarantees are typically not allowed. So what are we talking about here? Guaranteeing a client that a specific result would be achieved, won't gain money or lose money if they make an investment is prohibited. Additionally, if the client loses money on the investment, an agent or a broker-dealer is not allowed to reimburse the client, right? That's another way to guarantee that they don't lose money. In addition to this, when it comes to client instructions, securities professionals are required to follow all legal client requests in regard to their account, even if they don't agree with their request. So the client tells you to do something and it's a legal request, right? There's no law that's going to be broken by following the request. You're supposed to do it. So for example, if a client asks you to sell securities in the morning and you think the share price is going to rise, so you wait to the afternoon and sell it for a higher price. In the process, you show off your skill and give your client additional profit so the client gains financially, but this would be considered unethical because you did not follow the client's advice. So this is a prohibited activity. Let's look at information related to what is required in an investment advisory contract. So this is NASAA regulations regarding investment advisor contracts. So first off, it must be in writing. Secondly, they need to outline the services that are going to be provided. They need to make a term or time limit for the contract, state the advisory fee, and the amount of fee that the client would have to pay if they terminate the contract early. And then also specify whether the advisor has discretionary authority over the client's money. Discretionary authority is the ability to decide which trades to make and withdraw funds from the account. State that the advisor will not be compensated for performance gains within the account unless the client is a qualified client. There are some clients who are allowed to have performance-based arrangements. So either way, the contract would need to either state that it's not going to be compensated, or in the case of a qualified client that wants performance-based fees and compensation arrangement, would have to state that they are going to be compensated based on that. State that the advisor cannot sell or transfer a customer's contract to another party without the customer's consent. And finally, if the investment advisor is a partnership, the agreement needs to state that the IA will inform client that there is a change in the partnership structure. If there's a change in majority of the members of the partnership, the client would need to be advised of that and sign off. Authorize that their contract will continue despite that. Additionally, hedge clauses are not allowed. Hedge clause is basically the investment advisor getting the client to sign a waiver that they can waive some of their rights related to the arrangement with the investment advisor, so hedge clauses are prohibited. Let's look at some information related to communication rules now. So broker-dealers and investment advisor communications. Broker-dealer advertising comes under FINRA rules. FINRA got extensive rules related to broker-dealer advertising, but there are rules that are unlikely to show up on the Series 65 exam. For the most part, broker-dealer advertising, most things are allowed as long as the advertising is not deceptive or misleading. Now, let's look at the rules for federal covered advisors and state covered advisor advertising. So federal covered advisor advertising rules are covered under the Investment Advisors Act of 1940 and also under the more recent marketing or SEC marketing rules. State registered advisors advertising comes under state rules, which parallel the Advisors Act, but there are differences between the rules for federal covered advisors and state registered advisors. Now we're talking about advertising. Basically, advertising is a communication that's seen by the general public, including TV, radio, newspapers, and non-password protected websites. Sales literature is also covered under, sales literature is considered under communication rules. It goes to a specific audience such as research reports, forum letters that are not properly distributed in password protected websites. So advertising and sales literature is a little bit different, but they both do fall under the communication rules. So let's look at some rules for first that refers to state registered investment advisors. Remember, these are the NASAA rules. First off, a big one. State registered investment advisor advertisements and advertisements issued by investment advisors who work for those firms cannot contain customer testimonials. In no instances are customer testimonials allowed in state registered investment advisor advertisements. They can also not state that a research report is free unless it is offered without strings, without condition. They cannot take false or misleading statements. They can include a list of prior recommendations with performance, meaning recommendations that they have made to clients in the past showing the performance that resulted from those recommendations. They can do that. However, if they do, all recommendations over the past year, minimum, would need to be included. So you cannot cherry pick results and talk about recommendations you made that turned out exceptional, right? That turned out to be good investments for the clients, and then avoid other recommendations that you made. So you can't include a reference or recommendation that you make to a client in an advertisement. You have to include all of them that you made to all clients over the course of the past at least 1 year. Note that the bottom advertisements for federal covered advisors and their IARs can contain testimonials under specific conditions. So a big difference between state registered investment advisors advertising and federal covered investment advisor advertising. State registered advisors cannot put testimonials in their ads. Federally covered advisors can have testimonials in their ads. Let's look a little bit more about federal covered advertising now. So this is covered primarily under the SEC marketing rules. FCA advertisements must not contain any untrue material statements for which the advisor does not have a reasonable basis, or misleading information, and also cannot omit important material information facts, right? So material facts. As stated previously, they can contain testimonials as long as certain conditions are met. Those conditions are the testimonial is made by an actual client of the advisor, there is compensation related to the testimonial and it's disclosed, and the person who is making the testimonial has not been barred by the industry. FCA advertisements can contain performance results if they are fair and balanced. They can't cherry pick, only good results, for example. If they are going to contain performance results, they are going to need to contain, number one, all performance within 10-year periods and provide results from similar portfolios. Finally, they can contain a third-party rating if it's provided by a person who is affiliated or under common control with the advisor, and the advisor has a reasonable belief that any questions of use is preparing the rating to meet the requirement criteria of the SEC. Let's now look at investment company communications, NASAA rules related to these. So basically the communications that deal with mutual funds or other investment companies. So any agent that solicits sales of a mutual fund, first off, needs to disclose any sales charge related to the fund, front end, back end sales charges. They also need to disclose any ways to reduce sales charges, things like breakpoints, letters of intent, rights of accumulation need to be disclosed to the customer who is discussing buying the shares with. Rights, they're prohibited from advising customers to buy multiple investment company funds with the same objective. Agents should not recommend that customers buy a fund and then buy a new fund of similar. They might pay more in fees. The more transactions that the agents affect, the more customer pays fees. So unless it's suitable for them to buy more exchange or more shares, then they shouldn't recommend it. And then agents are not allowed to call a fund a no-load fund or say it has no sales charge if there is a load charge or fee that exceeds 0.25% of the average assets held in the fund per year. So this goes along with the definition of a no-load fund. So you're not allowed to tell a client that the fund is a no-load fund unless it actually meets that criteria. Let's look at information related to how NASAA model rule that discusses the conditions under which a broker-dealer can have a branch at a bank. So sometimes brokerage firms, broker-dealers have offices within banks. There's certain guidelines that they need to follow if they're going to do that. So if a broker-dealer has a kiosk located in a bank branch, NASAA requires that it must be separate from where banking activity takes place. So there should be, a space of separation between when the broker-dealer activity and the banking activity is going on. The broker-dealer's name and SIPC, the Security Investor Protection Corporation sign, need to be prominently displayed on the kiosk or office. And prior to any account that's prior to any account that's opened at the bank office, the broker-dealer needs to give the not made disclosure. They need to tell the customer that the account they're opening at the broker-dealer is not FDIC insured. The securities that they'd have within the account are not bank deposits and that they may lose value. So basically they're letting them know that even though this office is within a bank, this is not the same thing as opening a savings account at the bank. In addition to that, whenever a broker-dealer issues any advertisements, they would have to have those same not made disclosures on any advertisements that they send out. And then the broker-dealer needs to give this same disclosure verbally and needs to attempt to get the acknowledgement from the customer in writing. Let's look at rules related to investment advisor compensation, types of compensation for investment advisors, how they're paid. The most common way that an investment advisor is paid is a percentage of assets under management. They could also be paid via flat fees. Wrap fee is a wrap fee that wraps all the services provided combined. Investment advice, commissions, all wrapped together. And if the client is a qualified client, then they can have a performance-based fee arrangement, meaning if the portfolio performs above a benchmark, they get extra money related to that. The advisor is allowed to send its portfolio trace to an affiliated broker-dealer as long as they disclose this to their clients. Right, investment advisors often offer investment advice and broker-dealers affect transactions, so the investment advisor can send those trades to a broker-dealer to be affected that's affiliated with the broker-dealer, but they need to tell the clients in advance. The broker-dealer to which the investment advisor is sending their clients' trades can earn commissions for executing those trades. It can also be paid 12b1 fees. Oftentimes when they sell shares of mutual funds, they receive 12b1 fees as compensation. And finally, the executing broker-dealer or firm where that trade is executed can repay some of those commissions back to the IA in the form of soft dollars. So a soft dollar arrangement. Soft dollars are basically services that the broker-dealer provides to the investment advisor in return for the investment advisor bringing their clients' trades to the broker-dealer. It's an acceptable arrangement as long as the soft dollar services are things that benefit the investment advisor's clients. Things like research, market data, trading software. These are all things that could potentially help the advisor make better recommendations to their clients if those are the services that the broker-dealer provides to the investment advisor in return for the investment advisor bringing their clients' trades to the broker-dealer. Then it's an acceptable soft dollar arrangement because it's benefiting the customers. However, if the services that the broker-dealer provides the investment advisor thinks that would help the investment advisor but not their clients, like if they're paying the salaries of the investment advisor's associates or paying for the advertising the investment advisor puts out, these are not things that benefit the client. That would not be an acceptable soft dollar arrangement. Additionally, when we talk about soft dollars, anytime the IA has a soft dollar arrangement with a broker-dealer, it needs to be disclosed to the investment advisor's clients. As we said earlier, investment advisors can sometimes have performance-based arrangements with certain clients. Now, the client needs to meet certain characteristics in order to do this arrangement. In fact, most clients do not meet this arrangement. But if the client is a qualified client, the investment advisor can set up this sort of arrangement. So what are we talking about here? Performance-based fee is basically a fee that the investment advisor or IAR can earn based on capital gains or appreciation in the account, usually based on gains of a benchmark. Like a standard performance-based arrangement would be something like if the portfolio grows by a greater amount of the S&P 500, let's say it grows this year, the IA will earn an extra 10% of the assets. If they exceed that benchmark, then they get some extra amount of money. Performance-based fees are prohibited by the Investment Advisors Act and the NSAA rules, but with some notable exceptions. So some of these types of clients, some exceptions, right? These clients can, the rich man rule the weed, right? This is for high net worth individuals. Somebody who has at least 2.2 million in net worth, excluding the value of their primary residence, or 1.1 million in assets, could have one of these arrangements. A qualified purchaser, an individual or a family with a corporation with at least 5 million investments, or a non-family owned corporation with at least 25 million in investments. A business development company, a BDC, these are closed-end funds that invest in smaller, troubled businesses that are not regulated under the Investment Company Act. A private investment company, companies whose shares are beneficially owned by no more than 100 people and don't make a public offering of their securities. Registered investment companies like mutual funds, closed-end funds, annuities, unit investment trusts. Certain investment advisory personnel like officers, directors, registered investment advisor reps, and then also non-residents of the United States. They can all have performance-based arrangements. Now, that doesn't mean just because a client is one of these 7 types of clients that they have to have a performance-based arrangement. It means that they're allowed to if they and the investment advisor agree to it. So what about broker-dealers and agents? Can they share in the gains and losses of a client account? So broker-dealer is not allowed to charge performance-based fees. A broker-dealer agent can share in the profits and losses of a client's account as long as certain conditions are met. First off, they need to have the written authorization of the client and their employing broker-dealer. And then they would also need to have a joint account with that client. They must have some of their own money invested in that account. And then they could only share to the profits and losses based on the percent of what they have invested. So for example, Sarah, who's a agent of ABC Broker-Dealer, works with a client named Joe. Joe wants her to share in the gains of his account, so he gives her written authorization to do so, and ABC also gives written authorization. Sarah then contributes 30% to the account, so she's now able to share in 30% of the profits in the account. She'd also be responsible for 30% of any losses in the account. So remember, for an agent of a broker-dealer to share in the gains of losses, they have to give the authorization of their firm, the client whose account we're talking about, and they have to have that percentage of their own money in the account based on the percentages of what they can share on in their own percentages invested. Let's look at broker-dealers and their ability to share in commissions and fees. Remember, agents are basically paid in commissions. They receive some percentage of the value they receive in commissions. Agents are allowed to share commissions with other agents as long as they work at the same broker-dealer or broker-dealer under common control. What that means, two agents work at the same firm, they're both registered, the commission on a transaction is $100. Agent A, who's working with the client, could split that with Agent B, and they might be able to help do some research related to security. Investment advisors are allowed to share fees and are allowed to pay fees to solicitors. It's basically someone the firm pays to solicit business on its behalf, or people who are brought in to help work for the IA. Solicitors need to give a prospective client the investment advisor's brochure and their own disclosure document when they're trying to do that with the firm. And they would need to disclose to the client that a referral fee was received. They also need to disclose any amount that also might add to the fee that the client is going to pay for the investment advisor services. The investment advisor can send its portfolio trades to an affiliate broker-dealer where it gets a commission on those trades, but that would need to be disclosed to the customer, and the customer would need to give their written consent. It's a conflict of interest, which is why it needs to be disclosed. Here's a question. An investment advisor may be compensated with all of the following except A, wrap fees, B, soft dollars, C, bid-ask spreads, or C, asset-based fees. Investment advisors can be compensated with wrap fees, soft dollars, and asset-based fees. Bid-ask spreads? No, that's basically the difference between what a market maker pays for securities and somebody else to buy it. The market makers profit and dealers of securities profit. Bid-ask spreads, but not investment advisors. Investment advisors are not selling securities, so C. Here's another question. Which statement is true regarding the sharing of commissions between a state licensed agent and another person? The sharing of commissions is A, allowed between individuals as long as both are licensed by the state and work for the same broker-dealer. B, allowed between a state licensed securities agent and an unlicensed bank teller. C, allowed between a state licensed securities agent and a state licensed insurance agent. B, prohibited in all instances. Well, A is our correct answer here. I mean, in order for an agent to split commissions with somebody else, that other individual has to also be registered as a securities agent and working either for the same broker-dealer or a broker-dealer under common control. So A is our correct answer to this question. All right, let's look at custody for investment advisors. Custody basically it occurs when the investment advisor has the ability to control, take possession of a client's funds and securities. Now, IAs don't always have custody of client funds. In fact, some states don't allow it. So the IA cannot take custody of client's assets if the administrator has a rule prohibiting this. But many states allow for the investment advisor to take custody. And if they do, there's certain conditions and additional conditions that they need to follow and uphold. Let's look at the definition of a custody here, right? So I gave you the general definition to get appropriate access to access client funds, accepting clients' funds or securities, appropriating customer funds or securities, so being able to take money out of a customer's account. Also, acceptance of prepaid advisory fees, if that is 6 months or more in advance of rendering services. If the fee is $500 or more from state registered advisors, $100 or more for a federal covered advisor. And then also any account that gives full discretionary authority to the investment advisor. Full discretionary authority would be willing to make trades and be able to make trades and also withdraw money from the account. Limited trading authorization or limited power of attorney is not considered custody. A limited power of attorney, your limited trading authorization, only gives the IA the ability to make trades and not withdraw funds from the account. When you have the ability to withdraw funds from the account, that would be considered custody. Okay, sometimes investment advisors without custody might accidentally come into possession of client funds or securities. If that happens and they want to avoid custody, they need to return that money or securities to the sender within 3 business days, and then maintain required records. If they accidentally receive any client checks made payable to third parties and they want to avoid custody, they would need to forward those checks to the third party within 3 business days of receipt to maintain required records. So in cases which an investment advisor comes into possession of client funds or client money via check, it's supposed to go to a third party. They need to send that along within 3 business days, either back to the client or to the third party. If they hold it for longer than 3 business days, custody have taken place. And then they'll need to follow the additional rules that go along with taking custody. Those rules, by the way, include such things as a higher net capital requirement, right? That $30,000 being subject to a surprise annual audit, having to send more frequent updates to clients regarding securities. Those are all things that go along with what happens when an investment advisor has custody. Let's get a question related to custody. An investment advisor is considered to take custody of a customer's funds or securities if it A, exercises discretionary authority by placing trades of security for that customer, B, receives a check from the customer made payable to a mutual fund custodian and forwards the check immediately, C, accepts commissions for effecting trades for that customer's account through an affiliated broker-dealer, or D, appropriates customer funds. All right, appropriation of funds, the ability to control customers' money or security. So B is the answer here. Discretionary authority, they're making trades within the account that doesn't necessarily constitute custody. They receive the check and forward it, choice B. So custody has taken place. Executing trades through an affiliated broker-dealer, that's not custodial. Affecting trades, right? Let's look at discretionary accounts now. So what is a discretionary account? A discretionary account is one in which the securities professional is given the ability to make all decisions related to trades in the account and make those trades within the account. You don't need discretionary to make price and time decisions, right? But it's basically where when a financial professional decides the trade and the security that's being traded and makes the trade within the account without the customer's approval. There is a type of execution that allows for the securities professional to decide certain information related to the trade and then make that trade without the client's express approval, and that is the price and time execution. So as long as the client provides certain information, buy 100 shares of ABC, action, asset, and amount, right? So buy, action, right? 100 shares of ABC, what's the asset and what's the amount? Amount 100 shares, asset ABC. So as long as the professional is provided with that information, they can then decide the price and time. Now the price and time execution is only good on the day of which it's granted. So here's an example of time and price execution. So Jill is working with her investment advisor. Let's do an agent. Let's say Jill is working with an agent. He doesn't have written authorization to make trades in her account, discretionary authority, but she calls him this morning and says, I own 1,000 shares of ABC. I would like you to sell them at some time today. So she has given the action to sell the asset, ABC, and the amount, 1,000 shares. So now the agent can decide at what time of day and the price to make the trade. Now it's only good on the day of which it's traded, so they'd have to make the trade that day, but that's the price and time discretion. So you don't have to need written authorization to do price and time discretion. Broker-dealers and agents, if we are talking about written authorization in discretionary trading, they need to have written authorization before they make any discretionary trades. Investment advisors and investment advisor reps, a little bit different for them. They can get initial verbal authorization as long as they get that written authorization no later than 10 business days after they make the first discretionary trade in the account. So here's another hypothetical scenario. So a client wants her agent to have discretionary authority in her account. She calls him on the phone and says, I want you to have discretionary authority on my account, start making discretionary trades on my behalf. The agent knows what he's doing. He'd say, well, you need to give me written authorization first. I cannot make any discretionary trades before I have written authorization. On the other hand, now, same person's dealing with their investment advisor rep. They call their investment advisor rep, say, hey, I want to give you discretionary authority on my trades. Investment advisor says, okay, great, I'll start making trades today. If they can start making trades today, they would need to get written authorization no later than 10 business days after the first trade has taken place, right? The first discretionary trade. Here's a question. An investment advisor rep has discretion over a customer's account. This means which of the following? A, the IAR can make trades that sees fit for the client. B, the IAR can only use time and price discretion. C, the IAR needs to get customer approval before making any trade. D, the IAR can sell securities for a gain for the customer, but it cannot buy securities without customer consent. So A, they can make trades that they see fit for the client. That is what discretionary authority means. You're given the authorization to make any trades for the client that you see fit. So A is the correct answer to this question here. Okay, let's look at broker-dealer suitability versus investment advisor fiduciary standards. What we're looking at here is when you're working with a client, making recommendations, telling them what to buy, there are different standards for broker-dealers and investment advisors. So first off, a broker-dealer can recommend only suitable investments to customers. So basically, every time a customer opens an account at a broker-dealer, they're supposed to provide certain information to the broker-dealer: their age, their investment experience, their investment time horizon, their investment goals, their income, their tax bracket. And the broker-dealer agent is working with them is supposed to take all of this information into account when they're making recommendations. So making aggressive growth mutual funds to a customer is short-term would not be suitable, right? You need to make sure suitable investments are being made, and they are allowed to make those trades out of their own inventory to the customer. That's known as a principal transaction, directing in a dealer capacity. That's fine. They need to disclose to the customer. Broker-dealer earned commissions, markups, and markdowns, not flat fees. Investment advisors are held to a fiduciary standard. Investment advisors are considered fiduciaries. They have to put their client's best interest above their own interest at all times. As part of this fiduciary standard, they can only do the following with written client consent. So tell a client to take one action while the IA takes the opposite action. For instance, they tell the client to buy ABC stock when the investment advisor just sold it. So to do that, they need to get the client's written consent that the client understands that they are doing something opposite to what the investment advisor just did. They could sell securities from their own account to the client. This happens in cases where the investment advisor is joint in investment advisor broker-dealer. So the broker-dealer is the part of that joint entity, basically in the securities industry. They're selling those to the client. They would need written consent from the client before they did this. They represent both the buy and sell side on the same transaction. This is known as an agency cross-transaction. So basically what you have here, you've got two clients. One wants to buy a security, the other wants to sell. You would give advice to one of those clients and then affect the transaction on the other side. So they acted as an investment advisor capacity on one side of the transaction, and they acted in a broker-dealer capacity on the other side of the transaction. You're not allowed to give advice to both clients. And again, before you execute this transaction, you would need to have the written consent of the clients in order to do this. You can't give advice on both sides, only on one side, either buy or sell. You can't give, you affect the transaction on the other side, either to buy or sell, right? Let's look at some miscellaneous violation. The NASAA covered by the NSA violations: failing to bring written complaints to the attention of the broker-dealer. So if a agent of a broker-dealer receives a written complaint from a customer, they need to tell their principal about it. Their principal is going to be responsible for responding to the complaint and handling that. Soliciting order for unregistered securities. So securities that are supposed to be registered and aren't, not following legal customer instruction. We talked about that a little bit earlier. Recommending a stock of a publicly traded parent company. We talked about disclosure. So if a company's stock, a company issues and sells stock, and that company is affiliated with, they're under common control, or a parent company of the broker-dealer or investment advisor, and they're making recommendations to buy that stock, that would need to be disclosed to the client. That relationship would need to be disclosed to the client. And then also getting the customers somebody else's research, third-party research recommendations without disclosing that it was prepared by a third party. It's okay to give third-party research to a customer. You just need to disclose that it wasn't you as the agent or you as the investment advisor rep who prepared the report. Other prohibited practices: front running. This is trading ahead of a customer, affecting a trade for your own account prior to entering a client's order. Applies when the order is for 10,000 shares or more in large block transactions. So when you know it's going to move the price, an agent is working with working with a corporation. Say it's a client and they want to buy 20,000 shares of ABC. They put in an order to do so, but the agent decides to go and enter an order for themselves to buy 100 shares of ABC before they enter that large block transaction. That's front running, and it's a prohibited illegal practice. Trading ahead of research, right? So trading ahead of research report about a security oftentimes contains a buy or sell recommendation before that recommendation is released to the public. You're not supposed to make trades ahead of research. highlighting, marking up, or failing to deliver prospectus for a newly registered issue. So when prospectus delivery is required, you're not supposed to highlight, make the customer thinks that certain parts of the prospectus are different than others. You're supposed to allow them to determine what's important on their own in the prospectus and what's not. You can't alter the prospectus. Market manipulation, right? Simply trying to impact the price of a security, things like wash trades, painting the tape, trading securities back and forth without any real transactions taking place. The idea is to indicate volume without real ownership changes, right? Affecting transactions with no real change in ownership. General fraudulent activity that's done willfully or intentionally, trying to deceive. Broad-based investments. Nothing that's done with the intent to deceive is excluded from this rule. No one is excluded from fraud. Churning is making excessive trades for a client, over-trading their account, right? Agents are paid on a commission basis, so basically encouraging clients to make more trades than are suitable for them. That's churning their account. You're not supposed to churn. Most common within a discretionary account, the agent just makes trades on their own, but it can also happen in a non-discretionary account if it's the client, if they convince the client to make lots of trades through that type of activity. Let's look at rules related to loans to and from customers. These are NASA rules. The investment advisors are prohibited from borrowing money or securities from a client unless the client is a broker-dealer, an affiliate of the investment advisor, or a financial institution that's engaged in the business of lending funds. Also lending money to a client unless the investment advisor itself is a financial institution engaged in the business of loaning funds, or the clients are in the business of being an investment advisor. Broker-dealers can loan money to customers, but they must have a signed agreement to do so. The right to margin and borrow customers, right? They have to sign an agreement. They have to sign before they can borrow in a margin account. Broker-dealers are not allowed to borrow money or lend money to a customer, even if they're a bank. They can borrow money normally from a lending institution, as long as the lending institution is not a customer. In fact, they can borrow money from anybody, as long as that other individual or entity is not a client of the agent. But agent under NASAA rules are prohibited from borrowing money. FINRA rules are a little bit different, but your exam's going to talk about the NASAA rules. Here's a question. An investment advisor rep IAR is permitted to borrow money from A, a customer that's a financial institution, B, any customer if the loan is disclosed to the investment advisor, C, any customer that's defined as an accredited investor, or D, nobody. Remember, investment advisor reps can borrow money from financial institutions or customers, and also from affiliates of the investment advisor, but A is the correct answer. Here's another question. A federal covered advisor makes a loan to one of their clients for the purpose of buying a residence for personal use. The loan is secured by a lien on the house. Which statement is true? A, this is not permitted because an advisor cannot place a lien on assets. B, this is not permitted because the value of the securities for the loan may change in relation to the principal amount of the loan. C, this is permitted because the advisor can make the loan secured by real estate. D, this is not permitted because an advisor cannot make a loan to a client. Investment advisors, whether federal covered advisors or state covered advisors, cannot make loans to clients. So D is the correct answer to this question. Let's look at some specific conflicts of interest that could show up on the test. First off, an investment advisor acting as a principal and an investment advisor in the same transaction. So remember, broker-dealers regularly sell out of their own inventory, broker capacity, principal transactions. That's common for investment advisors because investment advisors are not registered as dealers. They don't deal from their own inventory. Now, if the investment advisor is a joint investment advisor broker-dealer, and this is relatively common nowadays, they operate in investment advisor capacity and a broker-dealer capacity. In that case, it is possible for the investment advisor to sell securities to one of their clients out of the firm's inventory, and that's what we're looking at here. They're acting as a principal. They're selling from their own inventory, and they're advising a client to buy that security. Now, in order to do this, they need to fully disclose their role in the transaction, describe any potential conflict of interest, and get the client's written consent in order to do so, no later than the date of the transaction is completed, which is trade settlement, T+2. Then the trade confirmation needs to be sent to the client, disclosing the firm's roles as principal and state that the client was previously informed and note that they gave written consent. So what we're talking about here an investment advisor has a client that they are telling they should buy ABC stock as advice. ABC stock is held in the broker-dealer's inventory, right, or in joint of the broker-dealer investment advisor, so they're going to buy it from the firm. So the IA is giving investment advice, and they're acting as the principal as the transaction, selling it out of their own inventory. They would need to get their client's consent to do that. An agency cross transaction, mentioned a few minutes back, but an agency cross transaction basically happens when the firm represents both the buy and sell side of a transaction. This again is something that would happen potentially if a joint investment advisor, broker-dealer. So what they do here is they're affecting the transaction for one party and offering advice to another party. They can only offer advice to one side of the transaction. They can't tell the buyer to buy or the seller to sell. So they broker the transaction, offer advice, broker the transaction to one party, offer the advice to another one. If they charge a fee, they could charge a fee to each client. They could charge an investment advisor a fee to the client who they're giving advice. They could charge commission to the client on the other side. So say that, just a hypothetical, ABC Investment Advisors is a joint investment advisor broker-dealer. They have one client who owns shares of XYZ and another client who wants to buy shares of XYZ. So they broker transactions between the two clients. They tell one client they advise to sell the securities, and then they effect the transaction on the other side. They can collect the advisor fee from one client, the commission on the other side. In order to do this, though, they need to have the written consent of both clients, provide full disclosure, and then annually they need to disclose in writing the number of agents and cross transactions and the amount of commissions, perhaps, that the firm has collected as a result of those transactions. Other conflicts of interest, recommending securities to the professional best, right? So anytime an investment advisory recommends a security, the disclosure must be made. The IAR should disclose if the IAR is personally recommending against the recommendation. Example, recommending a security that the IAR has just recently sold. It can be perfectly legitimate. You know, client suitability information might be different from the IARs, so it could make sense for the IAR to sell and the client to buy, for instance, but they need to disclose what they're doing. Other potential conflicts of interest, additional compensation for directed brokerage. These are soft dollar arrangements. The IA directs its trades to a broker-dealer. In turn, they receive soft dollar services. That needs to be disclosed to the client. Soft dollars, 12b1 fees. Agents of broker-dealers are being paid to sell mutual funds by 12b1 fees. That needs to be disclosed. Any other hidden fees. And any control relationship with an issuer or another firm needs to be disclosed. So you're recommending a client buy securities issued by a company that's under common control with your broker-dealer. That would need to be disclosed. Now, if a securities professional does not disclose a conflict of interest, then they should not take part of any transaction that's connected to that conflict of interest. So remember, when it comes to the test, disclosure is always your friend. Any instances in which it seems like something should be disclosed to a client, it probably should be disclosed to the client. Let's look at a few conflict of interest questions. May duly registered alpha investment advisors offer to sell securities from its own inventory to a client? Yes, as long as they disclose to the client and receive written authorization. True or false? An investment advisor may service an agent from one party to a transaction and an investment advisor to another party and charge a fee to each client. True. This is an agency cross transaction. As long as they disclose to the client and get the client's written consent, they are allowed to do that. They cannot offer advice both times, but as long as they follow those standards, they can do it. So true. Number 3, as an IAR allowed to tell a client to buy securities that they have just sold? Well, yes, but they need to disclose to the client that this is just happened, but they can't do that. Last, true or false? If an IAR has a soft dollar arrangement with a broker-dealer and it uses that broker-dealer to affect all transactions for all clients, the soft dollar arrangement does not need to be disclosed to each client. False. You would need to disclose that soft dollar arrangement to each client. Let's look at record-keeping requirements. The Uniform Securities Act states that any records must be kept in compliance with SEC record-keeping rules. The NASAA rules for state-registered advisors is that record must be kept for 5 years. The first 2 years readily accessible. There are some records that must be kept for longer than 5 years. Organizational records, such as articles from corporations, articles of partnership, these need to be kept by the firm for its entire lifespan, and then 3 years after it goes out of business. So most records, 5 years. Right, advertising, for instance, customer accounts, but the foundational records for the lifetime of the firm and then for 3 years thereafter, closure. Which of the following statements is correct concerning restrictions on advertisings by investment advisors under the NASA's statement of unethical business practices? A, investment advisors may not advertise their fees. B, advertisements must be filed with the SEC before being used by an IA. C, testimonials from clients may not be used in advertisements. Or D, advertisements may not offer free report or analysis to prospective investors. C is the correct answer here. We're talking about, for investment advisors under NASAA rules, we're talking state registered advisors. And for testimonials, they cannot be used in the advertisement of state registered advisors or their registered representatives, IARs. Next question. An agent is conducting securities activities on the premises of a bank. Which statement is true? A, this is an unethical business practice. B, this is permitted if the agent discloses orally to the customer that the products offered are not bank products. They're not FDIC insured and may lose value. C, this is permitted if the agent discloses in writing to the customer that the products offered are not bank products, are not FDIC insured, and may lose value. Or D, this is permitted if the agent discloses both orally and in writing to the customer that the products offered are not bank products, not FDIC insured, and may lose value. The correct answer to this one is D. It's permitted if the agent discloses both orally and in writing. The products offered are not FDIC insured and may lose value. They're not bank products. Remember, you might want to get the customer's written acknowledgement of these as well. Well done. This has completed our masterclass for the Series 65. And really, if you're trying to prepare for the Series 63, this class that we just covered is an excellent resource. In fact, it'll over-prepare you for the 63 in most cases. You've done so well getting through this class. It's time now that you go over to millionairesintraining.com and do our final exams. Make sure you're taking at least finals 1 through 5 and have 80 or 90%ed each of our fixed final exams, and then go on to take the final exam, which randomizes the entire test from all of the above content we've gone over in all sections of the Series 65. Chapter 1, 2, 3, and 4, combining everything in a mixed variety of questions, so you'll never be asked the same exam twice, very similar to the functionality of the real test. Go over to millionairesintraining.com and take these free simulated exams and work hard at them so you could prep effectively to pass your Series 65 and corresponding exams. Well done, warrior. I'm Colin Kleck, and I'll see you in the next video.